basis points of cuts over the next 2 years. You'd have to have some kind of I don't know, you described the recession to me. It would have to be quite a sort of a brutal punch to the economy to deliver 225 basis points of cuts.
I mean, I would agree. I mean, we are actually expecting a very, very mild recession next year. So starting in Q2, lasting 2 quarters, very, very small peak to drop. The big thing is, of course, what goes on with unemployment. But even within our forecast, we're only expecting 3 rate cuts next year, so 75 basis points of cuts for next year. So for the Fed at the same time to be saying that they don't expect recession, but then maybe to continue to have in their dot plot numerous rate cuts, it is slightly at odds. So I think that's a fair point.
Does United Auto Workers strike unfolding and a potential government shutdown, how do those 2 things feed into your outlook?
It doesn't feed into it too much. You know, from the inflation side, I think it's actually quite small. Maybe the strikes invigorate a few more wage demands across the economy. That's something that we need to watch. The bigger concern is really on the growth side, and I think that's where the threat is. And from the Fed perspective, it's another risk out there, which to me says, don't hike any further, but then keep the eye on the oil prices and everything else. That's a reason just to stay on hold for longer. So no rate cuts until you have clear evidence maybe that the labour market is starting to move into a downturn.
Seema, you know, when you look around the world, where are we in the evolution of the wage narrative? It's been the, you know, sticky inflation has been driven by services around the world, in Europe, in the US, and even in Japan, which we go towards on Friday. It's about, will we have enough data on the wages side to shift from yield curve control? Are we missing a beat here in the higher for longer narrative? It is wages are now moving into a new paradigm. Is there a shift? Is there a global shift that we need to reprice?
It's a good question. I mean, I do actually think that is one of the key questions when you're starting to think about beyond just the next 3 months and looking out over the next couple of years. It is about wage demands. The thing is, if you look at real wages, they're only just starting to move into positive territory. Real wages have been negative. That's why a lot of households have continued to be pressured. So this is almost a healthy development in some ways, which is why a central bank like the Bank of Japan wants to almost maintain a little bit of that pressure, but then keeping an eye out to make sure it doesn't take off too much. For the US, I think it's a difficult situation in a way because you are starting to see a little bit of unrest, you know, feeling that households are struggling too much and therefore they require further wage demands. So it's one thing that we have to keep watching. I generally think that a lot of the negotiating power is starting to shift back away from employees back to employers. So maybe some of that wage growth is going to start fading in the next few months.
Well, certainly the back to work and back to the office narrative is driven very much by the fear of recession, by the fear of slowdown, and that's got a consequence in terms of the balance of power between employer and employee. Stay with us, more work to do. We got you up early. Let's make value with you in the house. Coming up on the show, Goldman CEO David Solomon. He's drawn criticism in the past year over lackluster earnings, but Mike Mayo believes he's safe in the role for now. We discuss what the analyst says on Wall Street.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. that's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Now, Manus, the coverage of Goldman CEO David Solomon has been pretty brutal. I think there was even a New York Post story at one point talking about awkward dinner parties he was throwing. But as part of the mea culpa, Goldman continues to sell off its consumer assets. Latest reporting that they're going to be selling Green Sky to a consortium, including 6th Street.
And it's part of the fixing some of the problems. And this is Mike Mayo, the analyst, famed analyst across banks in Europe and here. He says Solomon's not going anywhere anytime soon. He met the board's lead director, and their conclusion is the CEO will stay in his role for the medium term, whatever the heck medium term is, Danny. And of course, they met with Adebayo Ogunlesi, who is the lead director. Yeah, in hindsight, they should have gone quicker. They should have punched it harder on the consumer front. But it looks as if they're putting that in order now. Will we have a little bit more?
I got to say that. Yeah, that medium-term thing, just quickly say, that definitely stuck out to me. But you're right, Manus. Coming up, Seema Shah, we'll get back with her, of Principal Asset Management on Bloomberg.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park. And that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. It's Fed Day. The central bank is set to deliver a hawkish hold to leave the door open for another hike. 5- and 10-year Treasury yields hit levels not seen since 2007. Meanwhile, the pound falls as UK's unexpected drop in inflation eases pressure from the Bank of England to hike tomorrow. And angst in the ranks. Mike Mayo says Goldman CEO isn't leaving anytime soon, despite the growing criticism from David Solomon's colleagues. All right, let's get your quick check on markets here. We have that softer than expected UK inflation. That sets off mid-cap UK equities, thanks to home builders, thanks also to the multinationals. European stocks, Manus, those are up for their first day in 3, up 0.5%. Finally, S&P 500 futures climbing back some of the losses that they have seen. We saw an upgrade from Bank of America on their year-end call. 4,600 is the new figure for them. Quickly, let's switch it up. Let me show you what Instacart is doing this morning in the pre-market for its second day of trading. It debuted at $30, went up to 34 yesterday. Now it's back down to 32. So some of the wind being taken out of those sales, Manus.
Okay, Danny. Well, of course, that is the elixir of life to every central bank. Softer CPI. It gives them that caveat. It gives them that optionality to move out. And that's what's drowning sterling this morning and the short end of the curve. But across the assets, we have oil, we have currencies, and we have Fed Day, of course. On the oil market, Goldman Sachs, they were the big bullish call of $100. They were out of the traps early. They're back in there again. Brent will make it to $100. They've raised their Brent call from $93 to $100. Now, they say most of the rally is behind us on sterling. Don't be fooled. Seema Shah said, don't be fooled by this softer CPI print that you have at the moment. Sterling is down. The swaps market now say 25 basis points of a hike on Thursday from the Bank of England. They're trimming back their overall estimates. And then, of course, it is the beginning of Fed Day. What will the dot plot actually tell us in terms of rate cuts for 24, rate cuts for 2025? How hawkish a pause will today be? But to the CPI in the UK, the elixir of life for caveat emperor for the Bank of England. And this is the performance on the short end of the curve, Danny. As you can see, a dramatic drop in the short end, the biggest one-day drop, I think, since June of this year. Do you want to believe that you're going to see maybe table mounting created by the Bank of England, as Hugh Pill said to us in South Africa just a few weeks ago? Danny.
Yeah, Manus, and as you pointed out, Seema Shah, who we're going to get back to shortly, did say, look through this one reading. It is just one reading. It doesn't make a trend. But we know the UK has consistently surprised to the upside when it comes to CPI. So it's interesting to put it in the global context of Canada getting a hot reading tomorrow. Does this make us perhaps rethink this narrative of sticky inflation everywhere? Perhaps the UK sets the cat among the pigeons.
Look, absolutely, and there's no doubt about it. It was the angst in the ranks in the macro policy from Canada yesterday. A hotter Canadian inflation reading really set off those bond markets in the New York session. But I think really over the next 24 hours, next 36 hours, we're going to get a redefinition of what G3 looks like.
Yeah, a lot to go through over the next few days. Let's do just that. Still with us is Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, we're going to switch things up a little bit. We're going to do a little bit of a rapid fire and get really into these markets. So I want to get your quick take on some of these different assets. Let's start with risk. Let's start with equities. Is now a time to be long or short American equities?
I think this is a time to be neutral because I know this is going to be too quick, But the thing is that at the moment, it's going to be very difficult to get the timing right. We think there's going to be a bit of a pullback, but it's going to be quite short and shallow. So this is probably the time to be neutral and then look to edge in as you start to see economic downturn unfold.
See, Seema, you're quick but eloquent. It's amazing. All right. Tell me then about high yield, about junk bonds, obviously very correlated. Is it the same for that market?
It is. It's similar. So you do need to have some exposure because it's too good at the moment to avoid, or just to not have. But at the same time, if we're expecting the economic downturn, high yield is a bit which will be impacted the most. But again, it's not going to be impacted too hard because this is still a short, shallow downturn that we're only anticipating.
So short, shallow recession. Let's talk about then the opportune moment. I think you and Bob Michael must have had either a bit of lunch or a bit of breakfast. Bob Michael wants to buy every dip. Here you are. You say the bond sell-off, any bond sell-off is an opportune moment. Where in duration do you want to be?
So actually, we're thinking about longer duration at the moment. You know, we do think the economic downturn is coming. That's going to put downward pressure on that 10-year point. At the same time, you know, you can get in a 2-year, you can get in right in the front end. But really, this is a time to lock in any of the gains that you can get from a 10-year perspective. So actually, we're thinking longer duration rather than that short end point.
Equity risk premium is at a 20-year low. So what goes through my mind is how long of equities do you want to be? Or do I, and some would say, waste money and buy myself some protection, buy some VIX, which in theory is perhaps a little bit of value at the moment?
So really, VIX should be going up, but actually, I think we're having to rethink the way that we think about volatility because it hasn't been moving in the way that we would anticipate. Equity risk premium, it is low. This is, I think, the time that fixed income is a little bit more attractive than equities, but it's fairly equally set at this point because there should be a rally once you come out of a bit of a dip in equities.
The dollar bulls and the bears have been equally shook, perhaps, this year. Those who thought that they could take positions against the dollar have been badly informed to the other way. Seema, we're going to get the BOJ later this week. Could we finally see a dollar downtrend in place?
I think you could, but it's not going to be too significant. You know, we do know that the Fed is going to be, we think, is going to be on hold for a while. So there's still that hawkish commentary starting to come out from them. So it's a bit of a downward move, but I don't think it's going to be very significant.
So I just did the big bullish call from Goldman Sachs there. They're back on this rampaging $100 oil, and that OPEC are going to keep us there. I can't pin you. Well, maybe you will give me a pin down answer on oil, but you have a broader church which I'll give to you. Do you want to be long of oil? Do you want to be long of commodities? Given the depth of recession that you think we're going to have?
So look, it depends entirely on what your time horizon is. If you're thinking about the next 6 months, I would be neutral because I think reading oil prices, given it's a supply move, it's a tough one to try and make a decision. If you're looking out over a longer term perspective, you should be overweight commodities because that supply shortages is only going to keep picking up. And we think oil prices, commodity prices, upward move over the next 5 to 10 years.
When does the rubber hit the road of higher oil impacting your other asset allocation? Is it $100 a barrel, as Goldman says? Is it something else? When does the rubber hit the road?
So let's say it hits about $120 a barrel and it's maintained there. That to us is a deeper downturn than we're anticipating. And at that point, I think you want to be really heavily into risk, into safer assets and risk.
All right. Looking at China then, that's another area where our assumptions have had to be challenged. When it comes to China exposure, whether you want to do it outright or perhaps in Europe, luxury, those sorts of things, can you buy China exposed assets right now?
I think it's a really tough one. So although the central bank and policymakers are trying to do more, I don't think it's going to be enough to convince investors to be increasing their allocations at this point. We would prefer other assets within EM which have a bit of a diversification to China. So India, for example, is a really key diversifier against China. If you have any concerns, increase exposure to India.
I like the way you frame the Indian narrative relative to China. It's not the perfect hedge, but it is something that you see as a contra to China. A lot of people are debating what the PBOC does next. Lots of incremental policies, but what is it that would shift the risk dial for China for you?
So if they really come in aggressively on the property market, that is the only thing that's going to make any kind of move for the China economy. Interest rate cuts, if it's not hitting the property market, it just doesn't do enough because there is very, very subdued confidence at this point. I don't think you're going to see that bazooka move, at least for the time being, until you see maybe a deeper downturn. And at this point in time, given you're seeing that economic data is starting to bottom, I think maybe the central bank will be a little bit reassured and can sit back and rest again.
Seema, you've survived the rapid fire. I hope we don't scare you off. Please come join us again.
Absolutely not.
All right, Seema Shah there from Principal Asset Management, playing ball excellently, I might add. All right, coming up, we're going to continue the conversation ahead of a lot of central banks. UBS chief economist Paul Donovan joins us. This is Bloomberg.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
Men in their 70s that have a lot of wrinkles. I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things,
Really?
but maybe it'll be a little bit beyond skincare.
Oh.
The problem is that the Bank of England right now is sending sort of dovish signal in a situation in which the policy rates are well above the Fed, but inflation is well above the United States. So what they should be doing is actually hiking rates all the way to at least 5.75. The signals are telling us right now is they're not sure whether they want even to hike more. If that happens, there could be a de-anchoring of inflation expectation. You could have a true stagflation.
That was the economist Noura Rabini speaking with Danny and myself on Monday. UK inflation for August unexpectedly fell to an 18-month low, easing the pressure on the Bank of England to hike tomorrow. Do they have the justification? Paul Donovan is the chief economist for UBS Global Wealth Management. Good morning, Mr. Donovan. Do they have the caveat that they need to pause, or would it be a mistake? Good morning.
Good morning. Well, the Bank of England is a very academic institution, and it has no problem with having very, very public and very, very significant internal disagreements. And I think that's what we're going to get tomorrow. We're going to get a very, very split decision. And I think it is now very, very finely poised as to whether they vote for hopefully one last hike or whether they decide to stand pat. It's not just the inflation data, it's a lot of the detail. UK inflation actually overstates what's happening with inflation in the UK. Food price inflation is actually lower than is being reported because supermarkets have this very weird dual pricing strategy. There's lots and lots of complicated factors here. So overall, if I was allowed a vote on the MPC, I would probably vote for no rate hike. I suspect the bank is probably just going to tip over into a rate hike at the decision tomorrow. But as I said, it's a very, very finely poised decision, and the bank loves to have internal disagreement.
And maybe that's the most healthy of all a discourse. I like the way you talked about a British pint of lager. This is the conundrum within inflation in the United Kingdom. CPI is the most expensive pint of lager, is 3 times the cheapest. I mean, just take me behind the pint of lager and why you're using that analogy and why it matters. And do you think the Bank of England, they're like a pint of ale at Threadneedle Street, don't they?
Yes, although the price in London is not the highest price. That's an important point to bear in mind. So, if the Bank of England governor is popping out for a pint of beer before the MPC, or possibly before the press conference, then he can get it a lot cheaper. The point here is that, firstly, there is a lot of divergence of inflation experience emerging, and the divergence has increased. That's one of the really interesting things, not just in the US. I mean, sorry, in the UK, it's also happening in the States.
Yeah.
The other thing about this, that it means that the inflation experience of some people is actually very different to the aggregate inflation experience. If you're living in the West Midlands, where a pint of beer is a little over £2, it's a far different experience to East Anglia, where it's over £6.50. So very, very different experience, and that means the spending power of consumers in different parts of the economy is noticeably different as well. Now, this, I think, is a bigger deal in the States. One could argue that the US doesn't have an inflation problem. It's got a Florida problem, because Florida is where the inflation's at. Lots of other parts of the States, inflation is back to within pre-pandemic ranges.
Manis, come on, you're in the US now. Do you need to avoid Florida? I think New York, come on, New York's got to be worse than Florida. Manis, how much do you feel it moving from Dubai there?
I feel food inflation here because I'm not cooking at the moment. And as for rent inflation, I mean, the broker that I've got, he's a little bit wealthier. The 2 brokers that I've got, they split the rent. But Paul, inflation here is live. It is kicking. How does it, there's the point. I can really, really feel inflation coming into this country from the Middle East.
No, and I appreciate, you're looking for your townhouse and your place in the Hamptons and so on. It must be expensive.
His penthouse.
But when we're looking overall, a lot of prices in the United States, in various parts, including in New York, have been coming down. Now, the price level is obviously going to be different from an area like the Middle East. You will see differences in the price level, but the inflation rate has actually become very subdued in cities like Chicago, Los Angeles, New York. Alaska has been having deflation recently, so absolutely falling prices coming through. So it's quite a wide range of experience that you've got in the United States. But lots of parts of the States, as I said, have got inflation sort of in the 2.5% to 3.5% range. Florida, unfortunately, is hovering around 8%.
So, Paul, how does the Fed solve a problem like Florida?
Well, of course, this is difficult. The Fed is looking at the economy as a whole, and it's got to try and decide where pressures are going overall. I mean, what I hope is that the Fed will take a look at the fact that wages, and I mean wages, not average hourly earnings, but proper wages, are slowing down. They're going to take a look at the fact that we know the fiction that is owner's equivalent rent, which is adding to inflation at the moment, that's going to come down in the future. And they will know that the lived inflation experience for a middle-income family that own their own home in the United States is actually significantly lower than the headline CPI. They'll know that they're in a more benign inflation environment overall. Churn in the labor market is slowing down, and they'll call a halt to the rate tightening. The important point to remember is if the Fed, or indeed the Bank of England, pause on interest rates, policy still gets tighter. Central banks are still pressuring economies slower if they do nothing, because real borrowing costs are going to be rising over the next 3 months, because quantitative policy continues to tighten. Everyone's gone quiet on quantitative policy. It's the second pillar of central bank policy, and it's continuing to tighten. So they are still tightening policy, even if they do nothing.
Should they be more active in it, Paul? Should they increase the Fed at this next decision today? Do you think we could get a hawkish surprise in the way of QT?
I think that's unlikely. I mean, never say never with Fed Chair Powell. I mean, after the June policy errors last year, where policy guidance was torn up, I would never bet against anything happening under the Powell Fed. But I don't think that's required because, of course, what's happening is the economy has slowed, but the economy is still growing, and it's growing faster than the Fed initially expected. Now, an economy that is growing demands liquidity injections, but the Fed is pulling liquidity out of the market. So what you've got here is the Fed's balance sheet as a share of GDP is falling faster than the Fed would initially have anticipated because the economy is doing better, the economy is demanding more liquidity, and the Fed is taking away the pinch ball. So I don't think that there's a necessity to do more on quantitative policy. I think the fact that the economy is growing and the Fed is pulling away liquidity at the pace that it's doing is creating enough of a slowdown in the balance sheet to GDP ratio.
Well, I think the Fed learned from a few fumbles in QT under Bernanke. Very quickly, Paul, oil, lots of debate, $100. Will it be a second round effect or for central banks, or as you say, actually, Manus, it's going to crimp the consumer more? Briefly, the take on oil.
So I think it's more likely to be growth disinflationary. This time last year, consumers had more savings. They could cushion the oil price. This time, I think you'll get two effects, cutting in non-oil spending, but also don't forget, oil is now more flexible as a form of demand. People work from home. You're not driving the car. Oil demand goes down. Oil price up, more people work from home.
Although if you listen to a lot of executives, I should say, less folks are going to be able to work from home. Hey, Paul, I'm afraid we're going to have to end it there. Really wonderful to have you on the show, gearing us up for a big rest of the week. Paul Donovan of UBS Global Wealth Management, thanks so much. Now, coming up, we're going to have more on the market-moving events for you to watch throughout the day. This is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. Now, Now, a quick look at what's ahead today. Let's get you set up for your trading day. President Biden will be holding bilateral meetings with his Israeli and Brazilian counterpoints. That is at 10:15 a.m., 1 p.m., respectively, in New York. And then we have today's main event. It's the Fed rate decision. That will be at 2 p.m., followed by Chair Powell's news conference at 2:30. Don't miss our special coverage. That will be at 1:30 Eastern. And then it's FedEx reporting its earnings after the market closed with eyes on any update on the carrier's cost-saving plans. Manis, before we can get through all of that, we have the Fed, and then we have the BOE, which, the way the market's trading, that could give us even more volatility than the Fed today.
Well, I think actually Threadneedle Street probably needs to see a softer Fed and something from the PMIs tomorrow to perhaps help them. Danny, there is only one chart that defines rates risk, and it's at the short end of the UK curve. And this is where the CPI came in at the lowest level for 18 months, and down went the very short end of the curve, 2-year yields dropping, because there's going to be a very divided Bank of England tomorrow, according to Paul Donovan. Sterling's down by 1/8%. Of course, it's had a fairly good run from Trussonomics, but here you are. The gilt market now believes that the Bank of England, Threadneedle Street, have got the fodder that they need, the caveat that they need to deliver a pause. We need to qualify that pause.
Yeah, I'm still fascinated by what Paul Donovan just said to us, Manis, because we talk all the time about the ECB dealing with regional differences, that it's one policy for many nations. Well, what happens in the UK, where you have beer, as Paul said, more expensive in London than East Anglia, which you're going to show it to me on a map after the show, and in the US, where Florida is much more expensive than Chicago? How do you deal with that?
But then that is the conundrum. I mean, delivering an interest rate for more than 50 states, delivering an interest rate for the United Kingdom are two very, very different things. Rates aside, you're also seeing those US rates hit the highest level since 2007, and that was on the inflation pop that drifted over the border from Canada. So, you know, the nerves are jangling, and then you go into Bank of Japan on Friday, and I think that's all about the currency rather than the rates. What have we got on the pre-movers? Instacart, they were brave, weren't they?
Yeah, I mean, IPOing in a Fed week. I mean, look, ARM went in the CPI week, so maybe they gave them the all clear, but we are now under $32 on the pricing for Instacart. It priced at $30 before the IPO. It went up to $34. Manis, we're kind of getting close to undoing all of that IPO pop.
Yeah, I mean, it was what, up $42 a share. They sold it onto the floor at $30. I mean, it was a monster one. Last week, the accusation was that ARM left too much on the table. There's a couple of other things just to keep your eye across. Keep your eye on NVIDIA, along with the automakers in Europe. That'll drift through on the EV story here into the US session. Let's see whether there's a nice bump on that. But tomorrow, it is all about the bond market, isn't it, Danny?
Yeah, we're going to have coming up on the Bloomberg Brief. We'll be speaking with Oliver Kedewell of First Abu Dhabi Bank and Sarah Hewen of Standard Chartered. All right, that's it for the Bloomberg Brief. Surveillance is up ahead. Coverage out of London. We'll be talking to ARK Invest CEO Kathy Woods. Manis, good morning from London.
And good morning from New York.
Politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Well,
take this one day at a time.
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time, join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lange.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
From New York City.
From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
It doesn't look like we've got a major issue with the economy at the moment. The economy's been relatively resilient.
Central banks have carved out in the last 6 to 9 months a focus on core inflation.
2024 should be a better year for earnings with the market.
We are seeing inflation coming back down towards where the Fed would like it to be.
In the end, higher for longer means there's going to be further tightening here in the real economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The week begins right now, live from the City of London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market is positive by 0.2% on the S&P 500. Hours away, TK, from Chairman Powell and that news conference.
And it's a different news conference than it was a couple days ago. Between the United Kingdom inflation coming in a little bit, I love what Paul Krugman said. We'll talk about Krugman's essay on disinflation here in a moment, but it's a changed outlook to the press conference than it was even 48 hours ago.
I'm told that it's a coin flip going into the Bank of England tomorrow. I will say this, 7, it's not 7, it's 6. Bramo, does that make a difference to you? The good news is it's not 7. The bad news, it's still 6% inflation in the UK.
The idea here is UK inflation did come in softer than expected. This is a positive, but how much of a positive? And you raise a good point. To me, the key distinction here is that the core measure actually came in much more than expected. So stripping out food and energy. How much are we going to be talking about the difference between core and all in, what you feel when you go to the store?
Well, that's going to be a theme today. I mean, we're there. We're there where we're slicing and dicing like David Rosenberg, what you do with inflation, disinflation, maybe parts of the world deflation. But the central bank story to me is they're completely data dependent, and that's what you're going to hear from the chairman today.
This market is running with higher for longer, that's for sure. Cycle highs on a 10-year yield in the last 24 hours, Lisa. New cycle highs going into this Fed decision. Crude at around 95 on Brent. We pulled back a little bit on WTI, but we're right there on crude. So the headline versus core conversation, how do they navigate that a little bit later in the news conference?
I'm not sure, because if you take a look at goods inflation, it's starting to reignite. And so at a certain point, oil feeds into that. The question to me is, how much is it being driven by demand? Can you be bullish on oil without being bullish on the economy, right? I mean, basically, aren't you seeing the kind of growth, which is the reason why people say, look, yes, yields are going higher. Yes, oil is going higher, but it is doing so because there is that demand, because there is that strength.
The heart of the matter, and to start strong today with Ben Laidler, I think says so much about how the gloom crew has gotten it wrong, is there's a resiliency to corporations, to market participants of working in a new interest rate environment. First thing I looked at this morning, John, the 10-year real interest rate, it's at that 1.9x level. To go through 2% is going to be a change agent if we see that this afternoon.
Are you throwing shade at Bramo and and Bramo.
No, I'm not throwing shade at Bramo. I just, you talk about disinflation, John. You don't see it on radio here, but behind John, John, I'm looking over at St. Paul's behind you, and there was inflation in the crumbs that they were serving tuppence a bag.
Right? Is that what you saw this morning?
I pulled out the farthing, and the farthing didn't go as far as they used to go.
Before we get deep in that nonsense, let's talk about a headline that came out in the last 24 hours. Amazon, holiday hiring. Bramo, 250,000 logistic workers. Pre-pandemic, that number was 200K. What was the number last year?
150,000.
It's getting better, right?
To me, this is actually really important. And there are people who say, well, actually, this is because more of the shopping is going online. Ironically, maybe people don't want to drive because gas is getting expensive. But either way, you're looking at a robust projection for a holiday season at a time where people are worried about that savings cushion supposedly going away. Where is that? It still seems to be there. If Amazon is hiring that many more workers and offering $1,000 to $3,000 bonuses.
So do the UAW workers double dip? Do they go over there and move boxes around while they wait for
I'm not sure
Detroit?
That's how it works, TK. We'll get you the latest update on the UAW negotiations a little bit later this hour. Let's turn to the price action on the S&P 500 this morning. And good morning to you, up by 0.2% on the S&P. Yields pulling back just a little bit. We're down 2 basis points on a 10-year to 4.34, but had a little look at cycle highs in the last 24 hours. And Lisa, if you want to blame something, I guess the move started after Canadian CPI.
Yes.
This was down to Canada, apparently, in yesterday's session.
And it came in lower than expected, kind of similar to what we're seeing in the UK. Today, the focus really is going to be on that 2 p.m. FOMC rate decision, followed by Fed Chair Jay Powell giving that press conference. The forward look, the statement of economic predictions, the dots. The concept there is what people are really going to be watching. A hawkish pause. God, we're going to have to be talking about that in the band that Tom created in high school today.
Is this 6:30 p.m. tonight? Are we into the surveillance sleep, or are we doing this?
We're doing this. We're going to be here.
Yeah, my people haven't told me.
A Fed special is happening.
1:30 p.m. Eastern or 6:30 p.m. British time. Meanwhile, today, Bank of America CFO Alistair Borthwick is going to be speaking around 7:15 a.m. Eastern time at a Bank of America Financial CEO conference. JP Morgan CEO Jamie Dimon speaking at the Detroit Economic Club at 1 p.m. I am curious how much they indicate that this strength has further room to go. And the savings cushion, do they push back against that at a time where it seems like people are getting raises and can actually push forward?
I'm interested in the fact it's in Detroit. Just kind of timely, right?
President Dimon, do you think that he's going to be trying to do this?
I'm not saying that. I'm just saying it's a timely conversation given what's happening.
How much is he going to weigh in on this? He's been known to be rather blunt, so it'll be interesting to see whether he comes out. In aftermarket, we do get some earnings, including from FedEx, which has gotten a boost so far this year from Yellow and UPS and some of the union negotiations there. I'm curious what they say about their labor and potential negotiations.
Always important.
Lisa, thank you. Joining us now, Ben Laidler, Global Market Strategist at eToro. Ben Laidler, constructive on this equity market. Max Kettner, HSBC, sat in your seat yesterday. He said we need to think about what could go right next year. You're the master of what could go right. What could go right?
Wow, you want me to give you the whole list?
Is it that long?
Listen, we're living sort of Goldilocks macro, right? I mean, growth is a lot better than we
He said, yeah, down, but his brilliant call was to push it out from his original call. He said, this is out a long way out, and we're still waiting, and we've been wrong on a UK slowdown. You look at something like the GDP input to Newcastle of that game last night.
I'm not talking about
that moves
game
the needle up.
There will be no conversation about that
There'll
game
be no
last night. We're done with that.
What else
Did
do
you
we
get any
have?
Instacart shares? Did you get any shares?
No, I did not. You got your usual 8,000.
Instacart easing in this morning's trading after gaining as much as 12% in Tuesday's debut. The IPO raising $660 million, marking the year's fourth biggest public offering in the United States. Semiconductor designer ARM raising $5.2 billion last week in the biggest listing of the year. Can you take any signal from this, TK? These two listings we've had in the past week?
I believe it was Zero Hedge. Had great charts last night. ARM goes up, enthusiasm rolls over it sells back to the initial opening price. And for both of these companies, very different. You know what it's about? The first conference call. That's really what this is about. You get away from the hoopla, and you get out the first call, second call, third call. And then
those quarterly earnings.
Quarterly earnings.
Like the questions from the analysts.
Do you think they understand they've got to go on the phone and explain what's going on?
I think ARM understands that. Instacart might have to figure that out.
Yeah.
ARM's got a history of doing that, Tom, as you know.
We are having fun today. It's an extended day for us here in London. It's been wonderful. Our team's put together a great eclectic set of voices for you to frame out, the path to 2024. Elsa Lingos is hugely qualified. Global head of foreign exchange strategy at RBC, tour of duty, working in Europe with different institutions to look at the political economics of the moment as well. You know, to you, I can say, like, what's Euro going to do? Or what's Sterling going to do? What are they going to do if they actually get disinflation? Can you call a disinflationary trend in place yet?
Too soon for that. But I do think this morning's CPI data will be very welcome news from the Bank of England perspective, because they'll feel like finally their policy measures are biting and they're removing some of that tail risk of stagflation.
How many months or quarters do you need to establish a disinflationary trend? Not the data dependency, the media's focus on one surgical point, but what's your timeline to say trend in place?
Well, I think it's also the composition of inflation, right? Because we've seen headline inflation come off on energy prices. In fact, if anything, now ticking back up again, as we saw yesterday in Canada. So really what we're focusing on is that core measure, or even more so the super core measure. What's happening to those demand-driven components of inflation? And are those weakening enough to signify that we're going to get to target?
And Paul Krugman with a brilliant essay out, folks, Wheelhouse for the Nobel laureate on trends. He looks at disinflation, and I love what he says about plain vanilla inflation. John Farrell's family in England is living plain vanilla 6% plus inflation. Do people like you and these elites, do they look at plain vanilla inflation?
I mean, you see plain vanilla inflation across the board, right? And I think that's the important part about the current rise in energy prices. Because for all that central banks like to look through those and focus on core inflation, if headline inflation goes up, comes down a bit, goes up again because oil prices or commodity prices don't really come off, what does that mean to your average consumer? Their kind of lived experience is that prices just keep going up.
I can't believe we're sitting here and we've got this note from not the Bank of England, from the Goldman Sachs team on the Bank of England, suggesting we're done here when inflation is in the high sixes. Can you make sense of that for our audience? If we were in the high sixes in the United States, we'd be talking about the prospect of a 50 basis point hike from the Federal Reserve this afternoon. Why are we talking about the Bank of England being done with inflation in the high sixes and wage growth pushing 8%?
I think it's the wage growth that's more important, right? Because don't forget, the Bank of England looked through high inflation in the immediate aftermath of the GFC. And there was a long period where Mervyn King was writing regular letters to the Chancellor about inflation being outside the target band, and yet, you know, they were happy to leave it near zero. It's that which is the difference. It's the fact that they're happy to look through it if they feel like their policy is working. And I will say this morning's data do make tomorrow's decision much more finely balanced.
Simon French of Panmure Gordon was in your seat yesterday. He suggested that this Bank of England has a communication problem, a credibility issue. Do you agree?
Yeah, it's hard to say they don't. And I think more than anything, it's the inconsistency in the messaging that people struggle with. I mean, sure, this is a particularly difficult time to be forecasting. I think economists have struggled with that on the sell side and the buy side. But from the Bank of England's perspective, it's the fact that that message seems to change every month rather than just sticking to this data dependency mantra.
You speak 14 languages. You've got parchment and physics from Cambridge. I want you to talk about the physics of Christine Lagarde's speech at Jackson Hole. You live the ECB theory, the ECB process, if you will. Is there any hope and prayer that the ECB can get away from the data dependency that she despises?
Sadly, not really. And I think the reality is that you've got so many competing views on Governing Council. You saw that just over the weekend, right? They had that announcement last week, and then they already came out with voices saying, oh, we should be doing more, we're not quite done yet. And it's that kind of cacophony of voices which ends up with the data dependency.
Well, you two are expert on this, John. You've lived it as well as Elsa. And what I find fascinating here is the simplistic American view of Bundesbank versus Portugal. Now, it's not that way. You both know it's richer and more complex. To be honest, my good friend Christine Lagarde doesn't have a chance on this. There's no chance that they're going to take a more holistic, longer Philip Lane trend.
Here's the difference.
In policy.
Under Draghi, who was not a consensus builder, he would bully the Governing Council into a corner and say, we're doing this. And he'd have to get the Bundesbank to come along. Lagarde is a consensus builder, but she gets an easy time of it now because Germany's the weak spot. Germany's the weak spot. And what I don't hear from the hawks on the Governing Council, they're not screaming rate hikes. They're not screaming rate hikes at all. So how much of a deal was there actually to strike on the Governing Council last week? People make out it was a deal between doves and hawks. The hawks that I'm hearing from aren't that hawkish at the ECB, are they?
Well, they're a lot less hawkish than they used to be because, as you say, Germany itself is feeling the weakness. But also Draghi, in many ways, had to do that, right? Because it was crisis situation and that forced his hand. Whereas now, we're not really there. We're kind of in a situation where central bankers have a bit more time to assess, to be data dependent, to build that consensus.
I teased this a little bit earlier when we were assessing what was happening with sterling. And Lisa raised the question, I think it's a really important question to ask regarding the UK and sterling, but I think we can take this broadly to Europe and the euro. How important are rate differentials for currency pairs at the moment? When you see developments in the UK, is this kind of development meant to be sterling weaker or sterling stronger? What does it mean?
Fully agree with Lisa that it's ambiguous. Right, I've heard a lot of people, probably more from the sell side than the buy side, trying to talk up sterling as this carry trade. There's much better carry out there. I mean, if you really want carry, you're going to Mexico, you're going to Brazil. Like, the UK is not necessarily where you're going to get it. But at the same time, the fact that, like I said earlier, you kind of remove some of that tail risk of stagflation, that's a good thing. And from a policy credibility perspective, it's good that the Bank of England is finally, seemingly, getting inflation under control.
What is your question for Powell today? You're in the press conference. McKee gives the last question. They go, Lingos, you're here. We'll give you one. What's your question to Jerome Powell today from your EU perspective?
I'd be really interested to hear how he's thinking about the run-up in energy prices and the feed-through that will have to headline inflation.
Well, wait. Well, stop the show here. Halima Croft. Okay, you've got someone who's pretty good at this, right? Yeah. What does the wonderful Halima Croft... Halima, wonderful to see you. Thanks so much for stopping by. Halima Croft, what does she say about this move to 100?
I think she's been bang on the money with that call. Now that we're there, it becomes a lot less obvious that we continue further from here. But she was very open and talking a lot about it earlier in the year, and markets were just ignoring it for a while. They were ignoring the supply cuts, the production cuts. We're here now. We feel the impact.
Can Powell ignore this later on this afternoon?
I mean, let's see. It's a very short intermeeting period between September and November. December is probably the time they need to make that call.
Do you think the Bank of England can ignore it a little bit more? I'm just wondering, who is this more important to? Governor Bailey? Ueda? Powell?
Ueda, we can almost forget about. The Bank of Japan are not doing anything anytime soon, and even when they do, it's going to be tiny. Now, I'd be most concerned in the ECB's position. Energy importer, you still have that regional difference between US energy prices and European, and they're the ones really that are facing the economic weakness.
We are staggering beyond Duesenberg. Through Trichet, John mentions the wonderful Draghi of Italy and now Lagarde. Is the ECB a more mature institution now, or are they still making it up as they go, as they did when Marsing was there?
Absolutely more mature. And, you've got to remember they've been now in existence for over 20 years. They've been through several crises that's knitted them together. But more than anything, the fact that it's the core now feeling the weakness, I think that
John mentioned that.
Naturally
I didn't mention that. John mentioned that.
Jane Foley talked about the prospect of parity on the euro in the new year. Are you going there yet? Can we finish there?
We got to make some news. Come on.
We've had 104 for year-end forecast since the start of the year. And that hasn't changed. But we looked into 2024 and actually said, why should it stop here? Why should it bounce back? We've got 102. Could we get to parity? Sure, maybe. I just don't think we'll stay there long.
Bold.
Alsa, thank you. That's quite a call so far in the year. We'll see how we end it, but quite a call so far. Alsa, thank you. Alsa Lindos there of RBC. They've got 104. We're trading at 107. 104 was quite a call at the start of the year. You have to imagine, go back to the start of the year, all the happy talk around China reopening, what it might mean for Europe and TK. That story is not the story going into year end. In fact, Lagarde talked about that in the news conference of the ECB just last week. The tailwinds at the start of the year, China reopening, lower energy prices, they have gone and they have developed into headwinds going into year end.
Yeah, and I think into these 3 central bank meetings, what our audience needs to pay attention to is this is a movable feast right now. There's no cast in stone belief going into October, dare I say, to that Fed meeting in December. We're literally, John, making it up as we go. And it feels that way, folks, putting the show together. Day by day, we're making it up.
Day by day. I think we can say the week begins today, a little bit later on this afternoon. Chairman Powell, a decision from the Fed, non-decision for many, no change expected. The forecast will be closely watched, changes to growth projections, inflation, the dot plot as well. Then it's on to the Bank of England tomorrow and the Bank of Japan on Friday. To preview all of that, Bruce Kasman, JP Morgan, looking ahead to those 3 central bank decisions. He joins us next, live from the City of London for our audience worldwide. Good morning.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
3 big days coming right up. The Federal Reserve a little bit later on this afternoon. The Bank of England tomorrow. Then on to the BOJ, the Bank of Japan, and Governor Ueda on Friday. The price action set up as follows, going into all of that on the equity market. Futures, just a little bit positive here by 0.2%. Yields coming in, TK, a couple of basis points. Your 10-year, 433.
The price action here that matters is, can John get decent tickets for Arsenal Tottenham on Sunday? What do you think?
I'm trying to hook it up. Yeah. Arsenal's the home team, though.
What I find, this is the only city in the world where I religiously take taxi cabs. I love them. If you mention English football to anybody driving a taxi cab,
yeah, they've got a team.
That's entertainment. That's entertainment for the whole trip.
I prefer the West Ham fans.
Yeah.
The West Ham fans, proper East London cab drivers who have got things to say about British football.
I've had so much fun with this. We're going to pause on this right now. Bruce Kasman coming up here in seconds on an important day, important conversation with Dr. Kasman. I had so much fun last night following a boring 0-0 game. It wasn't boring. And what is the symbolism that Newcastle went in there and survived AC Milan?
Pretty impressive. They've not been in the Champions League for about 20 years. So to go to a stadium like that, and for some of those players, Tom, they probably never thought they'd be playing an occasion like that.
To walk in a field
in a
like that,
stadium
yeah,
like
very
that.
cool.
To walk out to 80,000 fans, and we talked about the atmosphere and the acoustics of the San Siro, to survive that. And they did survive an onslaught. Compared to the shots on target at Newcastle, I think one
Oh, it's
for AC
terrible.
Milan.
It's completely one-sided.
Completely different in terms of the statistics. But yeah, they got out of it alive, and fair play to them.
And just to educate idiots like me, they do it again at Newcastle.
There will be a return leg. I think that return leg is in December.
Yeah.
But the challenge you've got, TK, when you're new to the sport, is understanding the tension of European football, understanding the tension so that you can enjoy.
Is it nationality in cities and, you know?
Yeah, the tension between the two clubs.
I don't see it anywhere in America. Anywhere in America. Maybe NBA, but not even there.
I was always told that Americans didn't like European football because it was too slow and low scoring. And then I look at American football, Tom, and the ball is hardly in play.
Oh, they've ruined the game.
And all you've done is call 1 goal, 7 points.
Yeah.
What's the difference?
It's run by committee
I'm going to get
now.
so much hate mail a little bit later.
No, but what's important on this, and this is the change, what we hate about English football is everybody falls down and gets hurt. And they've really diminished that.
They need to clean that up.
They've cleaned that up.
And I think the officials, the referees, are going to try and do something about that.
There's your football moment for the day. We're having a lot of fun.
We are done. No more Newcastle AC Milan.
Doing
no
this.
more of that.
As John mentions, the week starts today. For Bruce Kasman, it does not. On Friday evening, Kasman, along with the dreaded Dr. Ferroli and others, put out their weekly prospects. The way things are moving, it could be daily prospects. Kasman of J.P. Morgan joins us this morning. Bruce Kasman, what will you listen for from Jerome Powell today?
Well, I think the issue really when the Fed certainly stays on hold and certainly also continues to maintain a hawkish bias is how on this color are we talking about their confidence that they're done here. And I think, of course, they're going to continue to maintain that bias. They're going to give us some sense of progress on inflation, some ongoing concern. I don't think we're going to get a strong message. And quite frankly, I don't think it's going to tell us that much in a world in which the data is going to decide what the Fed is going to do over the next few meetings.
Our optionality, our ambiguity, our degrees of freedom, and all the other mumbo-jumbo buttresses up against Michael Ferroli's arch call on potential GDP. That goes into R-starred. Do you have a low statistic on potential GDP? Does that give you a low R-starred, that goal that Jerome Powell says he's trying to get to?
Well, I think there's two things here. One, which is perhaps most important, is potential GDP is low, but cyclically there are a number of forces which have raised what interest rate is consistent with stabilizing inflation and stabilizing utilization rates. So I think that's what's operational for the current environment. The second point, Mike and I have both been writing about the hints that U.S. supply side performance is actually improving. We've been running 250,000 a month on labor supply this year. Productivity growth, which has been stuck in the low ones, looks like it's moving higher on an underlying basis. It's too early to get confident about this, but it does feel to us that U.S. supply side performance is actually improving here.
I know you and Bob Michael aren't on speaking terms, but just the few times where you've got to get together and dovetail your economics into Bob Michael's fixed income, which I believe is price moving against yield. Can you make a yield call here? If we get Kasman disinflation, do yields come down?
I think it's going to be a while before yields come down. If we're right, inflation is going to stay sticky here. The Fed is not going to have the room to ease anytime soon. The economy is not really at material threat of going into recession anytime soon. So I think, 4% 10-year yields, 5.5% policy rates is going to be with us for a while.
Bruce, you touched on it, and I think it's a really important aspect dimension of the Federal Reserve conversation today and into this decision and news conference, the extent to which this labour market has rebalanced. Do you think that rebalancing is close to complete then, Bruce?
No. We have a very tight labor market. We still have very elevated wage inflation. I think we're seeing good signs on the labor market that things are moving in the right direction. But whether we get all the way back to what is consistent with the Fed achieving its inflation target, I think is still not by any means determined. From my point of view, I think it's more likely that things stick at a level that's going to keep the Fed uncomfortable over the next year.
Does that mean low unemployment with elevated inflation, or higher unemployment with elevated inflation? Because one mix is a lot more toxic than the other?
I think it's most likely the unemployment rate stays below 4%. I think it's most likely that wage inflation stays at 4% or higher. I think it's most likely in that environment the Fed is not going to have the opportunity to ease. And the question is whether or not that restrictive stance over time undermines what is still a pretty healthy U.S. private sector and eventually causes an end to the expansion, or whether the supply side improvement, whether some of the other supports can carry us along here and put us on a path to a soft landing. I'm in a boil the frog scenario, which is the first one I described, but I think it's still a pretty close call here as to how the environment plays out over the next year or two.
I mean, Bruce Kasman, what's so important here is simply there was a pandemic. Are we beyond the pandemic? Are we beyond supply side studies where we're getting back to Kasman 101?
Look, I think I hope we're beyond the pandemic in terms of its impact, direct impact on economic activity. But I think there's two issues here. One, we're still in an unwind of some of the pandemic dislocations. That's what inflation coming down is about. That's what some of the normalization going on in service sectors are about. We're not quite done with it. We're starting to get closer to the end. And then we're dealing also with the reverberations of this pandemic on a more lasting basis. And a couple of them are the damage done to the supply side globally. And I also think the health of the private sector balance sheet, which is a really weird thing to say, comes out of such a bad event as a pandemic.
Bruce, let me expand on this with one thought, and you pick up on it. Can China export disinflation or a deflationary trend? What does JP Morgan see of domestic China exported out across the world?
I think China is exporting deflation and goods pricing to the rest of the world. Chinese production is picking up right now. You see import prices in Europe and the U.S. from China going down sharply. We think global industry is starting to pick up. China's benefiting from it. So I think the Chinese economy is going to be weak, but not hit the fears, I think, of a real disaster that people expect. I think global industry is picking up. I think China is going to keep a lid on global goods price inflation, as among other things, for a while, except, of course, for what we're seeing in oil.
So, Bruce, just before you go, I've got to do a little bit of housekeeping. The takeaway from this conversation, high for longer, got all of that. Can we just play with the dot plot a little bit and get out to 2024? What do you think that dot plot will look like later on this afternoon?
Well, the most important is probably 23, and it looks like you're going to have a divided committee. We're on the side of them still having the median voter with a dot, but it's a close call. I think regardless of that, and regardless of big changes in the forecast for 23, the 24 forecast is still going to have something close to 100 basis points of easing. It's still going to have a big drop in inflation. It's still going to have an aspiration that we get an unemployment rate up to 4.5% without a recession.
And you don't buy it, Bruce?
I'm skeptical. I'm not pounding the table on it, but I'm still skeptical we can heal here without more damage being done to demand.
Bruce, thank you, sir, for the update from JP Morgan. Bruce Kasman there on the outlook. The takeaway here, Tom, high for longer. There was an interesting word that Bruce just used, aspirational.
Yeah, that was absolutely brilliant. And the best part about it is John asked the correct question. I don't give a damn about the dots, folks. And thank God Farrell brought up the dots, because a lot of our audience, and particularly Global Wall Street, cares.
They care about the dots. Yeah. Patrick Armstrong, Clarimi Wealth. He joins us next. Equities up by 0.2% from London. This is Bloomberg.
Given that we have this productivity enhancing technology that is AI, that has come off the back of this transformative communications network that's the internet, and we have a fundamental shift in the way the energy system is working, so that there could be the ingredients of a pivot point of a kind that we've only seen a couple of times previously in history.
But let's ask what the driving forces will be. The world is propelled forward and has been for thousands of years by great power competition. That is the thing that drives innovation right now across the board. It is a competition which is intensifying between two superpowers, the United States and a communist-led superpower. Now, is this starting to sound familiar?
It does.
So what is really significant about this historical moment is that we are in the first inning, the early phase of Cold War II.
Right.
And that is going to drive all the things that we've talked about, and it will not necessarily drive these changes in directions that are benign. The big technological advance of Cold War I was, of course, nuclear weapons. And the arms race with nuclear weapons was an extremely dangerous one that very nearly blew the world up, particularly in 1962 at the time of the Cuban Missile Crisis. Yeah. I don't believe for a minute that we can have a Cold War II without a similar risk.
What do you have for skincare for men in their 70s that have a lot of wrinkles? I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things,
really?
But maybe it'll be a little bit beyond skincare.
Oh.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
It doesn't look like we've got a major issue with the economy at the moment. The economy's been relatively resilient.
Central banks have carved out in the last 6 to 9 months a focus on core inflation.
2024 should be a better year for earnings with the market.
We are seeing inflation coming back down towards where the Fed would like it to be.
In the end, higher for longer means there's going to be further tightening here in the real economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
The Fed decision a little bit later on this afternoon. Live from London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Bramo just stepped off. She's going to be back a little bit later. In your equity market on the S&P 500, we're positive here by 0.2%. A lift to the equity market, TK. Hours away from Chairman Powell, that press conference, and all those lovely forecasts you look forward to, including that dot plot.
The dot plot. Can't wait to see that, Jewel. What I'm going to look at is the dot plot that is the voice of the Standard & Poor's 500. John, rounded up 4,500. It's showing a resiliency. It's an equity market. Big amount of money that's saying they believe in the Fed, they're going to get the job done, and they need to be in equities. And you wonder at the margin, like Savita Subramanian
She's
today,
on board.
Going on board, and others, Ben Laidler with that optimism, Anastasia Amoroso with her optimism, etc. That's the Fed story today. The stock market likes what it sees.
Savita goes to 4,600 from 4,300 over at Bank of America. I think we should talk about Max Kettner earlier on this week,
Yes.
Tom, just yesterday. Max saying people are too focused on what's going wrong. He wants to focus on what could go right next year relative to very downbeat expectations around China and around Europe.
And we just heard from Bruce Kasman some enthusiasm there about China. You know, he gave a typical J.P. Morgan, hedged it out. He's going to blame it on Feroli if he's wrong. We understand that. But the bottom line is there's an enthusiasm here away from country to country domestic politics. We'll talk the UK politics on ESG here down the road. We don't need to do it now. But it's a ferment.
Sure.
It's a positive ferment here into these meetings.
If you are just joining us on Bloomberg Radio and you missed the conversation with Bruce Kasman over at JP Morgan, it's worth going back over. Bruce ultimately is on the high for longer page. How he referenced the dot plot and the projections over at the Federal Reserve, he used this word aspirational. He said it was aspirational, Tom, to look out next year to expect inflation to come in without too much damage to the labour market. Yeah. That's a man who does not believe that we can get inflation back to target, down towards 2%, without real pain in the labour market? Have we made progress on that so-called rebalancing in the labour market? Yes. Have we made sufficient progress? Bruce says no.
We've lost perspective of a fully employed America. The answer is we're at 4%. Bruce Kasman said he doesn't think we go above 4%. I have no wisdom on that other than to say that's the oddity of the cycle, and that's what the Fed has to deal with, is their dual mandate has become a single mandate. They're very ECB-ish.
Very
Like
ECB-ish.
they're ECB-ish, looking at rates, inflation. Oh yeah, jobs, that's fine.
ECB last week, tomorrow the Bank of England, Friday the BOJ. Let's get to the price action. Your equity market on the S&P 500 shaping up as follows on the S&P. We are positive here by 0.2%. Yields are coming in just a little bit, down about 2 basis points on a 10-year, 434.07. In foreign exchange, the euro 107.03, sterling weaker against the dollar 123.64. A soft inflation print out of the UK that we can discuss, Tom, a little bit later.
Yeah, I would do that a little bit later. But the answer to me, as we dive into the brief here, John, is there's disinflationary tendencies out there. People are like, I don't really care about it. They're rationalizing disinflation, and it's in the air. Paul Krugman's essay in the New York Times, I think, really captured it.
Let's get to the morning brief for you. Coming up a little bit later, 2 p.m. Eastern Time.
We'll be here.
FOMC decision followed by Fed Chair Jay Powell giving that news conference. Plenty of questions, I'm sure, about the projections they'll release in the SCP a little bit later. 2 speeches to look out for. 2 speakers off Wall Street. The Bank of America CFO, Alistair Borthwick, speaks at 7:15 Eastern Time, so about 10 minutes from now, at the Bank of America Financial CEO Conference. And this one here, JP Morgan CEO Jamie Dimon speaks at the Detroit Economic Club at 1 p.m. Given the tension of this labor market, Tom, is in Detroit right now.
Secretary Dimon will be there. and we didn't talk about this in the last hour, but we're going to stop the show right now and talk about this. There are many people out there that wish that Mr. Dimon would migrate, as Mellon did, down to Washington to be bankerly. Can you do that in this time and this day?
Treasury Secretary?
Yeah, I don't know. But he's there in the crucible today of the American labor movement. It's extremely well taken.
Shall we reflect on what UAW said yesterday?
We should. I don't know if they'll be at the lunch,
Every
but hey.
fibre of our union is being poured into fighting the billionaire class and an economy that enriches people like Donald Trump at the expense of workers.
I'm glad you brought that up. That was quite a statement.
It was a strong and powerful one, yeah.
And that sets up this tension of Wall Street, Main Street that Speaker Pelosi highlighted, many others as well. And I just don't think it's a small matter that a Fortress Dimon wanders into Detroit today to talk about the labor markets. What else do we have?
AMH joining us in about 10 minutes on part of that story. Just your earnings after the bell, a little bit later after the market close. We'll get some earnings from FedEx. Look out for that a little bit later on. Joining us around the table here in London, the conversations continue. Patrick Armstrong, CIO of Plurimi Wealth. Patrick, good to see you.
Good to see you.
Are things good or just terrible? Because I can't decide based on our conversations so far.
Normal. Things are pretty normal.
No change.
Everything feels so different to how it was, but we've got inflation on a track down to something that's going to be sub 3% next year. I don't think it's going to fall to the Fed's mandate. I don't think they want it to. You've got economic growth that's potential in the United States. Who would have thought that? You're probably going to grow 2% for the U.S. economy this year. That's probably the long-term potential. Interest rates at 5% on the 2-year. It's pretty normal. Doesn't seem normal over recent years, but we're in an environment where things are pretty normal.
We're going back to the old normal.
I think we are going back to the old normal. I think inflation is going to prove to be persistent, sticky, with intermittent spikes, just because the big picture issues are populism and protectionism from governments, and that's just by its nature inflationary. You've got unions coming back like the 70s maybe a little bit. You've got job seekers having some power. That's inflationary. But you've got disinflationary forces coming from China. And you've got Fed policy at a point where it is restrictive. So all of those things, normal.
Your charm is your truly cross-asset. At the margin, how are you changing your cross-asset allocation into the fourth quarter?
So what we've done over the summer months is we've marginally reduced our equities that have just kept drifting to overweight. We wanted to have neutral weight, but just as equities have performed so well, they kept moving overweight. We've moved marginally underweight now. Not so much that we're worried about equities, that we're getting pretty compelling returns on tips right now, that you're getting a 2% real yield. And like I said, inflations are still a risk in the long term, but I'm getting the duration there. If we do fall into a recession, we'll see lower yields on conventionals and tips will benefit
So
from
talk
that.
to our audience on radio and television here, and particularly across America. How does Patrick Armstrong utilize the 10-year inflation-adjusted yield or the 5-year inflation-adjusted yield? How do you use that as a tool to have confidence in market allocation?
Well, the 10-year break-even is 2.3%, and my view is we're going to have persistent above Fed target inflation, so I want to be hedged against that. I'm happy to get a real yield of 2%. You put your capital at risk to preserve capital as a starting point and grow the purchasing power of that over time. The tip provides that to you right now in the 10-year, so I like duration there. But you're being compensated with really high yields on, we talked about Diamond.
Yeah.
JP Morgan bonds, I'm getting 6% on a 2-year, and that's almost a
That's a Chris Whalen moment.
Yeah.
He's channeling Chris Whalen, those JP Morgan preferreds, Whalen would say.
Should we do single names? A lot of people at the start of the year were getting jacked up on LVMH. The
I was one
portfolios.
of them.
You were too. You backed away.
Yeah.
You stepped away. The poster chart of the European market now is Novo Nordisk. Where are you on that?
That's my biggest stock right now. And again, it's come from drifting. The pandemic used to be COVID. The pandemic's obesity and diabetes in the West. And Novo Nordisk and Eli Lilly, they don't have monopoly positions, but they got the dominant share here, growing earnings.
If luxury come in enough off China gloom, Bernstein, I believe, was out with a note overnight saying we've got some ratios of luxury back to 2008. Is it pulled back enough for Patrick Armstrong?
No, almost. So I sold LVMH in March. It was at 32 times forecast earnings. We're now in the mid-20s. I bought it in October the previous year when it was at 21 times. That's a small premium to the market multiple. That's where I'd like to buy. So I think it's fair.
Folks, right there, we don't do much equity chat because, you know, who cares? The answer is what you just heard there from Patrick Armstrong is a clinic on how you bracket a beloved dominant stock.
I was with you. We were talking about it when you backed out of LVMH. You kept Hermes, though.
We did, yes.
Why was that?
Well, I didn't want to move against what I still think is the dominant trend is the spending power of high net worth individuals and also the immunity to input prices. Rishwan talked about inflation hurting spending power of people, but the input prices are things that are hurting mass market retailers, and it doesn't impact the high-end luxury.
So what's a distinctive feature of the Dumas family at Hermes? What are they doing differently? Bloomberg Intelligence, Deborah Aitken is just brilliant on this, and she singles out a few of these names. What is the Hermes model that makes them different from 47 other luxury brands?
The leather goods part of it is incredible. The margins, the growth they get there, and people pay up for that. And there's just waiting lines of queues for that side of things. But it's their brand management, the Hermes scarves and ties, and the leather goods. It's all, yeah.
We touched on it briefly. Let's finish there. Novo Nordisk. We're already up 40% this year. The stock's been climbing for 5 consecutive years. Can you spend just a little bit of time, a couple of minutes, just outlining how big this opportunity actually is?
Well, it was a vanity-type drug, their weight loss. It is a vanity product, basically, that people in Europe, America, and China... They spent the money to look good, feel good, but what they found is the heart disease and the benefits on that, it may become an insurable product as well. So that just expands the potential market where you're not just getting vanity uses, but health uses, which may be insurable as well. So heart and stroke disease, it does expand the market a lot because it's an expensive product that a lot of people can afford. It may move much more mass market because of that.
The run on this stock, Tom, has been phenomenal. Absolutely phenomenal. I'm not sure where we are right now versus LVMH, but certainly at one point earlier this year, it was bigger than LVMH, right?
I think it's bigger right now. They're basically the same market caps.
Can there be European exceptionalism without technology? The way we trumpet Apple and the other 18 states.
Well, Novo Nordisk, I think, is a form of US exceptionalism.
Yeah,
the wrong kind of US exceptionalism, right?
Yeah.
It's buoyant, to say the least.
It's exceptionalism is very clear in U.S. in technology. Europe can compete in healthcare. It's shown no ability to.
Quickly, are you buying big oil? You buying big oil here with $100 a barrel?
Basically, there's going to be more oil consumed in the next 3 months. We've already had more oil consumed today.
Single best buy. Come on, Patrick Armstrong, single best buy, big oil.
EOG, I like, rather than the integrated exploration production.
Patrick, good to see you. Patrick Armstrong of Plurimi Wealth. If you are just tuning in, welcome to the program on the S&P 500 right now. We are positive. We're positive by 0.2%. Outside of the equity market and the bond market, yields are a little bit lower by a couple of basis points at 434. Lots to talk about in fixed income. We'll do that with Alberto Gallo of Andromeda. capital management. That's going to take place a little bit later on this morning. TK, some amazing calls there from Patrick. Novo Nordisk, the European healthcare company at the epicenter of the US health epidemic right now.
Yeah, he's been so on. I mean, the thing about Patrick that's great is a cross-asset view that he takes all the time. And, you know, you mentioned this, I think, yesterday, the day before, John. Everybody's got to recalibrate where the Q4 outlook, September 30 ending Q3, is maybe as important as the year-end outlook this time around.
Well, I think this time around for the Federal Reserve, they're marking to market. Growth has just been so much better than we thought it would be. We already know that. The Fed's just got to update their forecast to take account for that, Tom, into year-end.
You know where I am in the parlor game. I just and thank you for bringing up the dots. Let's review this right now. We've heard this morning that the 23 dot has value. There's a 24 dot. Is there a Draghi 25 dot? Are they going to go up to 25?
So let's just sit on the dots. We've got a couple of seconds. So for 2023, the median dot is expected to still show one hike this year. Might come in, we'll see if it does. 2024 has some easing baked in, but it's what's behind the easing that I think is really important. Is it a collapsing growth that leads to these rate cut calls, or is it just this idea that inflation comes in, the Fed's focused on real rates and wants to maintain that restrictiveness? They're two very different things, Tom.
I think looking out that far post-pandemic, as I mentioned to Dr. Kasman, can you look out that far given post-COVID supply and demand dynamics? I don't think you can.
Up next on this program, we'll look out to Detroit, the tension between UAW and the Big Three, and get the latest from the UN General Assembly. Bloomberg's Anne-Marie, next from New York.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. Surveillance is live from London for the Bloomberg Global Credit Forum. After a decade of cheap credit, Tom, John, and Lisa address the risks in today's debt markets and the opportunities ahead. Tune in at 10 a.m. Eastern, 3 p.m. London time for the special episode featuring an interview with Apollo's Jim Zelter.
I got my hands full.
Only on Bloomberg. Context changes everything.
When it comes to China, I want to be clear and consistent. We seek to responsibly manage the competition between our countries. We are for de-risking, not decoupling with China. We will push back on aggression and intimidation and defend the rules of the road.
It's an interesting word that President Biden used addressing the United Nations General Assembly just yesterday. He said we are de-risking, not decoupling. Curious because the Treasury Secretary went to China, Tom, and used the word diversifying. So which one is it? What's the message they want to send to China?
Making it up.
Do you want to say de-risking? Because de-risking to me sounds pretty loaded. Are you saying China's the risk?
I think the political football here is substantial, and I'm going to say it's policy made up as you go. I think they're literally making it up as you go based on what China's doing and what the dialogue is. Very importantly, the meeting, Emery Horton talked about the meeting in Malta. Yep. Malta's an island in the Mediterranean. I don't know if you knew that. And
I'm well aware.
They had a meeting there of worthies to get Biden and Xi together. And that would be important. I mean, that's what diplomacy is about.
If we can make that happen, maybe a little bit later on this year. If you are just joining us, welcome. Federal Reserve decision a little bit later on this afternoon. No change to rates expected. Big focus on the forecast. Growth, inflation, the dot plot. That news conference won't be a snooze fest. A sleepy start to the week so far, though, in the equity market. Futures just a little bit positive here by about 0.2% on the S&P. Yields a little bit lower by 2 basis points on a 10-year. 434, Tom. 07.
It is a busy week in New York and the island of Manhattan. It is traffic status. Pharaoh had a tantrum and said, we're going to London during the UN so we can miss it all. Emery Horton doesn't have that advantage. She is in the heart of Manhattan with the United Nations meetings. A very important interview yesterday with the leadership of Poland, of course, so adjacent to what's going on in Ukraine. But this morning here in London, Anne-Marie, I think we've ignored, I've been wrong on this with the Fed Day and all, we've ignored Detroit and the UAW. Who does the president need to speak to today? When he gets up and dials 1-800-DETROIT, who does the president want to talk to on UAW strikes?
Well, the White House has been talking to everyone, right? They're going to be speaking to the UAW president, Sean Fain, but they're also talking to the executives of the big three auto workers. This has taken on more importance, this story, because Friday at 10 a.m., we will hear from Sean Fain. He's going to be holding a Facebook Live, and that's really this new date for the negotiations to look forward to try to strike a deal, or he's going to announce more walkouts at more plants. The administration is in a very difficult position at the moment. Not only is the former president going to be heading to Detroit the day of the Republican debate, so really stealing the show from everyone, but the administration said they would be sending Julie Su, the acting labor secretary, as well as Gene Sperling, a White House advisor, who is the individual who's the liaison between the White House as well as the UAW and the big three. And those two individuals have yet to show up to Detroit. And I was reading a political article yesterday, a Democratic strategist said Trump scooped us. And at this point, it's not even about sending that. Now they look like, are they going to be following Trump's tail by sending someone, a high-profile person? But the bigger issue, I think, is the fact that they said they were going to be sending Julie Su and Gene Sperling, and that has yet to happen.
Maybe it's a silliness and symbolism of the Detroit leaders age ago driving to Washington to do whatever they did. Maybe the president needs to get in his Corvette and head up to Detroit. With that said, there's percolation in news. There was a union settlement in Canada overnight. There's also the idea that there's a tangential knock-on effects of the strike where the automakers are shutting down other factories. Do those kind of tea leaves, do they have any impact on the debate?
I'm sure they do. I'm sure Sean Fain sees all of this. One, the extraction workers were able to get in Canada, but also the fact that this could be impacting the knock-on effect, the supply chain effect that this is going to have on these communities. So they're obviously going to be taking stock of all of this, but he wants to use this moment to extract as much leverage as he can from the big three auto companies, and the big three are saying they're still at the negotiating table.
Where's the leverage, John? 32-hour work week? Help me here.
Pay at the moment. It looks like they can get more out of them on that side.
That's it.
Stellantis has certainly come up. Anne-Marie, just to expand on the political conversation, you get the sense from UAW that they are sick of politicians playing politics with their cause. This is what you heard with the UAW president yesterday, and I'll share this quote with our audience, and I'd love your take on it, AMH. Every fiber of our union is being poured into fighting the billionaire class and an economy that enriches people like Donald Trump at the expense of workers. Is the former president still trying to go to Detroit on September 27?
The reports are that he is going to go there, and I think there's two key things we need to look at through the political lens. One is the fact that Trump won Michigan in 2016, a state that the Republicans have been unable to flip since the late 1980s. And a lot of this, if you look at, was potentially some of these rank-and-file members, not the UAW leadership. They would not endorse him. They're not going to endorse him in this round either. But then Trump lost it in 2020. This, I don't need to tell you, is a must-win state for Democrats. That's the first thing. I would also bring up the point that a lot of union leaders remember what Trump said in 2015 when he was campaigning. Remember when a number of automakers were talking about building facilities in Mexico, especially Ford, putting billions of dollars in Mexico. Trump said, why would you do that? Just move to a better U.S. state where you don't have labor, where you don't have union leadership. Get cheap labor, and then those people will realize they've lost their jobs, and then you can go back to your old factories.
Right.
And this deeply annoyed the UAW leadership, who said, philosophically, what is the difference of this? We are not being respected as a middle class, a working class. And those memories, I would say, they are still front and center for a lot of these individuals when it comes to the former president.
Anne-Marie, I got a segue here to your important conversation today. And as the gentleman from Poland was speaking in Polish, for me it was lost in translation, except boy, was there a tension in that conversation. Describe the tension that Poland faces at this moment.
Well, listen, Andrzej Duda has really been lifted by Putin's invasion of Ukraine to this global statesman almost. Remember in the start of the war, everyone was going into Ukraine, they still are, through Poland. He was this conduit between Kyiv and Western leaders, and he had this very close relationship with President Zelensky. He still does, but there is a ton of friction right now in this relationship that is playing out in the media. And what President Duda said to me is that his only plea right now would say, please stop doing this in the media, really taking a swipe there at President Volodymyr Zelensky. And some of the big friction comes down to the fact that we're not seeing a lot of Ukrainian grain moving out of the Black Sea corridor, so it's going into Europe. And Poland is saying, and they refuse some of these tariffs at first to make sure they can help the Ukrainian farmers, but now what he's saying is that our farmers are not making the money they need to be making because there's too much cheap Ukrainian grain here. Zelensky wants to take this to the WTO, so they're having this spat about Ukrainian grain. At the same time, there's also debate within the Polish government about the financial aid from the Polish government to Ukrainian refugees who are settling in Poland. Just like you're seeing here in America, people are saying, we are dealing with high inflation, we are dealing with higher costs of living. You're hearing this kind of conversation around the globe, whether it's Germany, whether it's Poland, and that is why you're seeing a little bit of war fatigue.
Anne-Marie, this is a wartime president facing a unique situation that these other leaders do not face. I think we have to acknowledge that.
Yes.
He's been celebrated by the West for the way he's spoken about the needs of his own country. I was listening to Speaker McCarthy yesterday. Do you get the sense that a lot of people, perhaps in Washington, of a certain politics are becoming frustrated with Zelensky's approach in the media?
I think some of them think that the approach in the media is a bit combative. And we saw that on display yesterday with the Polish president. He said, wishes, stop playing this out in the media. We've been strong supporters of Ukraine. Speaker McCarthy said yesterday that he just has a lot of questions for President Zelensky about where the U.S. taxpayer dollars are going. And remember, the last time Zelensky was in Washington, he gave this joint address. This is just going to be a huddle between lawmakers.
MH, thank you. The latest in New York, fantastic work of the UN General Assembly, fantastic collection of interviews over the last couple of days. The NATO Secretary General and the leader of Poland. Equities right now positive by 0.2%. Coming up shortly, the brilliant Deborah Cunningham of Federated Hermes. That's next. This is Bloomberg.
banking is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody uses my knife, I want them to say, damn! Golly, this is a badass knife.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Equities positive here by 0.2% on the S&P 500. On the NASDAQ, slightly elevated. Some outperformance on a Russell. The small caps doing better than a good, up by 0.4% on the Russell this morning. We're calling that a surge, TK.
Surge.
Is that how sleepy things have been?
Has been
0.4%. It's a surge.
I'm like, when does small cap calm down and actually put it on? And the answer is there's so much angst out there, small cap really can't get it going.
Jill Carey-Hall of Bank of America has been good on this as well. I want to turn to the bond market briefly as well. 2-year, 10-year, 30-year. We've got a rally in the UK. 2-year yields in the UK down by more than 10 basis points. A soft inflation print. Hot inflation print in Canada yesterday, lighting a fuse under this bond market. Yields shooting higher. New cycle highs on a 10-year. We're back away from it. We're down about a basis point on a 10-year to 434.47. But Tom, looking at that, you'd have to say we really have started to internalize high for longer. When you see
I
2-year
strongly agree with
north
that.
of 5%.
We are beginning to internalize the yield structures of another time and place, think 2005, 2006, and many of the different measurements we look like. You draw a horizontal line, John, and it takes you back to 08, 07, dare I say even to before August of 2007. What I end up looking at every morning, folks, is the 10-year real yield. And it's sort of in betweeny, 1.96 maybe is where we are right now in USGGT 10.
Oh, that's the ticker on the Bloomberg. Nice.
But the answer is that's what I'm going to look at as we go through the press conference today to see what the real yield does.
If you look at USGG2YR, which is the nominal yield.
Good.
Thank you. Thank you. That's just north of 5%. 430s on a 10-year, 440s on a 30-year.
People just drove off the road on Bloomberg Radio.
I mentioned that rally in the gilt market for the UK bond curve. Yields down almost across the curve, particularly at the front end. This move in sterling weaker off the back of that. The pound against the US dollar, 123.65. We're negative by 0.2%. Tom, just looking at the inflation data out of the UK. So the good news is that it's no longer the 7% we expected. The bad news is this number still comes in at 6.7% year over year. And core, Tom, is down from 6.4, great, but it's still 6.3. So there's still an inflation problem in the UK, and we're still talking up wage growth that's pushing 8% in the United Kingdom. So the pressure's still on this Bank of England. Goldman's dropped his call for rate hikes for tomorrow, and they think over at Goldman, based off what we're hearing from the London desk this morning, is that the Bank of England is done. This is the peak rate. They're going to stay there. Question I've got, Tom, if you're going to stay there, how long for? With CPI where it is, with wage growth where it is, how long have they got to stay at these levels for?
Essentially it's a boom economy that everybody's been wrong on. There's been a lot of gloom out there, and it's its own idiosyncratic story here. And part of it, to me, dovetails off Brexit and the relationship with Europe. And, frankly, I think the United Kingdom needs a strong Europe, and it's not there right now.
It isn't at all, based on what we heard from President Lagarde of the ECB last week. Nothing strong about that news conference.
I read Phil Serafino's stuff
last week.
Today.
Phil's great. 107.01 on the euro at the moment. That currency pair positive by 0.2%. Under surveillance this morning, the Fed rate decision due out 2 p.m. this afternoon. A pause is widely expected But a bit more debate around what this Bank of England will do tomorrow after UK inflation unexpectedly fell. Goldman altering their call, writing this: with today's data, 2 out of the 3 indicators that the Monetary Policy Committee has set out to monitor inflation persistence have now shown notably more progress than anticipated since the August meeting. We now expect the MPC to keep rates unchanged. Once you've got through the Bank of England, Tom, it's on to the BOJ on Friday.
Catherine Mann's going to push against that. She is American, Brandeis University, of course, her wonderful work at Citigroup. She is on the MPC, the Bank of England. And I would suggest that Dr. Mann would say, let's watch the data. And to your point on change in vector versus level, to everyone in the United Kingdom, it's that level above 6% that's intolerable.
I'm with you. That split on the MPC, let's see what that split looks like.
Yeah, they never dissent. I mean, they dissent.
We get a dissent on Threadneedle. We don't get any dissent over at the
Fed is,
Federal Reserve.
It's a snooze fest.
Singing off the same hymn sheet, apparently. Oil dipping this morning after a soaring summer rally. Saw prices rise more than 20% over the past 3 months. Crude touching 10-month highs, approaching $100 a barrel in the last 24 hours on the back of supply cuts from OPEC+, but falling back below 94 ahead of this afternoon's Fed meeting. 93.75 after a sniff, Tom, of 95
Yeah,
on
I
Brent.
think, a bit of the story's missed here. This has to do, again, with oil in the Caspian Sea. This has to do with Azerbaijan. I'm not going to pretend I'm an expert on it, but it is the ageless battle of those Caspian states, Georgia, Nagorno-Karabakh, and the rest. Amory Horton's way better. Maria Tadeo's expert on this. But there was a little bit of war tone yesterday, which got us up to Saudi 97. It got us up to 95 on Brent crude. And there seems to be not peace in the air, but maybe the tensions pulled back off the Caspian Sea today.
Fantastic to catch up with Javier Blas of Bloomberg a little bit earlier today, who basically said it's all about price for Saudis now. And they've got a higher tolerance for economic stress abroad. They want prices near 100. His opinion, maybe that resonates, but that's his view.
He walks in the building and the foundation shakes. I mean, he's huge.
He's a heavyweight.
He's a heavyweight.
A heavyweight in the world of commodities. I want to finish on this, an update on UAW. United Auto Workers weighing in on expanding their strikes as negotiations with Detroit's automakers continue. The union is set to hold a Facebook Live event at 10 a.m. Friday, where it's expected they will discuss whether more plants will join the strike. So like we had last week, we have a deadline. It's noon Eastern on Friday, TK, for further progress. If we don't have that sign of progress, ultimately 2 hours before that, we're going to get some kind of Facebook Live event, some kind of news conference from UAW, which may signal a broadening, a deepening of these strikes.
Walter Reuther would have done it this way. I mean, it's not your father or your grandfather's strike of union members. Are these companies the same companies and acting in the same process as they did in 1958 or the tensions of the 70s? I don't think we know yet.
So you can answer that question. I'll answer this one. UAW certainly changed their approach based on the assessment I've seen.
Absolutely.
This isn't targeting one. This is targeting all 3 simultaneously at the same time.
And they know, they're sophisticated enough to know the knock-on effect. One of the makers came out and said, if you're going to take out my Bronco factory or you're going to take out Michigan Truck, well, then you got to go out and there's this knock-on effect of 14 other factories. And literally in the next 48 hours.
And tons of other companies down the supply chain.
Yeah.
Tom, who are going to be hit by this as well. It's not just Detroit's big 3, that's for sure. It's
continue to follow that
companies.
Great team in Detroit leading that coverage, and we'll catch up with them through the day, this Fed day, I should say. Right now, this is an important conversation, and please lean forward as you figure out what to do with your short-term money. Deborah Cunningham, a fancy title, Global Liquidity Markets CIO. It federated, essentially they invented the money market fund, and with Federated Hermes, she joins us this morning. Deborah, what do you see in money market fund flows? What are we doing as we migrate from banks to a higher yield money market funds?
Well, certainly we've seen it in, full force over the course of the last 6 months. And it's really, it began back in March of 2022 when the Fed increased rates for the first time. You've basically got in its, sort of most inclusive form, money market funds with assets greater than $6 trillion now. So, if you kind of go back to the, days post-Lehman, this is 3 to 4 times what the market was at that point, and certainly what it was in the zero interest rate environment. So at 5+%, money market funds, especially for the retail investor, offer great returns at this point.
Deborah, I look at the Keefe, Bruyette, and Woods Bank Index, the so-called BKX, and it's sobering to say the least. What is a federated belief? And I know you're doing rates, it's maybe outside your remit, but how do you look through the Cunningham prism at what our beleaguered regional banks are doing?
You know, Tom, we do a lot of business with the banking sector from an investment perspective as well as from a counterpart standpoint. So we're always looking at the health of banks and, you know, what their activity in the market might be looking like. And at this point, the largest and what I'll call regional and kind of super regional banks seem to be quite healthy. Even, you know, in the context of the commercial real estate portfolio, there seems to be, a pretty good mix of what I would call the better types of commercial real estate within those larger banks. Now, some of the much more, much smaller, very concentrated regionally and geographically smaller banks, that profile is not the same. So I think what you might end up seeing through this next cycle from a banking perspective is a little bit more consolidation of some of those smaller banks into some of those larger, sort of regionals and super regionals in order to keep the market in overall, in an overall healthy sense through, what might be the next downturn from an economic standpoint.
Deborah, we'd love your view on the Federal Reserve a little bit later this afternoon. Andrew Honhorst, the Citi, just published moments ago. He had this to say: the Fed will skip hiking rates at 2 p.m., but dots will likely signal one further 25 basis point hike in 23. The median dot for 2024, they think over at Citi is at risk of rising 25 basis points. It's all incremental stuff, Deborah. For you and the team, when you get those projections a little bit later, what are you and the team looking for?
I think definitely a skip, not a pause. And I do think, they're going to emphasize that November continues to be a live meeting. I would not be surprised to see the economic projections and the medium dot to go up by 25 basis points more. Ultimately, although inflation, is lower than it was 3 months ago when these numbers came out, it's still firm. And in the most recent information, CPI, PPI, PCE, retail sales, they're showing the consumer being very strong and some of those numbers playing through to mild increases in those numbers. So we would not be surprised. I agree with you that, the market maybe is finally reconciling with higher for longer, but I'm not sure we've priced in what we think is a real live meeting in November at this point.
Hollenhorst cites three things, Deborah: oil prices, ongoing UAW strike, third thing, renewed advance in house prices. How do you think the chairman navigates those three issues?
I think all of them have to be addressed. I mean, they impact the consumer. And granted, the consumer has, from a wage inflation standpoint, also been improving from, a household net worth standpoint. But they are paying higher energy costs, they're paying higher food costs, they're paying higher shelter costs, and all of that comes out of their discretionary spending. So I think as the engine of growth to keep this economy, sort of above water, there's a little bit of a pullback on that from the consumer standpoint at this time. So, the chairman can't ignore that, but by the same token, are they going to be able to, marginalize and not raise interest rates by another 25 basis points? I think it's going to be a tough decision, but one that will, make the November meeting a little bit more, sort of in the limelight and focus for interest rates in the next several months.
Your view, you're not alone. Mike Gapen, Bank of America, Andrew Honhorst, the Citi, on the same page. Deborah, thank you. Deborah Cunningham there, Federated Hermes, the Federated Hermes view on the Federal Reserve. If you are just tuning in, welcome to the program. The S&P 500 right now is just about positive by 0.25%. Outside of that, into the bond market, yields are a little bit lower by a single basis point at 434.47. I mentioned that research from Andrew Honhorst, the chief US economist over at Citi, who had this to say: Chair Powell acknowledged recently softer inflation and lower job openings, but emphasize vigilance, he says, given remaining upside risk to inflation on those three issues that I mentioned, including the rise in oil prices, ongoing UAW strike, third one, renewed advance in house prices. Tom, of those three, what are you focused on? Strike, commodities, house prices?
I'm not focused on the political story. I don't think the Fed really does a mandate off of that. Maybe Greenspan would have a million years ago. I don't see it with Powell. I do see it with the house prices. I think they'll watch it very carefully. And to Paul Krugman's idea of plain vanilla inflation and rents are shocking. Yeah, I guess they're down in the West. But the answer to me is you got to get from the soup, the alphabet soup of inflation indicators Deborah Cunningham just brought up, to what our viewers and listeners are feeling. Powell viscerally knows that, and he can't go accommodative until he's got more of a vector in place. It's not in place yet.
So acknowledge progress without signaling victory.
Yeah, exactly.
Ultimately,
he's not going to declare victory as Governor Bailey.
I don't think Governor Bailey can declare victory.
No, but he alluded to it a couple meetings ago, and none of these people are anywhere near this. It goes back to what Wells Fargo said about the last mile. We're not in the last mile. We're like on the last time zone. We're not there yet.
Sarah House was right. That last mile is going to be tough. Coming up next, the treat here in London. Kathy Wood of ARK Invest. That conversation coming up shortly. Live from the city. This is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
I think tech still has a bit of room to go in the next couple of weeks. There is probably a window around Q4 where I'd be moving more towards really the value side of things, right? Tactically, right? If we get that bump in inflation, particularly in the US a bit higher, you know, you want to probably prefer then for a couple of months things like banks or energy over tech. But for now, I think energy still has, or tech still has a way to go.
Based on what we heard from Max Kettner, the Chief Multi-Asset Strategist over at HSBC, it feels like Goldilocks forever for Max, at least Goldilocks for now. Constructive on risk assets. If you're just tuning in, welcome. Equity's doing okay, positive this morning by 0.2% on the S&P 500. Going into this Fed decision, cycle highs on a 10-year yield in the last 24 hours. Backing away from that just a little bit, down a basis point on a 10-year, Tom. 434.67 on a 2-year, still dancing in and around 5%.
I'm going to look at the real yield. The oil pullback, oil's been front and center this week, but into these 3 meetings, I've got to look at inflation-adjusted yields. Patrick Armstrong, I think, was very articulate about that. That's where he is. That's where he's finding protection. But to see what the real yield does off the chit-chat today, and I agree with what we've heard on to November and, frankly, a focus to December as well with the Fed.
The risk of one more hike. Andrew Hollenhorst, Citi, Matt Gapen, BofA, Deborah Cunningham there. Same thing.
Yeah, there's a lot of cross currents here. We'll have this for you this afternoon. Remind me what we're doing, John. We're at 1:30. We're starting
Eastern time, so 6:30 London time. We'll start the Fed special.
We'll
get the decision
hour.
30 minutes
like
later.
This. That's good.
And then we'll beat the drum into the news conference 30 minutes after that.
Into the news conference as well. And we'll be with you tomorrow, of course, for Bank of England. And who's on Friday?
BOJ.
BOJ. And that'll be interesting for Mr. Ueda. is well. We welcome all of you worldwide on Bloomberg Radio and Bloomberg Television to a conversation of great anticipation. Cathie Wood came out of USC a long time ago, put out a shingle with the Lovelace family at Capital Group, and then built an investment career quite different from others, not so much based on the long-term solidity of a given portfolio, but capturing the trend, going up large, and sometimes going down large. She holds court on the Ark. Noah's Ark is where she is right now. I want to know, with all you've been through the last number of years, are you going to shift to a more long-term strategy? I look at Morningstar, 1 year, 3 year, 5 year, your bottom quartile, but your claim is more short-term. With your new ETF effort and with what you're doing with ARK, are you going to be still on trend, or do you invest more for long-term?
We've always invested for the long term. And what interrupted what was a very nice move up in innovation stocks, especially disruptive innovation, was a massive increase in interest rates, the likes of which we have never seen.
Of course.
24-fold increase. So all long duration assets, especially in 2022, were destroyed, including bonds, which are usually a flight to safety. They had their worst year last year since the 1700s. There's no way in that environment that our strategy would have done well. But I do think that what's happening this year is that the market is starting to look over the Fed's moves, whether there's one more or not, into falling interest rates. You know, we started underperforming in 21 just with the anticipation of rising rates, and even more so in 22.
So how are you going to change? I want to know how you're going to change the sobering quarters you've been through. What is the new Cathie Wood approach to macroeconomics, frankly, pandemic economics, intruding on your belief in innovation?
If anything, innovation gains traction during tough times. And if you look at how the reason our portfolios are outperforming this year is, it is because they are gaining share in what is becoming a difficult environment, right? And so one by one, we're going to earn our way back, and it's all about revenue growth, margin expansion.
In the Wall Street Journal, they do a fabulous thing with old farts like me, and it's people with over $5 million, and they believed in Cathie Wood. To a person, those retirees bought innovation, they bought tech, they bought Apple, and they didn't listen to financial TV or radio. Can you do the Cathie Wood approach for 1, 3, 5 years, given the volatility you've seen?
Yes, I think we're on the other side of that massive interest rate increase, which did destroy a lot of performance. That's the most important thing. And we are ready for prime time. Many people are concerned about our kind of strategy, and the company we just acquired, Rises, because in Europe, in London here, for all of Europe and UK, they're focused on global megatrends as well. And, you know, interest rates hurt everyone in that space. If we are right, and rates are going to come down at some point in the next year, you know, the market is a discounting mechanism, then I think that the muscle memory that hurt our strategy, and it all has everything to do with the tech and telecom bust, and people thinking, oh my gosh, are we here again? No. What happened during the 20 years that ended in the tech and telecom bubble is the seeds for what is happening now were planted.
Yeah. And this, John, is really important, and that the profitability stream down the income statement of new tech is very different than 2000 tech.
Let's talk about EVs.
Yes.
And not just Tesla.
Yes.
Is it good news for Tesla what's happening in Detroit right now?
Yes, because if there's a strike, of course, there will be more production shortfalls. You know, I think that there's just now the supply chain has freed up, so unfortunately we'll have all kinds of questions about that. But you know, I don't think it has anything really to do with the strike. It has everything to do with a consumer preference shift towards better vehicles, electric, that are falling in price. Tesla is leading that price decline simply by passing cost declines on to its customers. So I think that's what's good for Tesla.
The complaint we hear is that people can't afford these vehicles. What we're seeing in the news
changing.
in the UK, as you can see, Rishi Sunak is pushing back targets to get rid of all of these internal combustion engines to 2035 from 2030. Are we being unrealistic about this transition and how difficult this is going to be?
No, we do not think so. We actually, the total cost of ownership, now this is in the United States, it's a little bit different here, but the total cost of ownership of an electric vehicle fell below that of a gas-powered vehicle about 2 to 3 years ago. Soon, sticker prices.
Does that include insurance?
Yes, includes insurance. Yes, as I said, local differences, but yes, in the United States, that does include insurance. And in fact, Tesla is so sure that its cars will have fewer accidents and fewer fatalities that it's willing to provide insurance. So yes, that does include everything, all in.
You were at USC, you didn't get a B. Laffer called up Robert Kirby at Capital Group and said, just shut up and hire her. So you walk into Capital Group, which is the land of an R-squared and 98 Washington Mutual Fund Investment Company of America. Everything is completely diversified out. You're the polar extreme. They threw you out. You almost fell into the Pacific Ocean. They were so upset with you. So you go out and you say, I'm not going tight R-squared to SPX. I'm going out and do my own thing.
Yes.
People have prospered off of innovation and technology. How does that continue in America? Can you be less diversified and win 5 years out?
Well, you mentioned Capital Group, and that is where I did start my career. And that is where I saw tremendous research and a long-term time horizon. So really what we're doing with ARC is just going back to the future. My initial experience, which was in the late 70s when I was in college, and we're doing deep research, first principles based, white sheet of paper.
But you're away from an R-squared like Washington Mutual or the other funds. What's your R-squared right now?
To be honest, the correlation of our performance to broad-based benchmarks is very low. For better or worse, what it tells our clients and prospective clients is we have a very good diversification strategy. Our funds, the active weight, if you're comparing to MSCI World or S&P or NASDAQ, the active weight is less than 5%. So really good diversification strategy focused on companies that are going to transform the way the world works. We look at the broad-based benchmarks, and sure, there are companies that are sustaining innovation like an Apple, but they are not going to transform the way the world works from here. Our companies are.
Kathy, thank you. Kathy Wood of ARK Invest. I can't believe it's been 3 years. It was right before the pandemic and New York shut down.
Yeah, well, she ignores us. We've tried to get her
out. It's been that long. You've been ignoring us, Kathy.
No.
That's what this is about. Come on.
We should mention she's got a new ETF in Europe. They're bringing it into the ARC model as well.
And we should talk about
the
growth stocks.
Europeanizing. Probably Novo, what's it called? Novo
growth stocks
obesity?
in Europe?
Yeah,
Novo obesity. Is that what it's called now?
Yeah.
Over at Novo Nordisk.
Yeah.
Alberto Gallo coming up next. Futures positive here on the S&P. This is Bloomberg.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
In their 70s that have a lot of wrinkles. I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things,
Really?
but maybe it'll be a little bit beyond skincare.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
If you get yields moving higher, that's probably in response to growth doing better.
I worry more about a yield-induced issue somewhere.
I think a lot of our economic models just aren't working now. The pandemic's just thrown them into disarray.
I did raise my outlook for a recession risk from 15% to 25%.
We can't have Goldilocks forever. We are going to start to see biting within the growth standpoint.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television, across America, worldwide, from our studios in London. Lisa on assignment here. It's going to be an interesting hour. We start strong here for Global Wall Street. We'll go to bonds here in a moment with Alberto Gallo. But, John, we've got to focus on this Fed meeting coming up. Cocktail hour in London. It's a different Fed meeting.
It's a different Fed meeting for us. It's a different Fed meeting for others as well. We do get forecast today. Unchanged is the call, but it's the forecast we want to have the discussion about with Kathy Jones at Charles Schwab, Matt Lazzetti at Deutsche Bank, Diane Swonk at KPMG, and Andrew Holdenhorst at Citi. How do these forecasts change? They're going to have to market growth. Growth has been better. Growth is going to be evaluated higher, we expect, Tom. Inflation may be a little bit lower. That's 23. What about the dot plot for 3 and 24? That's going to be the call here. Where do they see interest rates going into year end? Maybe one more hike. Let's see if they back away from that. Where do they see interest rates going into next year?
That's the Mike McKee idea, the parlor game of it, as you will. What I like there is we're going to get from Diane Swonk the effect of the UAW strike is one of the worries that are out there. Andrew Hollenhorst lines them up like ducks this morning. His Citibank worries where you stay up at a higher rate. Matt Lazzetti modeling out a slower economic growth. And there's different narratives here that Chairman Powell has to calm. I look for a calming voice
today.
It's
a timely news conference, Tom. Those three issues that Citi talked about, crude in the 90s, UAW strike ongoing, house prices recovering. Do they have the inflation data behind them, the incoming information to say we've made progress? Absolutely. Can they declare victory in a meeting like today? No, they cannot. Which is going to be the story, likely, in the news conference.
In the heart of it, and one of our great themes here, particularly going to Bank of England tomorrow, is this phrase, anchored. Are central banks anchored? Do they have control of the moment now or the moment out 3 years, 5 years? And in England, it's a different challenge. The level of inflation, folks, over here is totally different than in the United States.
Has it improved? Is it lower in the UK? Yes. Is 6 a problem? Absolutely. It's a problem for the Bank of England. I'll give you 2 names, Tom. Elsa Linos of RBC. She sat just over there.
Yeah.
Simon French of Panmure Gordon in Elsa's seat a day earlier. Both said the same thing. They think the communication of the Bank of England hasn't been good enough. It's been insufficient, and they face a credibility problem. Now the call from Goldman is no hike at all from the Bank of England tomorrow morning.
I was surprised
Goldman
by that.
thinks
Full
they're
disclosure.
done after that inflation report this morning. So big rally in the UK gilt market, and sterling a bit weaker off the back of that data earlier on.
And let's get to the data, but I really want to say that the communication will be improved at the Bank of England if John Farrow could be in the press conference here that they have to talk to Governor Bailey. They don't do them every time, do they?
Not every time.
That's the first mistake.
No, you get them when you get the forecast.
In the modern world.
You'd like a regular meeting and news conference from Governor Bailey?
Not really. You know me on communication as well. Let me communicate to you the data check. Oil pulls back a little bit. Yes, Azerbaijan and all near the Caspian Sea calms down, and it surged to 95. John, back a couple dollars, but 90 is a difficult number for Jerome Powell.
Equity session highs. We're looking pretty decent here, up 0.24%.
Dow Jones Industrial Average
on the S&P. I say we're looking pretty decent. I'm leaning on the call there of Savita Subramaniam, who's saying 4,600 on the S&P. That's an upgrade from 43. It's amazing to see these upgrades, Tom, just keep coming through when people are talking about the potential for weakness.
It's that time of year, but I want to make a point that when you have BNP Paribas upgrade in a jump condition to a new level from being very cautious, that's a different upgrade than the marginal upgrade we got from Savita.
True. Savita's still looking for upside, and Greg Bowdle at BNP is not.
Yeah. I think that they can be different and nuanced. We're going to be different and nuanced here as we look at equities, bonds, currencies, commodities, at the dynamics of full faith in credit and the credit market. Expert on this across all geographies, but particularly Europe, is Alberto Gallo. He's with Andromeda Capital Management and joins us today on the tea leaves, John, to see from credit in your Europe.
The CIO and co-founder. Alberto, good to see you.
Thank you.
Why have I not heard the word stagflation more than 2-3 times this week? I thought I'd hear it every 10 minutes.
Well, you're in London and the UK is in stagflation, right? That's the wage dynamics. There's an entrenchment in inflation where you see, 8, 10, even 14% wage rises on an ongoing basis. And many of these negotiations embed a forward-looking raise, a forward-looking increase. So they're not just increasing one-off, but they're going to keep increasing. So the dynamics have changed. As a central bank, you should only say that inflation is transitory, if inflation has gone back to target. But calling it transitory ahead of time is obviously a credibility issue. And that's what the Bank of England is dealing with today. Unfortunately, they can't raise rates too much because of the over-levered situation in the property market and the household sector. So it's a lose-lose situation. The growth inflation mix is much worse. And against this, we have a consensus in the market which is very relaxed, with very low volatility, very high equity valuations. Why? At the beginning of the year, everyone was very, very bearish, very positioned for recession. But today, most investors, according to market surveys, are positioned for soft landing. So we've gone from one side of the boat to the
muscular. When you look at how much the balance sheet expanded, they've only taken 10 to 12% of that off relative to where it was at the peak, and they still have a very long way to go to get that balance sheet around to the 5 to 6 trillion range, which is what they've articulated as their end goal. So when you think about what that means for broader liquidity. Remember, there's only two ways to create money, right? Either the banking system lends aggressively, which clearly is not happening. The banking system was already pulling back prior to the bank failures, or the Fed prints it. And so we're in an environment for the foreseeable future where money supply growth, if it grows at all, would be a victory for the Fed. But it's certainly not going to grow faster than nominal GDP. So you're not going to have excess liquidity to drive asset prices higher and higher like you had from most of the 2009 to 2021 period for the economy and markets.
All right, so it's a really fascinating situation in that case because they've done so much, and certainly in markets we've seen an effect, but it feels like in the economy there's still a lot to do. PIMCO's Geraldine Sundstrom weighing in on the November debate, not today's meeting, but November's, says, quote, there's still a fairly elevated chance of another hike before year end. Higher for longer is likely the mantra for U.S. rates as inflation will remain a little bit stickier than expected. Kathy, what do you expect out of today's dots and SEP?
Yeah, I think we're with the consensus. We might see a little bit of a shift in the dots. Last time we had 12 dots indicating another rate hike. That may come down just a little bit, but I don't see that the consensus will shift very much. And then the focus is really going to be on, as we go out into the future, are we going to push out those expectations for rate cuts into 2024? I think that that's a possibility. And then there's a small chance that there's an adjustment in the very long term, the terminal rate. You might see a couple of members shift up that dot a little bit. I don't think that that's a high probability, but it's something people are keeping an eye on. In the SEP, they'll have to revise up the GDP numbers based on third quarter bouncing up. But I don't think for the year there'll be a huge change in the GDP estimates. And keep in mind, it feels like the economy is really buoyant because we've had some good numbers in the third quarter. We've been below 2% real GDP for 4 or 5 quarters on average. So we have slowed the economy down. We are seeing the unemployment rate move up. I think the Fed will have to adjust, near-term unemployment down, but stick with a longer-term unemployment rate rising. So it's going to be a mixed bag, but I really think that we kind of have to push back against this notion that the economy is running on all cylinders. I think it might be running on fewer cylinders, because I know you're a car guy.
Yeah.
Fewer cylinders. They're not all firing at once the way they were, during the immediate post-COVID period when we had all that fiscal stimulus.
Maybe it's battery powered and we just can't find a charger right now. A Fed rate decision, obviously, really the focus all day long. That'll come out at 2 p.m. Eastern. Reminder to our viewers. Of course, it's followed by Chair Powell's news conference that comes 30 minutes later. You can watch Tom, John, and Lisa on A Fed Decides. It's special coverage this afternoon. And of course, Mike McKee, a very important part of that, Bloomberg's international economics and politics reporter. Joining us now from Washington, D.C., he's got a preview of what we can expect. Mike?
Well, Matt, we're going to play a game here to make the 2 o'clock announcement more interesting because everybody knows the Fed's not going to do anything. First part of the game is the word finder. Take a look at the statement and the part of the statement that has said in determining the extent of additional policy firming that may be appropriated. If that word additional stays in there, they're still thinking about whether they need to raise rates one more time. Second part of the game, count the dots. Kathy brought this up. There were 12 dots predicting a forecast of another rate hike in June. Does that come down today? Do fewer people think that there is still going to be one more rate hike, or do they take it out? We'll have to see. And then look at 2024. The consensus was the Fed funds rate would fall to 4.6%. Does that change? Do the dots move down or up on that? Do they take out some of the cuts because maybe things are strong? And finally, let's do math. Kathy was talking about the GDP numbers. It's the inflation numbers you want to watch in their new summary of economic projections, because if they raise the inflation rates, then they're signaling they might have to do more. If they lower what they think is going to be the inflation rate for next year, especially, then they might have to do less. There probably isn't going to be a clear winner in this game, Matt, but it is some way to look at what the Fed is doing. A lot of short-term issues in front of them that they don't have the answer to. And so get back to my question that I told John Farrow I'd ask. How much confidence do you have in what you're forecasting today?
And what do you want to telegraph, Mike? Because I thought it was really interesting. Anna Wong, Bloomberg Economics chief U.S. economist, her base case is for the Fed to put a dot in there signifying another rate increase coming this year, but then not to do it. So essentially kind of jawboning, I guess, the effect of another rate increase until the end of the year, and we realized they didn't actually act on it.
Well, it's keeping their options open. The markets would react badly if they took the dot out and then had to come back and raise rates. That would be a surprise. If you leave the dot in and don't do it, that's not going to bother people too much.
All right, dots go is going to be a big focus today. Mike, thanks very much. I know you're there for the long haul throughout Fed Decides today. JP Morgan's chief Japan equity strategist sharing her outlook for a different central bank, and that may be more interesting. Globally, we're waiting for the BOJ. What does she say about their path ahead?
JP Morgan expects that BOJ policy step after YCC tweak in July. Next thing would be the YCC removal in early 2024, and then in mid-24, the removal of negative rate.
All right, so we have the BOE and the BOJ to follow. The BOJ, I think surveillance polled their guess, apparently was going to be the most interesting meeting. Now the BOE is also fascinating because of the little drop in inflation that they showed. But Kathy, what are you looking for in terms of yield curve control? Could this be a game changer?
Yeah, it certainly has the potential to have a pretty big impact. You know, we've been saying for years that the one thing that can change the outlook is if Japan eventually ends yield curve control. And it looks like it's coming. It's on its way. So that sets up a dynamic where you get perhaps less demand for U.S. Treasuries versus others. But keep in mind that, you know, the market is already starting to adjust to this, and much of the anticipation is probably already built into where JGBs are trading. So I think it's a short-term effect over the next 6 to 12 months, perhaps, but going out longer term, I don't think it really changes the dynamic of the, you know, the global market. So we have a bunch of central banks still tightening policy to try to slow inflation, and you have one central bank kind of edging in the other direction. I think the sum of that is, you know, it sort of equals itself out, but obviously a lot of volatility along the way.
All right, Troy, just want to quickly get how important other central banks are on your radar. I'm told that our economies are interconnected.
Yeah, I mean, I think when push comes to shove, you know, the Fed still has been and always will be the most powerful financial institution in the world. So, you know, it's not that every other central bank's a sideshow. To Kathy's point, they can have marginal impact. But imagine a scenario where yield curve control stayed and the Fed hiked by 50 more basis points. Like, what's going to dwarf the other? And so, you know, we obviously talked a bit about the risk to duration, but I think what is now an incredibly favorable scenario for investors in this environment is this concept of a dare to dream scenario, where if you're invested in floating rate debt, that's typically tied to speculative companies. In the case of commercial real estate, you know, you're senior secured in the capital structure. We're now in this environment where it's possible that rates stay elevated for years, not at 5.25%, 5.5%, but well above 3 or 4%. And we never have a give back of the income because defaults stay very, very benign as they have so far.
Right.
So, you know, there's been some negative surprises in this cycle. Clearly, you think of how 60-40 did last year. You think about those that were over their skis in duration this year. But there's been a lot of upside surprises. And one is the continued strong performance of credit and the abundance of income at the front end of the curve.
Yep. All right. I think that's all we need to say about the BOE and the BOJ. We'll continue to focus on the Fed, but let's also look into the equity market. Kathy and Troy are going to stick with us on that, but Abigail Doolittle joins us for a look at stocks ahead of the opening bell. Abigail?
Well, Matt. We, of course, have futures trading higher. Let's take a look at some of the idiosyncratic winners on the day. Coty shares are popping. This after the company did boost their like-for-like sales growth along with adjusted full-year EBITDA guidance on strong beauty demand. Hudson Pacific Properties also higher. This is BMO upgrades to an outperform, saying that the West Coast REITs negative catalysts such as the Hollywood strike and a dividend suspension, well, they're priced in. And then finally, Pinterest popping 5.5%. A recent investor event has spurred some upgrades. Both Citi and D.A. Davidson, Matt, they've upgraded shares to a buy. Investors are taking notice.
Wow, an $18 billion stock Pinterest is. Abigail, thanks very much for that. Coming up, markets facing mounting headwinds out of Capitol Hill.
The UAW strike, we're seeing that, and what is that going to do to wages across the board for labor? We've got a potential government shutdown. That can cause some volatility in the markets because it looks like it's going to go to a shutdown.
We'll discuss the state of play in Washington next. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers. Real-time analysis. Weekdays.
There's all these elements that we see kind of on the sidelines that we're waiting to see them flow through the economy. So obviously the UAW strike, we're seeing that, and what is that going to do to wages across the board for labor? We've got a potential government shutdown. That can cause some volatility in the markets because it looks like it's going to go to a shutdown. It doesn't look like we're going to get an agreement anytime soon.
So markets facing mounting headwinds from Capitol Hill, the Biden administration holding off on a trip to Detroit as the UAW plans to expand strikes on Friday if no deal is reached. The White House writing, quote, given that negotiations are ongoing between the negotiating parties, it is most productive for Sperling and Sue to continue their discussions from Washington and allow talks to move forward, which doesn't sound very promising at all. This is House Republicans barrel towards a shutdown at the end of the month, with hardline conservatives foiling Speaker McCarthy's efforts to pass a short-term spending bill. Representative Ralph Norman saying, quote, we're going to have a shutdown. We believe in what we're doing. The jury will be the country. Bloomberg's David Welch joins us from Detroit with more on one of these kind of twin threats. David, the UAW strike doesn't seem like it's ending anytime soon.
It doesn't. Yesterday, UAW President Shawn Fain said that unless there's some real significant progress, which he didn't define, if that didn't happen by noon on Friday, then he would add plants to the 3 that he already has on strike. And I would assume they'd be pretty profitable plants, but we'll see who he picks. We'll find out Friday morning. But if he's threatening further action, then he's putting pressure on the companies, and that means there hasn't been enough progress at the bargaining table to get near a deal.
So what are we talking about in terms of, the amount of people who are going to be out of work here and the effect it's going to have on suppliers? Because worst case scenario, or one of the worst case scenarios, is that we get a part shortage and it affects all manufacturers, not just UAW plants.
That's right. And so you did see a strike of a parts plant in the South today that could have ripple effects. But what could happen out of the big UAW strike with the big 3 is if volumes are hurt enough at some of the plants that supply the big 3, they might supply Toyota, Honda, Hyundai, Kia plants in the U.S. somewhere, and if it's no longer economical for them to run, or if they get shut down, then that could have a ripple effect. I don't think we're quite there yet because we only have 3 assembly plants in the U.S. that are down from the UAW strike. But if you add a lot more this weekend, you could see an effect coming out of that.
A lot of these, big 3 cars are produced elsewhere in North America, Mexico, Canada. Canada has had their own union issues. What's the state of play there, David?
So the union delayed things by a day to see if they could come up with a deal. It's not quite as militant there as it is here, but it's also touch and go, and they're seeing pretty big offers from the UAW or for the UAW in the U.S., and they're going to want something pretty similar.
All right. David Welch there, Detroit Bureau Chief, wrapping up what we're facing in terms of the UAW. Kathy Jones and Troy Gajewski back with us to talk about how the government shutdown could affect things. Troy, what's your take on, really, both of these threats?
Yeah, so I think if you look at the UAW in particular, it's part of a broader trend, right? Where labor has far more power than at any time, not relative to the 50s and 60s when unions were much more dominant, but in terms of the average worker in such a tight labor market where there's so much labor hoarding. And on the one hand, obviously the strike puts a little bit of downward pressure on GDP growth. But on the other hand, if the union gets anywhere near the wage increases they're asking for, it just makes the Fed's job even tougher to constrain inflation, because ultimately, this is playing out as a mini version of the 70s, where you first have, inflation in goods and services, and then you spill over into the labor market, and you have an all-out wage spiral, which is obviously very problematic from an inflation standpoint.
Right.
In terms of the government shutdown, clearly that's a net negative for risk assets and growth in the short term. But I think the broader point there is if we were right now talking about these risks where equities were 14 times forward earnings, not as big of a deal. If the Fed was not doing QT, not as big of a deal. But we reflated back up to 19 and a half times forward earnings, and you have all these issues simmering in the background. So you add a few negative catalysts on top of it, and it could lead to a more substantial risk-off period.
All right, I got to wrap it up there. But Kathy Jones of Charles Schwab and Troy Gajewski of FS Investments, really appreciate your insight this morning. Coming up next, the morning calls, and then later we'll speak to Michael Purvis of Talbacken to discuss the upcoming Fed rate decision. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is the countdown to the open. I'm Matt Miller, in for Jonathan Ferro. First up, JP Morgan downgrading Dollar General to underweight, seeing a challenging outlook amid persistent inflation. And there's a story on the terminal that says it could be the worst place to work in America. Next up, Citigroup upgrading Pinterest to a buy. Abigail Doolittle talking about this, expecting user engagement to accelerate after its investor day. Pinterest is worth almost $18 billion, if you can believe it. And finally, Oppenheimer downgrading Chewy to a market perform, pointing to softening trends within the pet food category, but still not nearly as bad as Pets.com. Coming up, Tal Backen's Michael Purvis. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
This is the countdown to the open. I'm Matt Miller, in for Jonathan Ferro. Moments away from the start of trading, you have Klaviyo about to ring the opening bell at the New York Stock Exchange with futures higher on the S&P up about 0.3%. Sigma Lithium ringing the bell over at the NASDAQ. There we go. Trading is started. Let's take a look at not just what futures show us, but some other asset classes here. The euro right now trading at 107.05 as we wait for the Fed decision and then later the BOE and the BOJ. The 10-year yield at 432.87 right now, but it had hit the highest level since 2007, as had a lot of other tenors across the Treasury's curve. NYMEX crude coming back a little bit, down to $90.49 a barrel. Now, in terms of stocks, I mentioned Clavio as well as Sigma Lithium, but one to watch is the IPO from yesterday, Instacart, the grocery delivery company, fading after going public in one of the year's biggest listings. One Needham analyst writing, quote, "We see a balanced risk-reward reflecting slowing growth in the years following a pandemic-driven demand surge, and Carts," that's his ticker, C-A-R-T, Carts already scaled advertising business. Abigail Doolittle has more on Instacart. Abby?
So it seems as though we're now having a bit of a trend here, Matt, because Instacart is clearly not the only stock to have gone public over the last 2 weeks. We also had ARM, and both of these companies, these stocks, popping on the first day of trading. Now, relative to Instacart, yesterday it was up as much as 43%. It closed up 12%, not so shabby. Right now, down about 4%. So some of that speculative trading action that occurred yesterday, some of that excitement, it's dying down today. We saw that last week with ARM. ARM closed up 24% on its first trading day, and then the 3 subsequent days, not counting today, last time I looked, it was about flat, down 4 to 5%. So this is a lot different than some of the pandemic darling IPOs that we saw, such as Airbnb up 113%, Bumble up 64%, Affirm up 98%, Poshmark up 142%. This is positive, but when we put it into the perspective of when the IPO market was truly healthy, we still don't know. So, of course, as you were mentioning, later today, Clavio will be going public. Let's see how it does. Birkenstock is filed. And I would also make the argument that we still have the Fed out there. If they are in hiking mode, that makes these IPO, these growthier, more speculative investments, a little bit more risk is attached, plus inflation, oil on the rise. But everybody's hoping that this IPO window has opened up back in 2021. 976 companies went public. This year, it's basically a trickle. This is all about 2024. Is this going to grease the runway for next year for a strong IPO market? I think we're still in the discovery phase, Matt, especially as we have Instacart down 3%. Not so shabby, but it could be better.
Yeah, absolutely. Still undecided. We have a few months left to go, but I don't think that these IPOs represent, a huge window opening for the rest of the industry. Abigail Doolittle, thanks very much for that. Let's turn now to banking. Goldman Sachs in advanced talks to sell its Green Sky unit to a consortium that includes 6th Street Partners. The deal would also include KKR and PIMCO. Sonali Basak, our Star Wall Street reporter, has more on this. So, David Solomon unloading some of those assets.
Unloading assets. After already unloading consumer assets, really this is a spate of good news for Goldman Sachs that has been trying to clean up its consumer business just weeks away from their earnings report in the middle of October. Now, as you've been saying, they are looking to sell the set of the Green Sky business, which they've already took a more than $500 million write-down to a group that includes 6th Street, KKR, and PIMCO. There's an irony here because remember, 6th Street as well has a lot of Goldman alumni on its own. It has Marty Chavez, the former CFO, Alan Waxman, and it is bringing on Julian Salisbury as well. So a homecoming of sorts. But remember, there is a price for everything. According to the Wall Street Journal, this deal may be around $500 million, a far cry from the $1.7 billion Green Sky was acquired for. But a lot of the cleanup work has been done, in addition to those Marcus loans being offloaded to the likes of Varde and Rhythm, as well as other assets tied to that consumer business. So perhaps David Solomon in mid-October can give investors a cleaner story on the consumer.
All right, we'll be watching it closely with you, Sonali Basak. Thanks very much for that. Let's turn to tech now. Intel getting mixed reviews for its innovation conference after providing a few, or just few, I should say, details about its manufacturing process. The CEO remaining focused on AI, saying, quote, AI represents a generational shift, giving rise to a new era of global expansion. Ed Ludlow joins us from the West Coast. You can tell because he's not wearing a tie and he's wearing shoes for tennis. Ed, what have you got?
Don't deceive the viewer. I'm sitting right next to you, Matt, here in New York City. You know that. Intel down 1.6% on a 2-day basis, on track for its biggest drop in a month, having fallen by the most since mid-June in yesterday's session. The AI story that Pat Gelsinger is trying to position with Intel is that the next wave will be on device. Remember, Intel, one of the principal makers of PC processors, and while right now we're focused on large language models with hundreds of billions parameters, those are built in data centers. The future for generative AI tools will be on local device PC powered by Intel processors. The manufacturing process you referenced is for their foundry business, where Intel is hoping to shift to become more of a mainstay third-party contract manufacturer like TSMC is for much of the world's chip makers. And what we did not hear was a customer for 18A. That is their next generation node or manufacturing process. They are on track to start that process back end of 2024, 2025. They've dangled there being a customer in the wings who Intel will make a chip for built on 18A. They've just never named them. And so they're making the right noises. They're talking about their own GPU for AI, which is called Gaudi 2, and how that is going to be competitive against NVIDIA and its H100s. But the ticket we're waiting for is to Intel talking up its foundry business. When are they going to name that customer, and who are the customers thereafter? The stock down 1.8%.
All right. Fascinating stuff. Ed, thanks very much for that. He is sitting right next to me, but you can't tell because we do these shows down the barrel. There's no relationship shots. Turning to earnings, General Mills reaffirming its full-year forecast for 2024. The CEO saying, quote, "We delivered growth on top and bottom lines in the first quarter amid an evolving external environment." Simone Foxman here to tell us what exactly that means.
Yeah, that's right. We're seeing numbers that slightly topped analyst expectations, but not by much. The company reiterating its full-year sales forecast, looking for growth of 3 to 4%. That's higher than Wall Street analyst estimates of about 2.8%, seeing adjusted earnings per share come in at 109 to estimated 108. So slight beat there, but the problem is that a lot of this outperformance was driven by price increases, not necessarily growing volume. In fact, volume a little bit weaker than Wall Street had anticipated, negative 2% across its business lines. The CEO talking about moderating inflation, and in a statement said that he expects input inflation to rise 5 to 6% for the fiscal year. This is driven by labor costs. Really interesting considering what we have going on in Detroit. We got more on the consumer as well. Increased value-seeking behavior, especially in pet food. They don't expect a huge rebound nor a sharp decline there. We're seeing a little bit of weakness, even though we saw some gains early in the pre-market, but shares down over 22% this year, so maybe it can find a little bit of a bottom. Who knows?
All right, Simone, thanks very much. Simone Foxman there talking to us about GM, General Mills, not the car maker. Getting back to the story of the day, the Fed's rate decision coming up in just a few hours. Talbackin's Michael Purvis weighing in, writing, quote, "The Fed focuses on core inflation because crude and food prices are volatile." I'm glad he didn't use the word transitory. But perhaps they need to be a more important part of the rate policy discussion. Michael Purvis joins us in person now. Michael, great to get you on the program. So why would they want to focus on food and oil prices? Is it because it's one of the only things all of us actually needs to survive?
Well, certainly there's obviously a political dimension to food and oil price inflation here. But, you know, if you go back to 1970 and you look at rises in crude oil, more than 2/3 of the time that if the rise is more than 20%, core inflation increases, and sometimes by a very material way, as much as 1.5% in the coming months. It tends to lead increases in core inflation. Now, if the move is small, say 10%, there's no real statistical evidence, to demonstrate that. But what we're seeing here, since June, crude prices are up 30%. Volatility of crude, which I think is a really interesting feature of this whole crude rally, is actually gone down. And there's an echo in this in interest rates, where rates have been going up, of course, but the rate volatility has been going down. In fact, just last week, we had a new high in the 10-year yield for this cycle and a new low in the MOVE index for this cycle there. And I think those are speaking to the fact that, after so much shock and awe between COVID and 2020 and then the Ukraine war early in 2022, we're sort of post-shock, but we're into these new, the world's contending with these new structural themes that are developing here. And those are moving slower but they're in some ways arguably more significant. And so I think what we have to, realize is that crude oil is going to help ultimately push up several facets of core inflation there. And then, of course, there's the wage discussion and there's housing discussion and all that. But it is a really important part of the broader economy, and it is lower volatility today as well. So maybe the Fed should kind of blend core and headline inflation more together in their thinking here. This is not about an oil shock. These are about structural shifts with decent demand and tighter supply, keeping oil at the prices where it is. And I think there's a good chance that oil will stay where it is. And if that's the case, next winter, we're probably going to see core considerably tighter, barring some massive external shocks.
I was going to say, unless, there's a recession, and because this oil price, $90 WTI, as I understand it, it's not driven by demand growth, right? So if we have a recession, if people, I wouldn't want this to happen, but lose their jobs and no longer drive to work, or, if they go back to WFH, isn't that going to help bring down the price of oil as well?
Sure, yeah, certainly there. But of course, right now, it's hard to call for a recession. I think Bloomberg's economist actually is saying that next winter. But we
our
see a high
model only
chance
showed
of recession.
a 100% chance, Michael, of a recession in this half.
But I would say still, I'm not on that page. I think there's a lot of very strong factors keeping the the economy in reasonably decent shape. Not great shape, but decent shape. All right.
But what? I mean, the consumer's out of money.
Not yet. They're not.
The school bills are going to become due again. More and more purchases are put on plastic. The payments there are seeing a lot more delinquencies. Auto loan delinquencies are just going up and to the right. Oil is expensive. There will be a government shutdown. We've got a UAW strike. I mean, I could go on and on and on. Why do you think this economy is firing on all cylinders?
Well, look at the employment statistics, right? They're still, sort of defying the notion that interest rates were going to crush employment, and they haven't. And so, look, Matt, everything you just mentioned, that laundry list of economic bear concerns, are all real concerns. But there's also a list of things that are just, there's a lot of important new structural themes that are helping to keep the economy going. But I agree, we're going to see a bit of a downshift here. I just don't think it's going to be something that's going to be that, that big crash landing that so many people anticipated to happen early in this year. I look at it as more of a meh year next year, where a slight degradation in growth and inflation, but still a sort of, I think we're walking into a higher nominal world here. There. And don't forget, Matt, oil prices are higher, but, today the United States is a large oil producer, right? We're there. And what's bad for us at the pump is also good for so much of the Texas economy as well. So it's a very nuanced story here as it relates to the United States.
As they all are. Michael, great to get some time with you. Come into the office next time. Michael Purvis there. He's going to stick with us. Coming up, the IPO frenzy continues.
The fact that we've been able to launch these deals speaks to liquidity in the market, speaks to decent appetite, and those are good fundamental dynamics for the market.
That conversation up next. This is Bloomberg.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under
tightening would be a worse mistake than over-tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's always for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn. Is that what we're doing right now?
Yeah, a big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
The issue is more around what is the appetite among investors for IPOs, and to what extent are people looking to deploy risk capital into some of these earlier stage names. The fact that we've been able to launch these deals speaks to liquidity in the market, speaks to decent appetite, and those are good fundamental dynamics for the market.
That was Morgan Stanley's Lisa Shallett weighing in on the IPO market. Klaviyo, apparently it's Klaviyo, making its trading debut today, pricing its IPO above the marketed range to raise $576 million in the third major U.S. listing of the week. This on the heels of SoftBank's chip designer ARM Holdings and Instacart. We were talking about that rally kind of fizzling out the day of and the day after its IPO. Let's bring in Bloomberg's Shonali Bassick for more for more of a look, I guess, at this IPO climate. Shonali?
Yeah, when you look at Klaviyo's IPO, for example, you do have not only them hitting above the top end of the range, you have Klaviyo going into a green market. The S&P today up on the day. When Instacart listed yesterday, they did not have the same market heat, although volatility has been low enough to make these listings smooth in a year where IPOs have come to a pretty screeching halt. This is bringing fervor back into the market. Klaviyo has also something that Instacart didn't have as drastically, which is a tie-in to the AI industry more directly. They have come in with cornerstone investors to the likes of AllianceBernstein, BlackRock, and Shopify was an early investor as well here. Interestingly, Matt, you have also had a lot of retail interest in these IPOs. And when you look at Klaviyo today, another interesting aspect of this, Matt, is it's going to price and also list its first trade likely within hours of that Fed decision. So you do have these companies trying to make it to market before any potential volatility were to hit the market and impact risk appetite from investors. Now, we've been talking about this a lot on this program. One day does not make a trend. How these IPOs keep trading will make a big difference, more than there is for Instacart. There are not a lot of grocery delivery companies in the pipeline for future IPOs, but there are a lot of SaaS companies in the pipeline, as Axios points out this morning. And so Klaviyo's listing today, any potential success of it means a lot for those companies in the pipeline, as well as underwriters. This is a trifecta for Goldman Sachs. And today we also have Morgan Stanley and Citigroup on the listing, as they were not as prominently listed yesterday and last week.
Shonali, thanks very much. Shonali Bassick there talking to us about IPOs. Michael Purvis from Talbacken weighing in on the IPO market, saying, quote, after a brutal 2022, the IPO market is coming back to life. The VIX has averaged less than 15 since June. This, combined with strong equity performance, has set the table for an IPO renaissance. Michael Purvis still with us. So what do you think of the action that we've seen this week? Is it going to lure more companies back to public markets?
Look, if the IPO market, if the aftermarket performance here does reasonably well, doesn't have to be great, but as long as it does reasonably well, doesn't fall apart, the market doesn't fall apart, and the VIX stays low, then yeah, I think the table's set. I mean, don't forget, Matt, that VCs need exits and bankers, investment banks need fees, right? And there's, I call it sort of like the VC banker industrial complex, if you will. So when the macro conditions, get, pale green light, as they just have been over the last 4 weeks, that's going to set the table for more and more companies, to go public, because there's a lot of people, whether it's the management, the VCs, private equity, or the bankers who are all incentivized, to do that. And it's a very healthy part of the, broader, economic system that we live in, to have this capital.
Well, what are the
new
risks?
Capital come in and recycled.
Michael, I mean, as Shonali was saying it, I just realized, oh yeah, the Fed, on the same day as an IPO, is that, risky? They have to start trading before 2, I guess, which these days isn't exactly a sure thing. And you've got the bigger looming risks of a government shutdown that's almost guaranteed to happen, and a UAW strike that looks like it's going to stretch out. So could that, ruin the party?
Well, let me take those one at a time. Look, in terms of the Fed Day issue, look, if we were having this conversation a year ago, absolutely, that would be a big issue. But if you actually look at, broader equity market performance on Fed days or CPI days over the last several months, it's not a big thing. It really is not there. So I think that, the broader complexion is, are there still, people that want to allocate into this market? And it seems like there are here, and people, IPOs always engender excitement there. Regarding the government shutdown, that again is always one of these like sort of perma risk. Unfortunately, it seems to be one of these perma topics that the markets have to contend with, and the markets generally, by and large, tend to work through those. With respect to the UAW, yes, that's another big risk. I'd argue that it's a bit more political than economic or markets right now, although it does speak to this issue we were talking about in the earlier segment on higher labor cost, slowly and steadily coming into the broader economic condition of inflation there. So yeah, the bankers are going to say, look, things are pretty good. We're, September, the market's supposed to be volatile. It's only down 1.5% month to date.
But it looks okay
here.
But it looks okay so far. Michael, I got to wrap you up there. Unfortunately, Michael Purvis from Talbacken, appreciate you joining us, talking about the IPO market. We are going to talk when we come back about the market-moving events you need to be watching. We're going to give you your trading diary next. This is Bloomberg.
when the Bank of Japan eased yield curve control. That will create at least short-term volatility in the U.S. rates market on fears that there could be changing demand dynamics from Asia. But the Fed still is the most important factor in where the market's going. And in particular, not even the 10-year. I think the 10-year is in a way a little bit independent from any news that we'll get today, but the 2-year, the 5-year, and certainly all of the money market rates that we're so keenly focused on wind up being, just keyed in so much on what the Fed's going to say today.
Guy, were you trying to get to the Bank of England, or were you trying to get to fiscal with that question?
Well, I think it's a bit of both. It's a good question because both those thoughts were going through my head as I asked it. And I think the fiscal story is going to be interesting. I think what's going to be happening over the next few days in Washington, I think, is going to be fascinating. Does that have an impact? But the Bank of England, I think, is a sort of case in point. There is certainly evidence now that inflation is starting to come under control. The bits that are falling are volatile, and maybe this isn't the end of it. But I think the big surprise today is that gasoline prices didn't lift that inflation number. There were other factors that lent in against it, and we ended up with a falling number. And Mike, I think this is the question that I think everybody's trying to figure out right now is how big an impact is that gas
people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, the big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Let's talk about Corti. It's a Danish medical software startup. It's just raised $60 million to sell an AI co-pilot to more hospitals, basically compete with the likes of Microsoft, Amazon, other tech giants racing into the healthcare space. Let's bring in, of course, the CEO, Andreas Cleve, as well as co-founder for the business. And alongside the investor, Laura Connell, partner at Atomico, which are helping with the fundraise here. And I start with you, Andreas. What exactly are you bringing? How are you augmenting people who are going to treat people in hospitals? What is the co-pilot allowing them to do?
So thanks for asking. We are augmenting the professional. So we're a tool that sits on the side of the patient and the professional as they have an interaction or a consultation. So imagine a small digital assistant that, as the conversation progresses in real time, will be taking notes, will be journaling the conversation, we'll be comparing symptom descriptions to more than 50 million other patients. We'll try to help the healthcare professionals steer the conversation to the best possible outcome with the least amount of administration burden happening afterwards. And hopefully not only will that free up a ton of time, but it will also make sure that the professional has all the time to focus on the patient and not the paperwork while they're interacting. And I think all of us who've tried healthcare think that's really important.
Laura, you were helping lead Atomico's investment in Corti. You've got an AI focus, an enterprise SaaS focus, a fintech focus. What drew you towards Corti?
Yeah, thank you for asking. At Atomico, what we're most focused on is trying to invest in and back teams and founders who are really trying to solve some of the most important generational issues that we face. I think few people disagree that healthcare and health tech is one of the key areas that we most need to fund. So we spent a lot of time looking at the full value chain and figuring out where along the value chain we thought that some of the latest developments in AI could most help, not only in terms of improving patient care outcomes, but also in driving cost efficiency and revenue optimization for key hospital providers who, as we know, are buckling under the strains of inflation, resource constraints, and a frontline care worker health force that is really struggling with things like burnout and depression post the COVID.
Andreas, AI is the technology, but I'm actually just interested in the data. There are many giant technology companies working out how they can enter this healthcare space. I was in Cupertino last week at Apple, right? Theirs is more about emergency situation detection, but it's machine learning based. Do you look at the likes of Apple and worry that they similarly want to be a part of this healthcare process, the same part that you're occupying?
I think it's exciting to see more big vendors entering the space. But I also think we've all now tried many of these new AI technologies and found them lacking. And what we come with is a uniquely vertical AI system. And for the layperson, that means it's uniquely specialized in one thing, and that is actually healthcare interactions. And that's still unique because a lot of the big systems are still built for the horizontal use cases, the very average everyday use cases, whereas we're very focused on this exact interaction.
We're just going to pause this conversation for a moment. We have some breaking news of Klaviyo opening at $36.75. We have the opening price for the initial public offering of Klaviyo. $36.75 is currently where we trade. So a big uplift from the $30 at where they priced. Now, ultimately, Ed, we are seeing, once again, a pop in the latest IPO. We've been sitting here wondering how Instacart was going to be performing on the day. They had a 40% pop at the open. We know that Arm also traded significantly higher. But notably, we are seeing these companies taking advantage of this window and managing to line up the demand and the supply side. Once again, this was a company that had cornerstone investors, but perhaps more at the more desirable area of finance. Shonali and Abigail Doolittle are standing by. Let's go to Abigail first, who's just here with the opening trade.
Yeah, well, we have another exciting IPO here, the third large one in a week right now. We have the shares of Klaviyo up 21%, so really very positive. And of course, it priced at $30. That was above where they were initially marketing this IPO at 27 to 29. And just today, we saw a bunch of different ranges, 36 to 38, from 34 to 36. This IPO was 30 times oversubscribed. So right now, it seems very, very successful. A valuation of about $11 billion. And of course, you just had that wonderful interview with the CEO and their what some are calling bread and butter technology. This may be a good sense for next year. A lot of people are looking at these IPOs to see, is it greasing the runway for next year, especially around technology IPOs. Now, on the other hand, it's interesting because we do, of course, have the Fed later today. We still have some inflation concerns. That's what's kept the IPO window largely closed this year. So we continue to have this big question of whether or not we are now seeing the reopening of the window successfully. Now, we don't know that yet because while Arm was very successful on its first day, it's traded back down there from Instacart. Same thing yesterday, up about 12%, now coming in a little bit. But overall, very successful start here for Klaviyo, up 21%.
Abigail Doolittle, literally running to set, breathlessly telling us about, well, the pop that we're seeing of 23%. Shonali Basek's been standing by, waiting for this opening trade. And, you know, this is once again about cornerstone investors. This is once again about limiting supply and ensuring that this has been really well managed by some of the banks.
Yeah, the management of this IPO with the cornerstone investors, AllianceBernstein, BlackRock. Remember, top 10 clients took 55% of the deal, while the top 25 took 80% of the offering. That left roughly 200 investors with no allocation at all. Yet you look at this, and that's according to Amy Orr, who has been reporting on this through her sources. $11 billion company. At the opening trade at $36.75, that is what you have Klaviyo now valued at in the market, give or take. You have it fluctuating slightly in the market. That 22% pop, that was less than what you saw at Instacart, despite those 200 investors getting no allocation at all. It will be interesting. Now, we are just hours away from a Fed decision. And so let's see where Klaviyo ends the day and goes into tomorrow. The end of this week is an important moment for both Klaviyo and Instacart because now that these IPOs, the pricing itself have gone so successfully, supply has been limited, big investors bought in.
Right.
It will matter a lot to these employees as well as these investors.
The cornerstone investors are important, but the IPO is a test of how much risk appetite there is out there for a high multiple software stock. You hear the words of the street, Wall Street. Is the risk appetite there?
What's interesting is we're going to watch Instacart and Klaviyo post not too long from now their first set of earnings reports. Those will be very important landmarks for these companies because as we've been talking about, there are really only a few more IPOs left this year. Perhaps Birkenstocks, perhaps Turo, as you've been talking about, Caroline. But it's really in the middle of next year, early next year, that you're going to see the bulk of these companies try to go public. Therefore, the results that these companies post and the investor appetite continuing on is important. Lastly, I would say for the employees, you just go to the filings, the SEC filings of Klaviyo, and one of the things you see is the contract, the employment contract for the chief people officer they brought in, and the stock options that she gets on the back of this as well. You think about all these companies. This was a company founded in 2012. These companies' employees have been locked up for a long time. So these stock listings are just as important for those employees as they are for these new cornerstone investors, as we've been talking about.
Okay, everyone take a breath. Bloomberg Shonali Basek, thank you. And as she just noted, she's going to have to wait a little while for another IPO anyway. Next up, Amazon is launching a revamped Echo Show 8 smart home device and updated Alexa with, finally, new generative AI features. That and much more was announced earlier today at Amazon's product event, its first in-person gadget unveiling since the pandemic. And we're delighted to bring in David Limp, Senior Vice President of Amazon Devices and Services, who's joining us from the company's new campus near Washington, D.C. Dave, you and I have done so many interviews over the years, but you did announce that you would retire at the end of this year. We will get to that. First off, let's start with this generative AI integration into Alexa. How are you guys going to roll that out over the coming weeks and months? Because other tech companies have been so conservative about putting generative AI tools into the real world.
Yeah, by the end of the year, we're going to offer a free preview to anybody that has an Alexa endpoint out there, an Echo, and we're going to do that in a way that you can get into the experience a couple different ways. We're kind of reinventing how we do entertainment on Fire TV. We're doing some things in the smart home, and then we're offering a Let's Chat experience that is super conversational. We showed it on stage today, and it's remarkable. And I think the big thing we were able to do is actually optimize a large language model and generative AI for the home, which is a very different environment than the tab of your browser.
The emphasis is conversation and real-world application. I told our audience on social media that you were coming on, and we always take audience questions, Dave. One is a pretty straightforward one. Will Amazon use Alexa devices to listen in the home as part of training of the large language model that powers the generative AI tool? Of course, there is history here about data privacy.
Oh, of course. And, one of the things we emphasize today is that privacy is foundational to what we're doing here. And, we give the best way we do here is that we give controls to customers. If you want to delete all your utterances, there's a single button that will delete your entire history. If you want to delete your smart home history, there's a single button that allows you to delete that whole history. If you want a more personalized scenario and more personalized types of things so that it recognizes you and personalizes the stuff to your screen, then we do use that information to train the model. But if a customer doesn't want it to be personalized, they want a more generic version of Alexa, that's fine too, and we give them that control.
I need it not to listen to my children, David. Meanwhile, I'm listening to some of the news that's been unveiled, and not only about new AI, generative AI within Alexa and some of the new Echo Show 8, but 1 billion Alexa devices have been purchased. Can you just break down exactly what you mean by those 1 billion? What kind of devices, where, how, when?
Yeah, we're talking about the number of devices connected to Alexa, and that's approaching 1 billion. It's getting very, very close. A bunch of those are Echoes. There are a bunch of third-party devices as well that have Echo and Alexa inside of it. Things like, BMW vehicles and Sonos smart speakers. And then there's over 400 million smart home devices, that have been connected too. And so we're really seeing kind of a continued momentum, and we're kind of lapping the pandemic, but we're still seeing this growth in engagement and growth in how people are using Alexa.
I mean, when you first launched the first device, the Kindle, just the amount of change that's gone on since then, and indeed the way that we want to stay informed, we have become aware of the way our data is used. And some of the regulatory environment, David, when you're launching new products that integrate very cutting-edge technology, how are you thinking about the way in which regulation is going to be changing into that unveiling?
Yeah, obviously, we have to take into account laws. We're never going to build products and services that are going to break the laws. But when it comes to AI, the most important thing is we build an AI that's responsible, that's safe, and that is trusted by customers. And so what we've done, and I think that's even more true when you're going to put this AI into your home in the form of Alexa versus if you were putting it on your personal computer or elsewhere. And so we're doing a lot to build guardrails around our AI to make sure that it is as responsible as we know how to make it. And because we're interconnecting it to your home, we're also doing a lot to try to reduce this idea of hallucination. The last thing you want is for you or your kids to say, turn on the living room light, and all of a sudden it turns on the garage door light. That assistant is not going to be used after a little bit longer. So we're spending a lot of time there as well.
Dave, I've lived in the United States for almost 6 years now. I've enjoyed these interviews with you talking about hardware and its role in the Alexa ecosystem. Bloomberg's reported that Panos Panay left Microsoft, where he led hardware, and is joining Amazon. Are you able to confirm that's who's replacing you in any of your retirement plans by the end of the year?
We don't have anything to share on that. Besides, it is true that by the end of the year I will be retiring from Amazon. That I can confirm.
Okay, well, and you won't stay in technology? There's no Dave Limp startup on the horizon?
I think the thing that I wrote it to the team, so I can certainly tell you, I've been doing some version of this job for 30 years. I came straight out of undergraduate college. I went to Apple. I had such a good time there. I then went to Palm and other places. And so I think I do have another chapter in my life. It's just not going to be consumer electronics. But beyond that, I just ask you to stay tuned.
Maybe venture calls. You're at Azure Capital just before this role. David, great to have some time with you. Thank you, David.
Thanks for the time.
Yeah, of course, Senior Vice President of Amazon Devices and Services. Meanwhile, we want to dip back into what the IPO is up to. It's been such a busy couple of days when it comes to NASDAQ yesterday with Instacart. Today, it's New York Stock Exchange's time to shine. We're seeing ultimately another pop, Klaviyo going higher. Now, not as high as it had been indicated overall, Ed, but certainly a notable 25% increase. They are managing to plan these IPOs to the nth degree.
And the first SaaS or enterprise or software name in 2 years, and they trade at higher multiple. We have the Fed later today, but we love an IPO. Sonali Basak laments that there won't be another one till Birkenstock, but it's been an amazing week.
And just think, it's not just about Birkenstock and retail. There's going to be so many other technology companies in the background. I remember speaking to Karen Snow over at NASDAQ saying that there's about 157 companies that have filed, many of them technology as their root cause. So
if the window's genuinely opened, we'll find out.
We'll see. Well, for now, it looks as though we've got a surge in trading. Stick with us. That does it for this edition of Bloomberg Technology, though.
We cap the show on our podcast. We get it on the Terminal, Apple, Spotify, and iHeart. From New York City, this is Bloomberg Technology.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything. In spite of the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg. Top experts. Great questions.
Welcome to Bloomberg Markets. I'm Matt Miller. Let's quickly start with a check of what's going on in the markets just about an hour before we get the Fed and 15 minutes after Klaviyo starts trading. The S&P 500 right now up about 0.3%. So the mood a little bit risk on here. Investors are also buying bonds, which might not be a surprise after yields yesterday rose to the highest they've been in 16 years. Right now, the 10-year yielding 4.3147. The dollar coming off a bit, back under 12.50 at 12.4819 as measured by the Bloomberg U.S. Dollar Index. And then crude right now, NYMEX, WTI trading up 30 cents a barrel to $91.50. Klaviyo, by the way, which priced in its IPO at $30 a share, is currently up more than 18%, trading at $35.46 in the first 15, 16 minutes of trading. And we'll be talking about that right now with a Bloomberg Wall Street reporter, Sonali Basak. She's been covering all the major IPOs. We've had 3 so far this week. ARM Holdings, well, was that last week already?
That was last week.
Last week. It's 3 in the last 2 weeks, big ones. ARM Holdings was last week. Yesterday we had Instacart, and today Klaviyo. The other 2 kind of fizzled out, look a little bit weaker than they did in the first day of trading. What do we expect from this one?
What's amazing is you already see it opening more than 20% higher than what they priced at. Remember, our own Bloomberg's Amy Orr had reported how much interest had come into this IPO. 200 investors roughly left on the table with no allocation at all. So this 22% pop is not surprising in that vein.
I was going to say, I don't think it's that amazing, right? This is what happens with IPOs. They aim for a pop. It's engineered for a pop.
They don't want to
Yesterday, Instacart was up 43%.
They don't want to leave too much money on the table. But look, the pop is already fading just a little bit. That 22% now is 17%. And we have Fed decision coming soon, too. So where it ends the day will be enormously important, let alone their first trade.
Yeah, absolutely. I mean, they wanted to get it done before the Fed. These are coming later and later. So it was a risk, I think, that it didn't get traded until much closer to 2 o'clock.
Yeah, a few things that are interesting here. Timing is everything, getting ahead of the Fed here. In the next couple of weeks, this will set the tone for what investors can expect in terms of new listings. We're waiting on Birkenstocks. It has been widely reported that they were seeking a valuation about $8 billion. Now, can they go to market and expect more from their investors? Klaviyo was a pure play, more pure play at least than some of the other listings, AI-focused company, a SaaS company. It tested the water for the SaaS companies that are in the pipeline for next year.
So much SaaS.
So much SaaS. we love being sassy
You're
about
meaning
the IPOs.
Software as a service.
I am meaning software as a service. I do also want to point to the underwriters because this is really the year for Goldman. They led all 3 IPOs. They were a top underwriter. But you know, fun fact, if you look at the Bloomberg's IPO league tables, you have Goldman with more than a 30% share of left lead mandates. You know who else is up with a 30% share? You're not going to guess. Barclays. That ARM holding was such a big IPO.
What do you type, League Go or MA Go?
IPO Go, and you see all of the league table information for this year because the biggest ones are pretty much getting out of the way. Interestingly, even though these were some of the biggest technology listings, there have been a whole other set of listings across different industries. Follow-ons have been happening. So this means that, yes, the bankers are busy once again. They want to keep that window open. Q1, first quarter of next year, might be even more if they can keep this exuberance. Volatility is low, but the market is choppy.
All right, Sonali, thank you so much. Sonali Basak, our Wall Street reporter, walking us through this IPO and talking a little bit of the last couple. Maybe the window is a little bit more open than it had been. Now, Birkenstock, the next big one. Let's turn back to the Fed, though, because it's coming in less than an hour. Earlier, Seema Shah from Principal Global shared her expectations for Chair Jay Powell.
We're seeing inflation moving in the right direction, at least for now, especially on the core inflation side. So actually for us, we think it's a pause. We think that rates have peaked. But I think from the Fed's perspective, and certainly for Powell today, it's really important to maintain a bit of an hawkish message.
Bloomberg's Michael McKee joins us now live from the Federal Reserve. So, Mike, I guess what we're really expecting, or what we really are looking forward to, is a new summary of the economic projections, which we get 4 times a year, as well as a new dot plot.
Yeah, and I think the dot plot is what everybody's going to turn to first, Matt, because they want to see, first of all, whether the Fed retained the idea of one more rate move this year. They probably are going to. Why not? And it does give them at least the option of raising rates without market angst, put it that way. And then they're going to look at 2024. Does the Fed raise the number of dots? In other words, do they project fewer rate cuts next year than they had? The median is 4.6. That's almost a full percentage point down. Or do they see inflation coming down faster? So that's kind of what people are going to be looking for today, hints about what comes next, rather than anything they do today.
Mike, thanks very much. We're going to obviously be checking in with you throughout the afternoon. Michael McKee, our Bloomberg economics and politics correspondent down at the Federal Reserve in Washington, D.C. I want to bring in Vanguard Global Chief Economist Joe Davis, who's here with me on set. Joe, thanks very much for your time.
Thanks for having me.
Today. So we don't expect any actual movement. A hawkish pause is the term everyone's using, which I like, and it's a good band name as well. But we do want to look for the dots to see if they have raised the expectation of another hike this year and what they are looking at in terms of possible cuts next year.
Sure. Well, I think actually what Mike said, I think they will leave the option open to raise rates again. I think it's really consistent with their economic forecast. I think we will.
And we should point out, though, it's not an optionality, right? The dots are their forecasts for what each member expects.
It's their best estimate of where we go. And I think we're going to see higher for longer. Whether or not they move the long-term dots is up for debate, but I think that'll be a glacial move. But we're going to see this continue to be priced in the bond market. This notion of the Fed cutting rates anytime soon, I think, is just misplaced.
Well, a lot of it comes from the dot plot, right? They have priced in 4 cuts, or they've got the majority of the dots in cuts 4 times next year, which is kind of at odds with what Powell himself has said. He's said it's going to be years.
And there's a little inconsistency here, at least I see in the forecast, because you don't have much deterioration either in the labor market, hence higher for longer, or you do have a deterioration, but then you have the stickiness of inflation. So something is not squaring in the full circle. Again, they are also evolving in terms of the data map, but I think we're going to see at the end of the day optionality on we're not potentially fully done, and we're not cutting rates anytime soon.
Do they choose one mandate over the other, Joe? I mean, if they're having trouble with inflation, but unemployment starts to tick higher, do they continue to hold rates high?
I think they do. I mean, again, inflation expectations, they'll talk about how genuine is it, how persistent is it. Man, I think it goes back to the labor market. It's still imbalanced. They will be hawkish, although their rhetoric will always be more hawkish than their policy, I think, at least in terms of the next year or so. But then when push comes to shove, you have to stick towards the 2% because of the downside tails if you get that embedded.
Well, the question I get a lot is what makes them cut? What do they need to see before they're like, uh-oh, we got to move rates down? Is it 4.5% unemployment? Is it a recession in terms of consecutive quarters of growth contractions? What is it?
I think it would be the labor market deterioration. Again, GDP less correlated than the labor market. It's less than growth. And again, 4.5% unemployment. We will have had certainly flat payrolls by then. So non-farm payrolls would eventually be negative. At that point, I think you would open the door for that, particularly if core inflation is coming down and you see the wage numbers softening. So our leading indicators would point to that, but just we're not there yet. It's later next year.
What do you think about long and variable lags? I mean, how long are they? Because we hear from some people, Danny Blanchflower says 18 to 24 months. And Jan Hatzius says much shorter than they have been in the past.
It's definitely not much shorter. I mean, you look back 100 years, you look at the last 30, it is 12 to 18. I think what's being lost here is that policy was so accommodative when they started to raise rates. So yes, they've raised over 500 basis points, but they were deeply negative in real or inflation-adjusted space. So only now...
And everybody adjusted at that point. Everybody did refinancing.
It's a big move, but we were the most stimulative, arguably, since World War II. So we are only now getting into the restrictive zone. So we can still have that debate of what is that actual.
Which is, by the way, only on the monetary side, because on the fiscal side, the money is still, hemorrhaging out of the federal government.
In fact, I could show you a graph that say when you put the 2 policy measures together, fiscal and monetary, we're certainly not as restrictive as we think. And you could even argue that we're barely restrictive.
Yeah, well,
and so I think that'll play into the stickiness of inflation over the next 6 to 12 months.
And there are those who have argued that. Neil Dutta, for example, doesn't believe that the Fed's really in restrictive territory and thinks the economy is still very bullish on the economy. What about those who are worried about things like student loan payments coming back online, credit card debt blowing up, credit card delinquencies rising? We've got rising oil prices, a UAW strike, a government shutdown looming. I mean, you can make a bearish case pretty easily for this economy.
Well, yeah, and in fact, you just used two hands. So, I mean, that's a lot. So I think it is. Their headwinds are building, but the economy still has strength. And that's where we see the crossroads in the financial market. So again, I think that, what we'll see is wait and see from the Fed, talk tough, and then update your priors accordingly. But I still think the labor market still has some resilience, and we are not really entered the fulcrum of when policy tightening you can trace to softening labor demand.
Joe, great having you on. Really appreciate your insight. Joe Davis there, Chief Economist at Vanguard. Coming up, new warnings about the rise in leveraged trades against U.S. Treasury futures. I think this is a fascinating story. It gets a little bit into the weeds, but fortunately we have the smartest people in the world to help you understand the details next. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg Markets. I'm Matt Miller. The Bank for International Settlements has warned hedge funds about a buildup of leveraged short positions in U.S. Treasury futures. Let's talk about that as a risk, an economic risk, with Bloomberg Chief Correspondent of Global Macro Markets, Liz McCormick. She joins me here on set. So a lot of this stuff is difficult for the layman to understand, but this is like the central bank to central banks, right? And so what's the problem with hedge funds having this huge short trade on treasuries?
Yeah, so hedge funds just being short in and of itself isn't a problem. It's when it's used with a lot of what we call leverage, right? It's like you and I buying something. If we have the cash, that's one thing. We might have risk. But if we're like borrowing from your brother and then things go bad, then you not only bad in the trade, but you owe your brother. So that's what the BIS and other regulators have been looking at. And it's a hard thing to kind of fine tune exactly how much is out there. But by looking at the net short position in the futures, which the hedge funds tend to short the futures, and then they have to deliver a cash bond into it, they're seeing there's a big buildup in the net shorts. So that makes them think, and you can look at like the repo, what are the rates in repo, because you're borrowing money. A lot of people do that in the repo market with Treasury repo. So that's what they're looking at, that if this trade blows up, then there's a lot of leverage, meaning you're scrambling. You might have margin calls, you can't pay that back. And remember in March 2020, which we don't want to live through again, that was part of what blew up. And we know the Fed came in massively and had to buy bonds, and they really don't like to have to do that, right? I mean, they'd rather stay out of the game of buying bonds, but they're
trying to do the opposite right now.
Well, right now, exactly. They're doing QT, trying to get out of the bond holding business, right? But they want financial stability, so that was the reason they came in. So it's the leverage in the system, Matt.
I also think it's interesting. Right now we have so much supply coming. I think Ira Jersey just quoted me a figure of $1.5 trillion that he can see. And we don't have primary dealers holding as much as they previously had on their balance sheet, but their trading has gone up massively.
Right, yeah, it was interesting you bring that up because Coalition Greenwich did a piece on that as well, saying, hey, dealers matter, but not in the way they used to, right? In the old days, our old days, they used to hold bonds, and there was a customer who needed them, they'd have them and sell them. Now they're kind of like a broker, they're moving them between clients, right? But they're not holding them. So their holdings of debt have really gone down, but they're trading more. So, yeah, and we have this massive amount of paper like Ira is talking about, because I know you were talking earlier about the deficit and the fiscal backdrop, and there's like, as far as the eyes can see, there's going to be more Treasury issuance, because our deficit is just on a trajectory to keep worsening, or definitely not get better anytime soon.
I bring it up because I read your byline, right? I just do bio Liz Capo McCormick, and then I read the stories
I got one
there.
reader here.
Thank you so much for joining us. Liz McCormick talking to us about risks in the Treasury market. Now, the SEC just voted to toughen rules for misleading ESG labels in an effort to have fund names better reflect their holdings. This comes as regulators face a potential shutdown. Bloomberg's Kayleigh Lyons caught up with Chair Gary Gensler about the possibility of a shutdown on Capitol Hill, and I'm sure she lobbed a few crypto questions at him as well.
We will largely be a skeletal staff under the laws, and so the normal oversight we have on markets will not be possible. It just simply is not for how many days that happens. Companies that want to go public may not find that their filings could even be reviewed by the SEC.
Kayleigh Lyons joins us now live from Washington. So, Kayleigh, there's so much going on there for you. You've got the UAW strikes, you've got the looming government shutdown, and now you've spoken with Gary Gensler. And since you and I co-anchor a crypto show together, I'm most interested in what you asked him about ETFs.
Yeah, of course I asked him about that, knowing that the chairman does not speak about any ongoing litigation, Matt. He also often says he is just one member of a 5-member commission, and he can't prejudge any one product. He needs the process to play out. So did I get a firm answer on a spot Bitcoin ETF application? The answer is no, I did not. I did ask him, though, how recent court decisions we have seen collectively has changed his thinking about regulating this space. And the answer really, Matt, is it hasn't changed his thinking much at all. He still thinks it's rife with fraud and manipulation. He still thinks that crypto companies that have what he sees as securities need to come into compliance. And so I asked, hey, is there anything any court could say that would change your mind on this? And he said, all I wish is that the courts could make them come into compliance faster. So that's what I asked on that. I did talk about the distinction between a Bitcoin spot ETF and a futures ETF, considering his concerns on fraud and manipulation. I asked, could he rule out revoking approval of a futures-based product? He didn't say no, he could rule it out, but he was a little reluctant to answer that question.
All right, interesting stuff. What about the shutdown? How are regulators affected in the government shutdown?
Well, we just heard a little bit of what he had to say. Basically, because of furloughs and things of that nature, it would limit their ability to operate, to function as normal, and therefore to oversee the financial markets. But I did ask him, especially given some of the remarks he made during the debt ceiling fight we were in a few months ago, about the catastrophic impact for financial markets a default could have. I said, could we see significant market events emanating from a government shutdown? Should financial markets really be worried about this? He really kind of downplayed that part of it. He said, yes, Treasury markets are incredibly important. He said that is the very, very base of our capital markets. He said, however, that Treasury markets will continue to function, stocks will continue to trade. It's really just that oversight ability that would be impacted. He did say, though, that faith in the U.S. Treasury markets, the ability of the government to commit to spending, is very important. So just weighing in a little bit on the debate going on Capitol Hill, Matt.
Kaylee, great to check in with you. Thanks very much. Kaylee Lyons there in Washington. Still ahead, how the Fed interacts with, I guess, reporters in the press conference. That's one thing we're going to see at 2:30 because Jay Powell goes live. And how the Fed and its rate decisions affect the housing market. We're going to talk about that with our next guest, Brown Harris Stevens CEO Bess Friedman. This is Bloomberg.
There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
So the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Good morning, good morning. This is Bloomberg
Bloomberg Markets trying to open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg Markets. I'm Matt Miller. We are less than an hour away from the Fed's rate decision. The central bank is certain to keep housing on its radar as it keeps rates elevated. Let's talk about the housing market with Brown Harris Stevens CEO Bess Friedman. Bess, I always love to get your insight on this market. You are focused on New York. Is the city's market different, you think, from other markets in the country in important ways?
I mean, I do think there are differences. We are in Florida, in Palm Beach, in Miami. We're in Connecticut. We're in New Jersey. But, you know, New York City, where there is a distinction, is we have ample inventory. We're not as tight as places like Connecticut and Palm Beach. And so that's been part of the challenge. You know, once we see in a meaningful way where rates start to go down, then you'll start to see more sellers put their homes on the market, and then we'll have the inventory that we need in certain pockets of the country. But that's been like the chicken or the egg challenge right now. You know, the inflation is, you know, too much money chasing too few goods. And that's really what it's like in housing for the most part. And so people are kind of waiting, buyers and sellers. Buyers think, you know, I'll hold off until rates come down. And sellers are thinking, well, you know, rates have doubled and maybe I'll wait because if I buy a new home, I'm going to have to pay double what I'm paying now. So it's sort of a little bit of a waiting game.
Yeah, I can imagine, you know, people in homes with mortgages already would be loath to move just because you don't want to have a 3% mortgage and then move somewhere else at a 7.5%. Is it just rates coming down that's going to change that? Do you think if we went into a recession, you know, that stalemate would be broken as well?
I mean, it could. I mean, there are a lot of factors that impact the housing market. I think rates are paramount because roughly 65% of homeowners in the United States have mortgages. So when rates double, I think that's over a 20-year high. And even though it's not the highest they've been, we've seen them in the double digits. It's meaningful for people. So I think it's great news that we didn't enter a recession. I think it's also good news that Powell has decided to maybe skip another increase for the Fed fund rate. Maybe it'll be a stop altogether as we see sort of a period of a slowdown. The economy has proven to be really resilient, which has been a good thing in a way, but we do need a slowdown to sort of get inflation to where they're targeting.
Do you see a lot more cash deals, Bess? Because if you know you're moving in high-end circles, right? Greenwich, Manhattan, Palm Beach. A lot of those people can probably afford to do cash deals, and the numbers, the sums are too high for mortgages anyway.
Yeah, Matt, it's funny. I bumped into an agent this morning. We were chatting, and he was telling me he just did 3 different deals in luxury market, and he told me they were all cash. So, of course, the people that have cash are spending it now. And so we are seeing more cash deals, and we're seeing a decent amount of luxury sales happening. So that's a good thing. But I do think, you know, overall, people are impacted by what's going on with rates being higher. And there's not enough inventory. I mean, people want more things to choose from, and prices have really not come down overall to where they need to be. So that's sort of the trifecta of headwinds in housing right now. But as I was saying, it's a decent market. It's just not great, and it's slowed down. It's a bit of a sea change.
Bess, great to get your insight. I'm sure the Fed has Bloomberg TV on right now, so maybe we're having some effect on the decision that's due in just about 22 minutes. Brown Harris Stevens, CEO, Bess Friedman talking to us about the housing market. Coming up, the Fed decides. Special coverage at Bloomberg Surveillance's John Farrow and Tom Keene. This is Bloomberg.
person who's just been attracted to hair, I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening, because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
Live from the City of London for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz. Bloomberg Surveillance, The Fed Decides.
Live on TV and radio for our audience worldwide. Good afternoon. Good afternoon. The countdown to the Fed decision starts right now. 27 minutes away, TK. Your equity market slightly positive and yields very close to cycle highs.
Here from the fog of London, it's Dickensian out there right now.
It's surveillance after hours, TK.
Yeah, we're going to see if
we'll
get some clarity from Jerome Powell. He's dealing with the fog of the American economy. A lot of cross currents here. I'm really interested to hear what Kathy Jones says about what yields tell us right now.
Looking forward to that conversation, TK, and so much more. As you know, Thomas, a three-part act. Decision at about 28 minutes. Bunch of forecasts as well. Then on to the news conference about an hour away.
Well, the news conference is going to be different. And again, we're going to go to November. And what I saw from our guest this morning on surveillance was a real tendency to look to December. How does he frame in that press conference the forward view? The people in the room are less concerned with September and the dots. Okay, but I'll give you that, John. I don't care about the dots. But the answer is they're going to go to November and they're going to go to December.
Andrew Hollenhorst, Citi, looking for that hike in November. Hollenhorst joining us a little bit later. This is how the stage is set. The price action looks a little something like this on the S&P 500. Equities are higher by 0.2% on the S&P. Yields are backing away from cycle highs. We're down about 4 basis points today to 431.67. I've gone through the three-part act, the decision, the forecast, the news conference. This is the two-part act of this show. Going into that decision, coming up, Morgan Stanley's Jim Karen, Deutsche Bank's Matt Lazzetti, Kathy Jones of Charles Schwab out the other side after 2 p.m. when that decision drops. Here's the lineup for you. Citi's Andrew Hollenhorst, Diane Swank of KPMG, Jim Bianco of Bianco Research, TK, Greg Peters of PGIM.
It's going to be interesting to see. Jim Bianco's maybe the most holistic there, pulling in the markets with the economy as well. And I go back to the Arch Bianco call, now hugely prescient about the longer, and that inflation comes down to where we are and goes flat or even with a little bit of an uptick. At the time, that was controversial.
And the ultimate contrarian call that maybe yields just have to go higher from here.
Well,
hearing that from Jim, we'll ask that question to Greg Peters of PGIM.
Is this a buy in this bond market, TK, with the 10-year where it is, where the 2-year where it is currently as well?
It can break either way. And, again, I think Powell will give us some direction. He's going to be cautious. He's going to say, this is what we see now. But again, I'm going to go to the gaming out of this into November, December. And John, quickly here, that's going to come off those dot plots. That middle range here from the announcement to the press conference, the analysis by Mike McKee of those dots is key.
The median dot for 23, for 24, the growth projections, we're expecting them to mark to market. Essentially, growth has been better.
Yeah.
Their forecast might have to come up. Inflation may be a little bit softer, but I'm with you. Where do they see rates beyond November into next year?
Not expert at the dots, but certainly expert at the bond outcome. Joining us now to get us started on the special show from London is Jim Caron, to say he's Portfolio Solutions Group CIO at Morgan Stanley. Investment management's important. What you have to understand is after the physics of Bowdoin, the physics of Caltech, he knows the physics of Jerome Powell. I'm baffled, Jim. Is this meeting about today, or are you looking already to November and December?
Thanks, Tom. Look, I don't think this meeting is about today. As you put it, this meeting is about November and December and what he messages. Look, if we break it down this way, very, very simply, 2023 is about the Fed cycle coming to an end and them getting the job done to do enough to get inflation down towards target and keep it anchored there. 2024 is about holding rates higher for longer or potentially even cutting if economic conditions seem that it's likely that they need to do so. So the market will have no patience for rate hikes, further rate hikes in 2024, because if that's happening, then that means the Fed has missed something, inflation is accelerating, and that they're going to have to do something more drastic to bring inflation down. So I think if we look at this more broadly, we need to see in 2023 the Fed get the job done. So look, as far as the way that I see this meeting's all about positioning their potential policy act for November or even December.
I look at this, and the overlay to me is the good work of your Ellen Zentner, award-winning economics, and she's marked down GDP off revisions and some actual present numbers, and she's come down a fair amount, 0.5 percentage point of real GDP or even more. Are we on the edge of a stagflation here, where we pull in from an Atlanta GDP guess of 6%, where all of a sudden GDP slows down and changes the Fed decision?
So I think that, third quarter GDP is likely to be still, relatively strong and robust. In the fourth quarter, there's likely to be some give back. But I think Ellen's onto something here, though. I think the markets are going to start to read through this, and they're going to say, like, look, third quarter GDP, some good technicals, things are strong, but this might be the last big thrash in the economy before it really starts to slow down. Now, if we think about this from the Fed's perspective, this is what rate hikes are supposed to do. You're supposed to see a slowdown in GDP growth, a slowdown in inflation, slowdown in wage growth, and everything, and even housing and everything else. So the goal here for the Fed is to get inflation down and keep it anchored and keep it down durably. Just getting a slowdown or potentially even a mild recession, yeah, that could help in terms of bringing inflation down. But the point is that they have to keep it anchored, because what could start to happen if they don't is by the middle of 2024, the year-over-year base effects might make inflation start to reaccelerate higher. So it's imperative for the Fed to get inflation under control between now and the middle of 2024.
Jim, Bruce Kasman, JP Morgan, on the program with us a little bit earlier on this morning. Bruce Kasman said that 2024 projections were aspirational. They were aspirations. And the idea that we can get inflation back to target without doing real damage to the labor market is aspirational, fanciful. Jim, do you agree?
I do agree. Now, target is 2%. Do I think we're going to get to 2% and stay there? No. Will the Fed take a victory lap if we get between 2 and 3% and it shows that it's stable and it's not accelerating above 3? Yes. I think that what it would take for the Fed to actually get inflation at 2% and keep it there would probably be much higher policy rates and very likely a hard landing. I don't think that's what the Fed is aiming towards at this point. So I think we have to look at growth in 2024 as certainly slowing, we just can't see the acceleration of inflation. And I think, therefore, at that point, the Fed would likely be happy with their policy actions and likely be able to keep rates high. Look, just because rates are high and they're not cutting, it doesn't mean that they're easing. I mean, rates are still impacting the economy, and there's about a 9-month lag, and that is yet to be seen going forward. So I think that the work that they're doing in 2023 needs to have enough speed to keep momentum going to bring inflation down to last them through 2024. And that's why a November hike or a December hike is still likely on the table in their eyes.
Jim, I don't know what Chairman Powell says in the news conference about 50 minutes from now, but I can share with you, offer you a sneak peek at a Mike McKee performance in that press conference. Mike McKee told us this morning, this is the question he wants to ask: how much confidence do you have in anything that you are telling us today? Jim, when we hear the words of Chairman Powell, how much confidence does he have about the future?
I think he is making an educated guess like the rest of us. I really think that it's very, very uncertain right now. We're having a very unusual economic cycle at the moment. The unemployment rate has stayed very low. Wages stay relatively robust. So it's hard for us to think of having a deep downturn or a recession. Typically, at this point in the cycle, we would be really, really primed to have a deeper recession and everything else. The markets are just not functioning that way. So I think that the Fed's stance on this in terms of just being very, very cautious in terms of how they proceed is very, very important. So when the Fed says we're data dependent, what they're really saying is we're not sure. We're not 100% sure as to how things are going to develop and what our actions might be. I'm always going to go back to this one point, Jonathan, which is that the Fed needs to get inflation to a level that they're comfortable with. And to me, that's like 2.5%, maybe 3%, somewhere in there. But make sure it stays there, that it doesn't start to reaccelerate higher. So it gets anchored at a lower level. Anchored at a lower level. That's the absolute key. If it starts to reaccelerate, that's bad for everybody. And they just need to take the steps today to make sure that that doesn't happen in the future. And I think that's the balance of risks that they're playing with.
Hey, Jim, stay close, stick with us. This is great. Jim Kern there of Morgan Stanley. Jim's going to stick with us going through to that decision. Joining us in just a moment, Matt Lazzetti of Deutsche Bank, Kathy Jones of Schwab. Looking forward to those conversations. TK, the words of Jim Kern there, when he says, and he being Chairman Powell, says we're data dependent, to some extent he just means we don't know.
Well, they're back, and I go to the dual mandate. They're not only data dependent on what the job market does, which has been booming, everything considered, but also data dependent on a quieter GDP. And we really haven't seen a tepid U.S. GDP yet.
Looking forward to the Mike McKee performance in the news conference in about 50 minutes' time. 3-part act, you know it well. We're going to get a decision, some forecasts, and a news conference a little bit later this afternoon, all in the next hour. Live from London, this is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This
Fed will do what we all expect it to do.
So they'll pause.
Pause.
Hawkish pause.
A hawkish pause.
The pause, but an indication that they're prepared to do more.
They'll keep wide open the possibility of another hike.
Emphasize that November continues to be a live meeting.
One more rate hike has to remain on the table.
Chair Powell is going to say that they are remaining vigilant.
They'll make it very, very clear that they are still data dependent.
And they're going to push back against this notion that they'll be cutting anytime soon.
The big question mark is, are they going to do something in November?
What do they do November 1st, their next meeting?
I think that the Fed is done hiking rates.
We see inflation coming down.
They're going to raise rates in November.
The economy is still very strong.
It's a really tricky needle to thread in terms of doing just enough, but not too much.
November, we'll see what happens.
Whether this is going to be a skip or a pause is to be seen.
Well, it took us at least 15 minutes to say it, but we're saying it. Hawkish pause is what is widely expected, a phrase overused over the last month or so in anticipation of this particular Federal Reserve decision. If you are just tuning in, welcome to the program, live on TV and radio. This is a Bloomberg surveillance special counting you down to a Federal Reserve decision for the month of September. That decision is about 15 minutes away, and the price action is shaping up as follows in the equity market. On the S&P 500, almost totally unchanged. We're positive by about 0.1% on the S&P at the moment. On the NASDAQ, we're negative by 0.14. That's how the session is shaping up currently. Of course, that can all change with the decision in just a moment, alongside the forecast, together with a news conference from Chairman Powell, which starts in the next hour or so. Beyond equities in your bond market, it's amazing to see it all over again. Tom, we've talked about it, how we're slowly and then quickly internalizing this high for longer message from this Federal Reserve, with a 2-year still north of 5%, yields in this morning and this afternoon, and the 10-year still in the 430s, and the 30-year still around 440.
In 4 basis points on the 2-year at 5.05, as you mentioned, John, you were going back and forth with someone here earlier today on a 509 2-year yield. I think a huge body of people watching this Fed decide special haven't yet framed out a 509, or, you know, what money market funds do on the way up there, as Deborah Cunningham talked about.
It's amazing to see, Tom. And with that front end elevated, we've seen significant dollar strength come through over the previous several weeks. The euro at the moment just about holding on to 107. TK 107.26 on euro dollar.
As we near here 2 p.m. in New York and Washington, we have great conversation for you to frame out this moment. Kathy joins us, Chief Fixed Income Strategist Charles Schwab, Matt Lazzetti at Deutsche Bank, and we continue with Mr. Karen. Jim Karen joins us from Morgan Stanley as well. Kathy Jones, I want to talk to you about the real yield. To me, it's ending a real rate analysis. We really haven't done that since before 2007. Interpret how Jerome Powell and his team interpret a 1.96 10-year real yield. How do they handle that?
I think the way the Fed looks at this is as an evidence that they're tightening policy. So we haven't seen it play through in the credit markets. You know, credit spreads have actually fallen. And so the financial conditions indices have been relatively buoyant. But real yields matter a lot when you're talking about business investment or consumer spending. Ultimately, that real yield's very important. So I think the Fed is looking at that and saying, okay, inflation expectations have been anchored, but we've had almost all of this lift is coming in real yield. I think they're looking at that as, yeah, we're getting some of the tightening through in our interest rate policy, and it's maybe not in the credit markets, but it's certainly there in the real economy.
So Matt Lazzetti, let's build on what Kathy just said. Given all of that, are we sufficiently restrictive?
Yeah, I think the Fed thinks that we're close. You know, they are likely to show another rate hike this year. Our baseline is that they don't deliver on that ultimately we get enough evidence that the labor market and growth are slowing into the end of the year, that they don't hike in November, December. So we're at the peak at the moment. You know, I think you're beginning to see some evidence of it for the consumer. You're seeing delinquency rates rise. And at the time where you're seeing some of these headwinds hitting the consumer from higher gas prices, tightening of credit conditions, a return of student loan debt, I think these things will help them achieve the sufficiently restrictive stance that they're searching for.
Matt, you're always bravest guy in the street. You got a little narrow paragraph at the bottom of your note. On 2026, you think we converge to a normal economy, something like 2026. What is that real GDP number that you and Jerome Powell have to consider far, far out in 2026?
Yeah, look, I think there's substantial uncertainty about what the Fed's going to do through the rest of this year. There's meaningful uncertainty about 2024. There's a ridiculous amount of uncertainty about 2026. I think that is all kind of a messaging perspective from the Fed. It is, is the economy converging back to what they think the long-run values are? On their view, it's 1.8% for real GDP. I think from our perspective, there's upside risk to that as you look further out. Productivity growth from a tight labor market, I think, could be materially higher than what the Fed is currently pricing in. Your own view is that potential growth is above 2%. But look, that's mostly a messaging thing from the Fed's perspective at the moment.
You're better at this, John, than I am. Do we get 2026 dots today?
I think the long dot is interesting. That's going to be the conversation around where they believe neutral is, Tom, where we will be going back to. What does that trip look like? Yeah. I don't think Chairman Powell wants to have that conversation at the moment.
No, Matt Lazzetti does.
From Jackson Hole. But Kathy, to some extent, Mr. Williams over at the New York Fed has engaged in that conversation. When you look at the projections, Kathy, that come out in 10 minutes, beyond the decision, most people expect it to be unchanged. For growth, for inflation, the dot plot, what are you expecting to change? How does this shape up compared to, say, what we saw in July?
Yeah, excuse me. Sorry. I think we'll see the growth numbers revise up a little bit to reflect the third quarter bounce. And then the inflation numbers revise down a little bit because, we're starting to see that core PCE pass through to the downside. So those would be the big changes I would expect, but they're incremental.
Matt Lazzetti, I know that you've got to run. We've got about 50 seconds left with you. Can we just finish there as well, Matt? What you'd expect to change in the forecast, the projections we get from the Federal Reserve in 9 minutes' time?
Yeah, I think we know it's going to growth upgraded substantially. We think it doubles this year. Core inflation comes down a bit. I think really the focus should be on 2024. It's on, do they still expect inflation to be 2.6%? Do they still think that requires some pain in the labor market with the unemployment rate rising? And really, what does that 2024 dot look like? We think that it comes up by 25 basis points, that the Fed needs an even higher real Fed funds rate to achieve their objectives. But I think if we step back, if that is the hawkish message from this meeting, we've gone through a year where the hawkish message was upgrading the terminal rate, upgrading growth and inflation. If the real hawkishness that comes out of this is some view on 2024, I think that's a hard thing to sell to the market as a terribly hawkish message.
Matt Lazzetti, thank you for joining us today. And what a great call from Dr. Lazzetti that we saw where he said, yes, recession, but out there somewhere. No one was more prescient about that than Matt Lazzetti. Jim Caron is with us with Morgan Stanley. Jim, I look at all that we're talking about here, and it comes back to the physics of going back to a normal rate environment. Nassim Taleb, the quant, said the gravities return to the system. You're degreed in the gravity. Tell me the gravity, the physics that Jerome Powell has right now. Is it a 1994 physics?
I think we're getting close to it, right? So, these rates are high right now. They're not extraordinarily high, but they're high enough to put pressure and force down on the economy to continue with the physics analogy. So, yes, gravity is going to pull this down. Look, there's a lot of things. There are a lot of headwinds in 2024 from a policy perspective. Number one, the higher rate hikes are going to start to bite. Number two, the refinancing. People talk about maturity walls, that are coming up. It's going to be more expensive to do business. And number three, it's going to put pressure on valuations, right? So bond yields being higher, a Fed that's higher for longer, is going to continuously put pressure on just the broader markets, financial conditions, equity markets, I would even say. Just given the alternatives that investors have to invest in bonds with a higher, potentially more attractive yield as we move into 2024. Because look, as Matt was saying, there is a recession that's out there somewhere. Whether it's a deep recession or it's a mild recession, I'm in the camp it's a mild recession, but it's a slowdown. And I think that there's going to be a bigger balance between, when we think about asset allocation, between fixed income and equity.
As Jerome Powell goes into this press conference in 6 minutes, Jim Caron, is he a single mandate Fed chairman? Is he on the edge of Christine Lagarde?
Yeah, I think his primary mandate is getting inflation where it needs to be. I think the jobs market is structurally very strong for various reasons. The big thing that everybody's talking about, what we're all concerned about the most, is can the Fed get inflation towards an area that they're comfortable with in terms of their target? and keep it there. So yes, the Fed does have a dual mandate, as you pointed out. It's price stability and full employment, but I think the Fed is willing to risk it a little bit on the jobs front in order to get inflation down. So I hate to phrase it this way, but I think that a mild recession actually plays well in the Fed's calculus to get inflation down. So I think they're willing to push it and risk that in order to get inflation to target. So let's not call it a single mandate, but pretty darn close.
Do we call that a soft landing? Kathy, I'd love your view on that. We throw around these phrases. I don't know what they mean anymore. What is a soft landing to you, Kathy? What is it?
Well, I think it would be a slowdown in the economy and a reduction in inflation without a big rise in unemployment. And I agree with Jim. That's a tough thing to pull off. It's more likely we'll have some sort of a downturn in the economy if we really have a Fed that's determined to get back to that 2% target on inflation. So soft landing, seems like an aspiration, as you mentioned earlier. I think every Fed wants to accomplish it, but it's really hard to pull off.
Agreed. And I think a lot of people listening agree as well. Jim, one thing you've been fantastic at all year, I'm sure there's many, but I'll pick out one. You asked us to ask and really question what could go right this year. And when we think about risk, there is upside risk, not just downside risk. Jim, how are you thinking about that particular question now?
Yeah, look, I still think that there are upside risks. I mean, we're talking a lot about recession, but we also have to recognize that if it's a mild recession or if it's a soft landing of some sort, however we define that, earnings growth, when we think about bottoms up earnings, that's been rising. 2024 earnings around $248, $249 right now. Many people were forecasting that we would have sub $200 earnings, right? Multiples have held up reasonably well. I think what could go right is that the market looks through what could be potentially a mild recession and buys a dip quicker than what many people think. The number one question I get from a lot of clients is, I missed the rally, where can I get in? So there are a lot of people with dry powder that's looking to buy the dip.
Kathy, I want to give you the final word. What's the number one question you get from clients at the moment? Is it the same one?
The number one question I get from clients is, when do I extend duration? I've been sitting in cash forever and ever, and I want to extend duration because I want to lock in yields, but I'm afraid to move.
We hear that a lot too. Kathy, thank you. Kathy Jones, Jim Caron, your Federal Reserve decision about 3 minutes away. Said this a few times, three-part act. At the top of the hour, you'll get a decision from the Federal Reserve, a bunch of forecasts as well. Mike McKee's going to break that down for you. 30 minutes later, a news conference in Washington, D.C. with Chairman Powell. But TK, before we get there, you've got the meat of the statement and then straight to the forecast. I think for a lot of people, it's straight to the forecast.
The heart of the matter.
2023, how much movement are we expecting? Growth up, inflation down, maybe. Yeah. Show me the median dot. Do people start to nudge that extra hike away? Maybe a little bit. Does that change the median? Yeah. And then out to 2024.
I think the dots are the most important thing this time. I usually don't say that, but within that is the background news. Is he going to address a strike in Detroit? I believe as Jamie Dimon of J.P. Morgan will speak in Detroit today. Maybe he's already done that. We're a bit out of the time zone here, but I think there's a set of data and a set of global events right now, including China, that he has to allude to in this press conference. That's not seen in the dots. The dots are a pure U.S. guess. There's more going on than the dots.
So Andrew Hollenhorst of Citi is going to join us in the next 30 minutes or so. Andrew put out a note, publishing with the team a little bit earlier, Citi Economics, and they made 3 points, TK. One is the strikes with UAW. Yeah. The second was oil. And the third was house prices. I would pick up on oil and throw in China. Tom, yeah. Oil and China were believed to be tailwinds at the start of the year. Energy was coming in, China was reopening. Are they headwinds now at the back end of 2023? Most people would assume they are.
What they are, and this goes to data dependency, there's something that's happened in the last 14 days. Maybe it's 20 days, I'm not keeping at count. But this surge that we've seen in oil, with Javier Blas looking at Saudi Light near $100 a barrel. I saw a 97 quote on Saudi Light spot, I think 48 hours ago. That's new, and that's new for the people. The Eccles building, they are data dependent, but it's just not economic mumbo jumbo. It's what's going on in the rest of the world, including China.
Neil Dutta of Renaissance Macro wants the last word going into the Fed decision.
He's one of our best guests.
Dutta writes in, this is wish casting from the Fed. They are wish casting a soft landing, but the reality of 2023 is that we have not landed at all. We're running at an above trend cruising speed. We'll get the forecast from the Federal Reserve in about 20 seconds time alongside that Fed decision. Going into it, the price action looks like this on the S&P 500, positive by 0.2%. On the NASDAQ, almost totally unchanged. To the bond market, yields on a 2-year shaping up as follows. Near, in and around 5% on a 2-year in America, 5.05%. Mike McKee has the decision.
This is the very definition of a unanimous hawkish pause. The Fed leaves rates today in the range of 5.25% to 5.5%, while saying growth is solid and inflation elevated. So, higher for longer. Policymakers leave another rate move on the table for this year and take 2 reductions off the table for the next 2 years. The statement once again discusses, quote, the extent of additional policy firming that may be appropriate. And the dot plot shows that 12 members of the Open Market Committee still believes they will raise rates by another 25 basis points this year. The high dot at 6.25% comes out of the dot plot with St. Louis Fed's Jim Bullard's retirement. For 2024, the committee now sees a median effective Fed funds rate of 5.1%, up 50 basis points from their June projection. And for 2025, 3.9%, up from 3.4% in June. The long-run neutral rate is unchanged at 2.5%, although the central tendency range moves up to 3.3% from 2.8%, and the dots show 7 members think that neutral is higher than 2.5%. All this because the Fed sees stronger growth, lower unemployment, and lower core inflation ahead. The economy should grow 2.1% this year, they say. That is up from 1%, their June forecast, more than doubling. They say next year growth will be 1.5%, up from 1.1%. Unemployment will finish this year at 3.8%, down from their June forecast of 4.1%, and the next 2 years end at 4.1%, down from 4.5%. PCE headline inflation will be 3.3% this year, up 1/10, basically on energy concerns, but their core PCE forecast falls to 3.7% from 3.9%. Next year, it falls to 2.6%. And one final note, no change in QT, no change in the IOR or repo rates.
Mike, stay close. I'm just going to work through the price action. So off the back of this decision, we're negative by, let's call it 0.2% on the S&P 500. As you might expect, the NASDAQ underperforming. If you turn to the bond market, yields were lower almost across the curve at the front end as well. They're now higher by 3 basis points. Looking at, staring in the face of the potential of closing at new cycle highs on the front end, 5.1287 turns to 5.13 on a US 2-year. So yields up, new cycle highs at the front end of the curve, and the dollar off the back of it a whole lot stronger. The euro against the dollar, 106.89 on the session, positive still by about 0.1%, but certainly off the back of that decision, a stronger US dollar. Mike McKee, I want to come to you on that median dot for 2024. Are you basically telling me the Fed took back half the cuts that were priced for 24 in their previous projection?
That's basically what I'm telling you, John. They were looking at 4.6%, and now they've gone up to 5.1%. Clearly, they think the economy is strong enough that they may need to do more. At least that's the message they want to send to the markets.
Mike McKee, I look at the growth forecast. You went through them quickly. Maybe they don't make the headlines. I think they should. Frame out again their growth vision. As Neil Dutta says, they're wish casting for 2024.
Well, the biggest change is 2023. This year, obviously, the way things have been going, they need to mark up growth for this year. They call it solid. 2.1% is their final growth. But growth next year is 1.5%. That's up from 1.1%. That's a fairly strong change. So they do see perhaps the wish casting that Neil is talking about. The idea that growth can be stronger into next year, and it does certainly suggest the idea of a soft landing.
I look, Michael McKee, at where we are in this, and it gets to November and December. I know your first question to the chairman will be, tell me about November. Mike McKee, tell us about what this translates into for the next meeting.
Well, it's definitely going to put the markets on guard, depending on what kind of data we see, especially in the inflation numbers. The Fed's acknowledging that we're going to see a little bit higher headline, a little bit lower on the core. And if that's what we get, then the Fed could decide to raise rates. It's hard to know exactly because of the energy components that are coming into this, but that's what to watch for when we get the CPI and PCE numbers. The other, of course, joker in the pack is if the government does shut down and there is no data, the Fed will have to use its own kind of methods to figure out where it thinks inflation is.
Mike McKee, thank you, sir. We know you've got to run and get to that news conference. Mike McKee's going to sprint to that. It begins in about 25 minutes' time. Just to go through the forecasts again, that is a monster upward revision to GDP. But they're market to market at the Federal Reserve. So they go from 1% to 2.1 for 2023. Tom, the story for me is out in 2026. The story for me on unemployment, they've got it at 4% and PCE back down to 2%. All the way out there, several years away, and this is the aspirational, fanciful stuff that this is how it's going to happen. Unemployment for this year, by the way, 3.8% is the forecast now, and it only climbs to 4.1% next year. Bruce Kasman talked about this a little bit earlier this morning at JP Morgan. Tom, how high does unemployment need to go to get inflation lower? That's going to be a question we could explore in the next 25 minutes or so. But the Federal Reserve is telling you that they can get back to target 2% in several years' time, and unemployment's going to be in and around 4%.
I'm going to go with Duddy here and combine it into what Matt Lazzetti said. I got lucky in that I picked out of Matt Lazzetti's note his first look at 2026. I don't even know if there's a first look to first quarter 2024. The uncertainty here off the pandemic, off the shift from a supply analysis to a demand analysis of the economy, and that's a pretty clumsy move. John, looking out to 26 now, maybe they're forced to do that, but boy, that's a tough thing to do. Let's do this, and we're very lucky today to do this because we can fold in what you're all reading and feeling about the strike in America. Diane Swank is steeped, I should say, in Midwest economics, her tenure at Bank One, and of course her academics at Ann Arbor. Andrew Hollenhorst with us as well. Diane Swank, I guess Chairman has to mention the strike today. How do you fold strike analysis into the chemistry the Fed has?
It's really tough. I don't think it. First of all, the strike is very targeted. We'll see over this weekend how far the strike gets. I think many people are worried about how long the strike will last, and that is important. It both suppresses economic activity, of course, constrains inventories, but it's constraining inventories in a different way than the chip shortages did. So I'm not as worried about vehicle prices being the push on inflation that they were, that some people are, given that this is a more limited kind of production hit, and it actually gives market share to other producers out there. At the same time, demand has fallen quite dramatically for new vehicles because financing rates have gone so high. I think what's really important in what the Fed just did was the whole concept of higher for longer, much higher for longer, and potentially a higher neutral rate on the other side of this. This is what the theme was coming out of Jackson Hole Symposium, was how synchronous the idea of higher for longer mantra is across the developed economies, that even as we approach this peak in interest rates, that the central banks are emboldened because of the resilience that we've seen even in those economies that have suffered recessions, have not been as bad as they expected, that they are emboldened to hold rates higher for longer. And there is a concern on the other side of this that they're going to need a higher neutral rate. This is a different world than the world that we left in 2019.
Far different, far different. Andrew, at the start of this hiking cycle, we asked a pretty important question. Can we get inflation down to target without doing too much damage to the labor market? Overwhelmingly, people said we couldn't. We've made some progress without killing off the labor market. The Federal Reserve today, Andrew, is extrapolating that out. How hopeful, Andrew, is that forecast?
I think that's the big question that these forecasts raise. You have 2023 growth revised materially higher. You have that strong growth continuing into 2024 now in their forecasts. So you have an economy that's running at or above potential. You have an unemployment rate that's historically low. And yet we're meant to believe that wages and prices will cool in this economy. This just contradicts basic macroeconomic theory. So this is a forecast that does not line up with traditional ways of forecasting the economy, with the relatively intuitive idea that when labor markets are very tight, that pushes up wages. And when labor costs are rising, that pushes up prices. So I think this is a difficult forecast to square with the reality of how economies behave. That's to be addressed at a later point. I think what the Fed did today makes sense in the sense that we're running strong growth, we're running inflation that's above target, so it makes sense to guide towards higher for longer. So they achieved the hawkish skip. If that was the intent, that's achieved. I think in terms of the forecast, there are some real questions that need to be answered.
The hopes and dreams of these forecasts, Dan, let's sit on it. I remember a word that you used maybe more than a year ago. You referred to the forecast from the Federal Reserve as fanciful. Aspirational was a word we heard again this morning, repeated through this afternoon. Dan, when you look at these forecasts further out, do you think it's the right approach to extrapolate out current dynamics, which essentially is the following: inflation can come down, can come in further without doing real damage to the labor market?
I think it's a great idea, and I hope they're right. I do think it is still fanciful. One of the things that I think that the Fed is betting on is that we are seeing the high-frequency data as the labor markets have cooled. This has been one of the most dramatic, frenzied pace of a labor market and then cooling that we've ever seen, with unemployment still very low. And what they're counting on is the high-frequency data on job postings shows that wages are slowing even more rapidly as we go into fall. So they're betting on those things, helping them. At the same time, we haven't seen in decades as many strike actions as we're seeing right now. And that's where things like the current strike with the UAW, the strike that we're seeing in healthcare, the strikes that we're seeing ongoing with the actors and the writers union, those things will have an impact. And how much we see the cost of living adjustments baked into contracts going forward is going to be very important. Remember, with the pop in energy prices, we're going to see an increase. The September CPI is what sets the numbers for Social Security bump in January.
Right.
That's one of the reasons. It's going to be a higher bump now. That's one of the reasons we had stickier inflation at the start of this year. And so that could be a sticking point and be harder for the Federal Reserve.
Andrew Hollenhorst, you need a victory lap right now. We got a 5.13% two-year yield. I've got a 10-year real yield any moment to pop through 2%, 1.99% right now. How does our economy, how does our business society, how does it adapt to a 2% real yield? Is that a signal of buoyancy and resilience, or is that a signal of trouble to come?
You know, we've seen the economy a lot more resilient to higher interest rates than I think many people expected at the beginning of this rate hike cycle. And part of that is that a lot of the debt that's out there is fixed rate debt that doesn't mature for many years. You think about 30-year fixed rate mortgages, many of those are still at lower rates. You think about some of the corporate borrowing that's taking place, and that also hasn't all been refinanced yet. So as that debt is refinanced, you start to have people, individuals, and firms experiencing higher rates. That should slow the economy. You see credit that's tightening. So there is a sense that this is slowing the economy, but it has to be sustained. And I think that's the message in the dot plot.
For Bloomberg Radio Worldwide, bring up the chart again on television here that we just put up with a two-year yield back to before the pandemic. And this is an arch call by Hollenhorst, and Swank was very good at this as well. Andrew Hollenhorst, we're back to yields that I remember and Diane Swank doesn't remember. The consensus belief out there is, OMG, we're all going to die with this yield structure. We're going to a 6% two-year Hollenhorst yield. Are we all going to die?
Well, remember the 2005 to 2007 period. This was an extended period of time when the economy performed relatively well and we sustained higher yield levels. And it wasn't that long ago, but it just feels like a long time ago, and many people haven't experienced that yield environment. So I think this is kind of rediscovering that economies can continue to grow, continue to produce inflation at higher yield levels. Eventually, these levels may be restrictive enough, sufficiently restrictive in the words of the Fed, to cool the economy, but that's a process that can take time.
Diane, you're one of the best at this. Give Mike McKee a little bit more help. What's a question for Mike for this chairman in this news conference that starts in about 15 minutes' time?
I really want to know about how they're so optimistic about growth for next year, given some of the headwinds that we face going into next year, everything from higher oil prices to student loan repayments, and the additional tightening that they expect in the pipeline, not only in the banking sector, but more broadly. So, that 1.5% is really pretty stunning, with 0.5% higher on short-term interest rates. That's remarkable resilience with the cooling of inflation, and I'm just trying to square how that all comes together.
Yeah.
Oh, Diane, we all are. We're trying to figure this out. Diane Swonk there and Andrew Hollenhorst, two of the very best on the Federal Reserve. That news conference starts in 15 minutes. If you're just joining us, welcome. Special coverage of the September Federal Reserve decision live on TV and radio, a Bloomberg surveillance special alongside Tom Keene. I'm Jonathan Ferro. The decision, unchanged, no change on rates of the Federal Reserve. The focus on the projections of this Fed, a monster upgrade to GDP for this year, in many ways marking to market. No news there. We understood that growth was better than expected through much of this year. They understand that now. The new projection is 2.1%. The old projection was just 1%. An upgrade to the GDP forecast as well for next year too, for 2024. That goes from 1.1% to 1.5. Some of the projections elsewhere are pretty fascinating. 12 of the 19 officials on the FOMC still forecasting, plotting an extra hike this year in 2023. In 2024, the median dot, we priced out half the cuts they had projected in the previous set of forecasts. But ultimately, it's the soft landing hope and dream. The decision, Tom, today is to extrapolate out current conditions. The idea that we can get back to target, all the way back to 2%, without seeing unemployment climb much higher than 4%.
We had a banner up moments ago on television here, and I did the quick nominal GDP math. And this is basically out 24 months, out 36 months, out to when we turn into a pumpkin. John, it's simple. They're looking at 4% nominal GDP or lower. And there's a lot of people looking at the spirit of this economy saying that with this inflation that maybe strengthens the economy. And it's to bust Bramo's chops, it's a toxic brew.
It is a toxic brew. But for them right now, there's nothing toxic about those projections.
I can't get out to 25.
Max Kettner, we said Max Kettner, HSBC, he started talking, and we said, that sounds like Goldilocks forever.
Yes.
Aren't those projections Goldilocks for the next 12 months?
I would.
The rest of this cycle?
I would say so. And what's interesting here, folks, we're coming to you from London, is, those of you on TV can tell the sunset is spectacular tonight. I went out on the sidewalk in the rain here, the lovely afternoon rain.
How did that work out for you?
Of London, practicing for Bank of England tomorrow. And this jumble that we're seeing right now in America is the same exact theoretical jumble we're going to see tomorrow with the Bank of England. These people are making it up as they go.
Let's turn to the price action and see how much Chairman Powell has to say in the news conference that starts in about 13 minutes. Your equity market totally unchanged on the S&P, slightly negative on the NASDAQ, but this move in the bond market, Tom, let's sit on that. The 2-year cycle highs.
Yeah, that's a key thing.
Through 5.1%, just like that, up by 3 basis points on the session, Tom. Yield on the 10-year, not much price action there, 434. 30-year, let's call it 440 TK on the long bond.
Let's bring it in right now. This is very important. PGIM's Greg Peters with us on yield, and Jim Bianco with us with Bianco Research. Jim, let me go to you right away. I just think this is so important. There's a sense of longer. I see a nominal GDP call out 24 months, which is not longer. It's that finally rates come in. Do you buy it?
Well, I buy the idea that you want to be looking at GDP, nominal GDP, as being a benchmark for long-term interest rates, but I'm not buying this idea that nominal GDP is going to fall to the levels that they think. If I was to describe, this confusion that we seem to have about this Fed policy, they're almost arguing that nothing of significance happened in 2020 and that we're going to return back to normalization, the word we like to use that's replaced transitory, and go back to something between 2010 and 2019 where we can have 2.5% real growth, 1% to 2% inflation, 4% nominal growth, and that would bring everything down and you'd have Goldilocks forever. But I'm not so sure that that's the case. I think that the economy has changed since the shutdown restart in 2020, and The Federal Reserve is still struggling to come to grips with that, and they're still thinking we're still in the last cycle.
Greg, you've got to work with real money here. The decision to extend duration, to find the belly of the curve, all the other professional stuff you do at PGIM. Does the language and the nuance of the forecast and the dots, does that change your conviction in what you're doing with your portfolios?
Well, I would say that we're finally getting what we've been thinking for quite some time, and that is higher for longer, right? The markets have been raging against this notion that rates will remain high. All the forward curves are pointing down, the dot plot pointing down. So I think this really throws cold water on that. And so for us at PGIM, we really think it's a higher for longer. We never felt the need to jump into duration. Maybe it's closer to that now, but more in the back end of the curve. So, look, I mean, I think the Fed delivered exactly what they wanted to, provide a hawkish sap that allows them to speak more dovishly and perhaps not move rates higher here.
Greg, it's not just the high for longer message that jumps off the page of the SCP. It's the growth inflation mix looking out a year, 2 years, that they believe you can get back to target 2%, and unemployment's going to drift higher, maybe to 4%, and basically stop there. Greg, that has big implications for how you invest elsewhere, beyond rates, bonds, and to credit. Is that your outlook, that basically we can achieve back to target inflation, barely shaking up the labor market in any way, shape, or form?
Well, it is very aspirational. There's no doubt about it. I mean, that is a Goldilocks type of outlook. If you have an environment where, rates remain higher, but growth is quite robust and inflation's coming down, I think that is a fantastic investing backdrop. I do think we're pretty close to it. The challenge, of course, on the table is all these different uncertainties and cross currents, and that has not gone away by any stretch of the imagination. So, we need to take these forecasts with a grain of salt. There's no different than our own forecasts, right? They're rife with uncertainties, but I do think there's a distinct possibility here, at least directionally, and I feel pretty good about the outlook.
Jim Bianco, do you feel pretty good about the outlook?
If we're talking about the outlook about the Fed, I have my issues with it like everybody else, but to feed on something that Greg just said, let's be real. We all have forecasts, and most likely they're all wrong, but that's okay because we're not being expected to predict the future. The key is whether or not we can adjust. We can see that, okay, the data's coming in not as we expected, and we need to adjust these forecasts. Now, the Federal Reserve in the last couple of years has not had a good track record on that. We can all remember transitory. And what I'm afraid of with this Goldilocks forecast is when the situation comes in that it's not panning out, they're going to dig in their heels and continue to say it will, and they might wind up making another transitory type of mistake in 2024. I'd like to see Chairman Powell, show some flexibility with these forecasts to say, look, this is what we think now, but if the circumstances and data comes in soon, that's out the window and we're going to adjust. And that, like I said, that is okay. That is what you should do with a forecast, not just keep at it because you're afraid of some embarrassment of having to change it.
Jim Bianco, the laureate Paul Krugman, with a wonderful essay on disinflation, and he really emphasized what the Fed doesn't look at, which is plain vanilla inflation. Are they just in the fog of London, in the fog of Washington, the fog of across America, are they missing a disinflationary tendency in place?
I don't necessarily think they are missing a disinflationary tendency. I happen to be in the camp that inflation on a year-over-year basis, I'm talking about headline CPI, has bottomed for the year. It's going to drift towards 4%, not much higher than that.
Wow.
Energy prices are going to be a big factor in that drift higher, and that will be enough maybe to give us that one more rate hike that they're looking for, and to at least justify going from 4 to 2 cuts next year. And I think that if that continues, that the December update of this plot will probably take those 2 cuts away as well. So I'm in that inflation is sticky camp, and that the Fed is going to have to come to the realization that they're not going to get close to 3%. So the disinflation that they're hoping for, that inflation comes down, the unemployment rate could stay at 4, it's been described here as fanciful, and I would also be in that camp too, that it is fanciful, and we'll have to see whether or not that type of situation unfolds.
John, moments ago, rounded up the 10-year real yield to 2%. This speaks to Dominic Constantine-Mazzuo's idea of we are restrictive.
Forgive me for thinking out loud, gents. There's a very, very simplistic approach to markets. You get economic information, data. You think about what it means for the Fed, and you trade accordingly. Now, Greg, I wonder if that's just changed off the back of these forecasts from the Federal Reserve. And let me go one step further and explain why. The first Friday of the month, we'll get a payrolls report. And if that payrolls report is hot, typically we'd sit there and say, well, labour market pressure, higher inflation, Fed has to do more work. But Greg, hasn't the Fed just told us, haven't they just de-emphasised the importance of the labour market to the inflation conversation?
Jonathan, I think that's putting way too much emphasis on the SEP and the forecast. I mean, at the end of the day, we're in this data-driven world. The Fed is trying to balance that out. And I think the markets, given the fact that we're in this data-driven world and we're not getting what we're wanting in terms of clarity out of the Fed, we're relying a little too much on this data release. So I don't think anything changes. I think if the data change, I think the Fed policy changes. And, it's also important to remember two things. One is that, they don't have inflation going down to, 2% until 2026, which is, quite some time from now. And then two, we just had a massive revision of GDP in this year. So, let's use that as kind of a reminder that forecast error is really quite high here.
Jim, what are your thoughts on the same question?
Yeah, if I could give you a cynical thought, that is that let's see if we even get a payroll report on October 6th, because if we have a government shutdown, the BLS is closed, and Mike McKee's sitting in front of an empty building on that morning. So leaving that aside, I do think, though, that if you're talking about the payroll report, the consistency about it it's been much stronger than we've been looking at for the last 14 to 18 months or so. All but something like 2 or 3 of the reports have been above consensus. And that seems to be the trend that I would think would stay in place. And if we see those kind of numbers come in, it's going to push everybody firmly into that, away from that Goldilocks and into that higher for longer camp as well.
We got to make some money to get home here, John Farrow. Ian Lingen, the screaming buy of the 10-year yield, just says this is a Fed doubling down on soft landing. Mr. Lingen, of course, at BMO Capital. Greg Peters, if they're doubling down on soft landing, for you at PGIM, is the 10-year yield a screaming buy?
No, I don't quite understand that logic, to be honest with you. I mean, what that would presuppose is that you'd have a healthy dose of cuts in response to that soft landing. So no, I think yields are relatively range bound here. I don't really see a big move either way. Yeah, it does look a little oversold. There's some technical dynamics, but ultimately on a medium-term basis, it looks pretty fair value to us. So I don't think the bond market, investing in the bond market is not about capital appreciation. That is a pre-pandemic trade. It is about roll and carry. And so, no, I don't expect it as a screaming buy.
With that in mind, Greg, if there's a pool of money, people sitting at home right now, they're sitting on the front end, they've been told by a couple of people that they should worry about reinvestment risk in the next 6 months and allocate accordingly further down the curve. Are you saying relax, patience, you're fine where you are?
Yeah, so I've been saying that the whole time. No one wants to listen to it, right? I think there's been this tendency to jump back into the pool because these higher rates are going to evaporate. What the Fed has told you today, what the markets are finally starting to respond to, is that no, these rates are actually around here for a while. So, so I don't think there's any reason to rush. And so we like duration, but we wouldn't go hell's bells. Sorry.
And let's fold this into Jim Bianco. I mean, John, it's just simple. Bianco was way out front with this idea of defining what longer looks like with a 10-year yield, and he's in the camp with Greg Peters.
Hey, Jim, this was great. Jim Bianco, together with Greg Peters. Thank you, guys. Going into this Federal Reserve news conference with Chairman Powell in about 90 seconds' time. I can tell you the 2-year, the high of the session, 514.80. We've backed away since then, Tom. We're up by 2 basis points to about 511 at the front end of the curve.
For those keeping score, the third week of August 2007 is when the follies began. And there is a headline in the Bloomberg now of a 2-year yield back to 2006. Lapels were wider in 2006. John, I can honestly say, I guess I would, say historically, someday you're going to revisit 2006. Did I think we'd see it off this pandemic now? Never.
At the front end of the bond curve?
No, this is a big deal. And again, I'm going to go, folks, from the nominal yield that we're all living. What does this do to mortgages? And I'm going to go to the real yield analysis, printing 1.99 up to 2% right now.
We've spent 30 minutes or so, Tom, talking about these forecasts from the Federal Reserve. Any moment from now, Chairman Powell's going to walk into the room, stand behind that podium and deliver his statement and take some questions. On those forecasts, let's reflect on the Mike McKee question of the day. How much confidence do you have in anything that you were telling us today? Well, and Greg Peters said it. We're putting too much emphasis, Tom, on those forecasts from this Federal Reserve.
This is the Latin mumbo-jumbo of ex ante and ex post, and there's never been this much ex post, this much data dependent. I think we're going to hear that across 3 central bank meetings through the week here in London. These people are living ex post because of pandemic, because of a massive fiscal stimulus in the United States, not in every jurisdiction, a war in Ukraine, the endless litany that we have. But the heart of the matter is we're ex post.
The Chairman Powell walks into the room at the Federal Reserve on the September decision.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we're in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. And so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%. Based on the Consumer Price Index, or CPI, and other data, we estimate that total PCE prices rose 3.4% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses. In light of how far we have come in tightening policy, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June summary of economic projections, the median projection is unrevised for the end of this year, but has moved up by a half percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. What makes the committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive, especially when officials are forecasting a slightly more benign inflation outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government shutdown, the end of federal childcare funding, resumption of student debt payments, things of that nature.
So I guess I would characterize the situation a little bit differently. So we decided to maintain the target range for the federal funds rate where it is at 5.25% to 5.5%, while continuing to reduce our securities holdings. And we say we're committed to achieving and sustaining a stance of monetary policy that's sufficiently restrictive to bring down inflation to 2% over time. We said that. But the fact that we decided to maintain the policy rate at this meeting doesn't mean that we've decided that we have or have not at this time reached that stance of monetary policy that we're seeking. If you looked at the SEP, as you obviously will have done, you'll see that a majority of participants believe that it is more likely than not that it will be appropriate for us to raise rates one more time in the 2 remaining meetings this year. Others believe that we have already reached that. So it's something where we're not making a decision by deciding to about that question by deciding to just maintain the rate and await further data.
So right now, it's still an open question about sufficiently restrictive. You're not saying today that we've reached this level.
We're not saying, no. Clearly, what we decided to do is maintain the policy rate and await further data. We want to see convincing evidence, really, that we have reached the appropriate level, and we're seeing progress, and we welcome that. But we need to see more progress before we'll be willing to reach that conclusion.
And just on the 2024 projections, what's behind that shallower path for interest rate cuts and the need for real rates to be 50 basis points higher?
Right. So I would say it this way. First of all, real interest rates are positive now. They're meaningfully positive. And that's a good thing. We need policy to be restrictive so that we can get inflation down to target. Okay? And we're going to need that to remain to be the case for some time. So I think, remember that of course, the SEP is not a plan that is negotiated or discussed really as a plan. It's accumulation, really, and what you see are the medians. It's accumulation of individual forecasts from 19 people, and then what you're seeing are the medians. So I wouldn't want to, bestow upon it the idea that it's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected, stronger than I think everyone expected. And so what you're seeing is this is what people believe as of now will be appropriate to achieve what we're looking to achieve, which is progress toward our inflation goal, as you see in the SEP.
Thanks. Let's go to Rachel.
Hi, Chair Powell. Rachel Siegel from The Washington Post. Thanks for taking our questions. How would you characterize the debate around another hike or holding steady? Is it discussion around lag times, fear of too much slowing, too little slowing? Could you walk us through what this disagreement was about at the meeting?
Yeah, so the proposal at the meeting was to maintain our current policy stance. And I think there was obviously unanimous support for that. But this, of course, is an SEP meeting, and so people write down what they think. And you have some, you saw, I think 7 wrote down no hike at this meeting, or between now and the end of the year, and I think 12 wrote down another single hike in one of the next 2 meetings that we have between the end of the year. So it wasn't like we were arguing over that. People just stating their positions. And really what people are saying is, let's see how the data come in. We want to see, what we want to see. We want to see that these good inflation readings that we've been seeing for the last 3 months, we want to see that it's more than just 3 months, right? We want to see, the labor market report that we received, the last one that we received, was a good example of what we do want to see. It was a combination across a broad range of indicators, continuing rebalancing of the labor market. So those are the two things. Those are our two mandate variables, and that's the progress that we want to see. But I think people, they want to be convinced. They want to be careful not to jump to a conclusion really one way or the other, but just be convinced that the data, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks and make these decisions meeting by meeting.
I see. And in your view, I know nothing has been decided yet, but what would one more hike at the end of the year do to the economy or to inflation? And on the other side, what would no hike do, if you could sort of game that out for us?
So, you can make the argument that one hike one way or the other won't matter, but for us, we're trying, obviously as a group, it's a pretty tight cluster of where we think that policy stance might be, but we're always going to be learning from data. We've learned all through the course of the last year that actually we needed to go further than we had thought. If you go back a year and what we wrote down, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get. It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, we need to get to a place where we're confident that we have a stance that will bring inflation down to 2% over time. That's what we need to get to, and we've been moving toward it. As we've gotten closer to it, we've slowed the pace at which we've moved. I think that was appropriate, and now that we're getting closer, we have the ability to proceed carefully.
Thanks. Let's go to Steve.
Steve Leishman, CNBC. Mr. Chairman, I want to return to Colby's question here. What is it saying about the committee's view of the inflation dynamic in the economy that you achieve the same forecast inflation rate for next year, but need another half a point of the funds rate on it? Does it tell us that the committee believes inflation to be more persistent, requires more medicine effectively? And I guess a related question is, if you're going to project a funds rate above the longer run rate for 4 years in a row, at what point do we start to think, hey, maybe the longer rate or the neutral rate is actually higher? Thank you.
So I guess I would point more to, rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity, I would say. So if I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates, we have to do more with rates, and that's what that meaning is telling you. In terms of what the neutral rate can be, we know it by its works. We only know it by its works, really. We can't the models and that we use, ultimately you only know when you get there, and by the way the economy reacts. And again, that's another reason why we're moving carefully now, because there are lags here. So it may of course be that the neutral rate has risen. You do see people. You don't see the median moving, but you do see people raising their estimates of the neutral rate, and it's certainly plausible that the neutral rate is higher than the longer run rate. Remember, what we write down in the SEP is the longer run rate. It is certainly possible that that the neutral rate at this moment is higher than that, and that's part of the explanation for why the economy has been more resilient than expected.
Howard Schneider with Reuters, thank you. So you've said several times that the economy needed a period of below-trend growth to get inflation consistently back to 2%. You kind of get that in 2024 a little bit. 1.5% is just a touch below what's the estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you think the economy works? a change in the mix of supply healing versus demand destruction that's necessary to achieve this?
Yes, of course, it is a good thing that we've seen now meaningful rebalancing in the labor market without an increase in unemployment. And that's because we're seeing that rebalancing in other places, in, for example, job openings and in the jobs worker gap. You're also seeing supply side things. So that's happening. I would say, though, I still think, and I think broadly people still think that there'll have to be some softening in the labor market. That can come through more supply, as we've seen as well. Also, remember, the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for that's a way for the labor market to achieve a better balance. So all of those things are happening. You're right. In the median forecast, we don't see a big increase in unemployment. We do see an increase. And but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing, is progress without higher unemployment for now.
So just to boil that down for a second, we've gone from a very narrow path to a soft landing to something different. Would you call the soft landing now a baseline expectation?
No. I would not do that. I would just say, what would I say about that? I've always thought that the soft landing was a plausible outcome, that there was a path, really, to a soft landing. I've thought that, and I've said that since we lifted off. It's also possible that the path has narrowed and it's widened, apparently. Ultimately, this may be decided by factors that are outside our control at the end of the day. But I do think it's possible, and I also think this is why we're in a position to move carefully again. That we will restore price stability. We know that we have to do that, and we know the public depends on us doing that, and we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve, which is an extended period, sustained period of strong labor market conditions that benefit all. We know that. The fact that we've come this far lets us really proceed carefully, as I keep saying. So I think that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me to do that.
Nick Timmeros of the Wall Street Journal. Chair Powell, both you and Vice Chair Williams have indicated that sufficiently restrictive will be judged on a real rather than nominal basis, implying some scope for nominal rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
I mean, yes, we understand that it's a real rate that will matter and it needs to be sufficiently restrictive. And again, I would say you know sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates. And so what are we seeing? We're seeing, through a combination of the unwinding of the pandemic-related demand and supply distortions and monetary policy's work in suppressing demand or alleviating very high demand. The combination of those two things is actually working. You're seeing, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects of it in non-housing services as well. So we think that is working. And I think as we've said, we want to reach that. We want to reach something that we're confident gets us to that level. And I think confidence comes from seeing enough data that you feel like, yes, okay, this feels like we can for now decide that this is the right level and just agree to stay here. We're not permanently deciding not to go higher, but we would, let's say, if we get to that level. And then the question is, how long do you stay at that level? And that's a whole other set of questions. For now, the question is trying to find that level where we think we can stay there. And we haven't gotten to a point of confidence about that yet. That's the stage we're at, though.
But it looks like because there was an across-the-board drop in the core PCE inflation projection for this year, and even then it seems possible the core PCE inflation could come in even lower than the median at 3.7%. Would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
The decision that we make at each meeting, and certainly at the last two meetings this year, it's going to depend on the totality of all the data. So the inflation data, the labor market data, the growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be trying to reach a judgment over whether we should move forward with another rate hike overall, and whether that would increase our confidence that yes, this is an appropriate move, and it will help us be more confident that we've gotten to the level that we need to get to.
Thanks, Chair Powell. Following up on Nick's question, actually, John Williams, the New York Fed president, obviously has said things to the effect of next year, as we see inflation, kind of again to Nick's point, as we see inflation coming down, we're going to need to reduce interest rates to make sure that we're not squeezing the economy harder and harder over time. And I wonder if that's basically the logic that you apply. Is that how you think about it? And then I also wonder, in the last press conference, you said something to the effect of, it's a full year out, those discussions, and people interpreted that to mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting, I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So please, I wouldn't want to be taken that way. Sorry, the first question was that how? Yeah, so as we go into next year, that's the question we'll be asking is, taking into account lags and everything else we know about the economy and everything we know about monetary policy. The time will come at some point, and I'm not saying when, that it's appropriate to cut. Part of that may be that real rates are rising because inflation is coming down. Part of it just may be that it'll be all the factors that we see in the economy. And, that time will certainly come at some point. And what you see is us writing down, a year ahead estimates of what that might be. And, there's so much uncertainty around that. In the moment, we'll do what we think makes sense. No one will look back at this and say, hey, we made a plan. It's not like that at all. These are estimates made a year in advance that are highly uncertain, and that's how it is.
Thanks so much, Chair Powell. Neil Irwin with Axios. I wonder, how do you think about the question of whether the strong GDP growth we've been seeing is driven by excess demand versus supply-side factors, productivity, labor force growth? And relatedly, if GDP keeps coming in hot, even in the absence of inflation resurgence, would that on its own be a reason to consider more tightening?
So on your first question, we're looking at GDP very, very carefully to try to understand really what's the direction of it, what's driving it, and it's a lot of consumer spending. The consumer's been very robust in spending. So that is, that's how we're looking at it. Sorry, your second question was?
There's GDP stays hot, but without inflation.
So I think the question will be, GDP is not a mandate, right? Maximum employment and price stability are the mandates. The question will be, is GDP, is the heat that we see in GDP, is it really a threat to our ability to get back to 2% inflation? That's going to be the question. It's not a question about GDP on its own. It's you're expecting to see this improvement, continued rebalancing in the labor market and inflation moving back down to 2% in a sustainable way. We have to have confidence in that, and we'd be looking at GDP just to the extent that it threatens one or both of those.
Hi, Victoria Guida with Politico. There are multiple external factors that are playing out right now. We see rising oil prices. We see auto workers striking. There's the looming, very real possibility of a government shutdown. And I was just wondering, for each of those things, could you talk about how you're thinking about how that might affect the course for the Fed and the economy?
So there is a long list, and you hit some of them. But it's the strike, it's the government shutdown, resumption of student loan payments, higher long-term rates, oil price shock. There are a lot of things that you can look at. So what we try to do is assess all of them and handicap all of them. And ultimately, though, there's so much uncertainty around these things. I mean, to start with the strike, first of all, we absolutely don't comment on the strike, as we have no view on the strike one way or the other. But we do have to make an assessment of its economic effects to do our jobs. So, the thing about it is so uncertain. It will depend. The economic effects, it could affect, we've looked back at history, it could affect economic output, hiring, and inflation. But that's really going to depend on how broad it is and how long it's sustained for. And then it also depends on how quickly production can make up for lost production. So none of those things are known right now. It's very, very hard to know. So you just have to leave that uncertain. And we'll be learning, I think, over the course of the next intermeeting period, much more about that. And the same is true for the others. I don't know if you mentioned shutdown. I think of all these as being on the list. We don't comment on that. It hasn't traditionally had much of a macroeconomic effect. Energy prices being higher, that is a significant thing. Energy prices being up can affect spending. It can affect over time. A sustained period of higher energy prices can affect consumer expectations about inflation. We tend to look through short-term volatility and look at core inflation. But so the question is, how long are higher prices sustained? We have to take those macroeconomic effects into account as well. Those are some of them. I'm not sure if I hit them all, but ultimately, you're coming into this with an economy that appears to have significant momentum, and that's what we start with. But we do have this collection of risks that you mentioned.
Craig Torres from Bloomberg News. I was a little surprised, Chair Powell, to hear you say that a soft landing is not a primary objective. This economy is seeing added supply in a way that could create long-term inflation stability. We have prime-age labor force participation moving up, where people can add skills. Workers want to work. We have a boom in manufacturing construction. We've had a decent spate of home building. And since inflation's coming down with strong GDP growth, we may have higher productivity. All are which good for the Fed's longer-run target of low inflation. And if we lose that in a recession, aren't we opting for the awful hysteresis that we had in 2010? So are you taking this into account as you pursue policy? Thank you.
To begin, a soft landing is a primary objective, and I did not say otherwise.
Okay. All right.
I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that. If you don't restore price stability, inflation comes back, and you go through, you can have a long period where the economy is just very uncertain, and it'll affect growth, it'll affect all kinds of things. It can be a miserable period to have inflation constantly coming back and the Fed coming in and having to tighten again and again. So the best thing we can do for everyone, we believe, is to restore price stability. I think now, today, we actually, we have the ability to be careful at this point and move carefully, and that's what we're planning to do. So we fully appreciate the benefits of being able to continue what we see already, which is rebalancing in the labor market and inflation coming down without seeing an important, large increase in unemployment, which has been typical of other tightening cycles. So.
Let's go to Chris.
Hi, thank you. Chris Rugaber at Associated Press. When you look at the disinflation that has taken place so far, do you see it mostly as a result of what some economists are calling the low-hanging fruit, such as the unwinding of supply chain snarls and other pandemic disruptions, or is it more a broad disinflationary trend that involves most goods and services across the economy? Thank you.
So if I understood your question, I would say it this way. I think we knew from before when we lifted off, but certainly by the time we knew that bringing inflation back down was going to take, as I call it, the unwinding of these distortions to both supply and demand that happened because of the pandemic and the response. So that unwinding was going to be important. In addition, monetary policy was going to help. It was going to help supply side heal by cooling demand off, and just in general, better aligning supply with demand. So those two forces were always going to be important. I think it's very hard to pull them apart. They work together. I do think both of them are at work now, and I think they're at work in a way that shows you the progress that we are seeing.
Michael McKee from Bloomberg Television and Radio. In June, you forecast a 5.6% year-end median Fed funds rate, and since then, you've more than doubled your growth forecast. You lowered your unemployment forecast significantly. So what would justify that last move? Because the median forecast is for lower inflation. And given all the known unknowns that you face, how much confidence do you have, can investors have, or the American people have in your forecasts?
Well, forecasts are highly uncertain. Forecasting is very difficult. Forecasters are a humble lot with much to be humble about. But to get to your question, though, what's happened is growth has come in stronger, right? Stronger than expected, and that's required higher rates. Unemployment, you also see that the ultimate unemployment rate is not as high, but that's really because of what we've been seeing in the labor market. We've seen more and more progress in the labor market without seeing significantly higher unemployment. So we're continuing that trend. In terms of inflation, you are seeing the last three readings are very, very good readings. It's only three readings. We were well aware that we need to see more than three readings. But if you look at June, July, and August, you're looking at really significant declines in core inflation, largely in the goods sector, also to some extent in housing services, and just a little in non-housing services. Those are the three buckets. Headline inflation, of course, has come way down, largely due to lower energy prices, some of which is now reversing. So I think people should know that economic forecasting is very difficult, and these are highly uncertain forecasts. But these are our forecasts. We have very high quality people working on these forecasts, and I think they stand up well against other forecasters. But just the nature of the business is the economy is very difficult to forecast.
Given the forecast that you have, what justified not moving today, and what could justify moving in the future if you think inflation is coming down? In other words, why did you leave that extra dot in?
Well, I think we have come very far, very fast in the rate increases that we've made. And I think it was important at the beginning that we moved quickly, and we did. And I think as we get closer to the rate that we think, the stance of monetary policy that we think is appropriate to bring inflation down to 2% over time, the risks become more two-sided. And the risk of over-tightening and the risk of under-tightening, it becomes more equal. And I think the natural common sense thing to do is as you approach that, you move a little more slowly as you get closer to it. And that's what we're doing. So we're taking advantage of the fact that we have moved quickly to move a little more carefully now as we sort of find our way to the right level of restriction that we need to get inflation back down to 2%.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With your focus on year-over-year PCE, isn't it true that base effects are huge, and that by the time you meet in November, that it's more likely that you'll have a low PCE number that would make you feel more comfortable? And secondly, how would the lack of key indicators like CPI, the jobs report, impact your approach in upcoming meetings if we were to have a government shutdown? Thank you.
Yeah, I missed the first question. What was what factors?
The base factors.
Base factors. Okay. So on that, we're looking at just monthly. Right, you can look at just monthly readings and see what the increase was from the prior month. So you're right. When you go back 3, 6, and 12 months, you get base factors, but we can adjust for that. In terms of not getting data, again, we don't comment on government shutdowns. It's possible if there is a government shutdown and it lasts through the next meeting, then it's possible we wouldn't be getting some of the data that we would ordinarily get, and we would just have to deal with that. And I don't know. It's hard for me to say in advance how that would affect that meeting. It would depend on all kinds of factors that I don't know about now, but it's certainly a reality that's a possibility.
But would you feel more comfortable on the base effects that as those kind of fall out of the equation for the next couple of readings by November, would you feel more comfortable at that point?
Yes. I mean, if you're looking, we can tell how much inflation has gone up in a given month, right? And that's what we're looking at. And month by month, what's the reading? And I think what we're really looking at is there's a tendency to look at shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12-month. But I think in this situation where it looks like we've had a bit of a turn in inflation starting in June, we're also looking at 6 months and even 3 months, but really 6 months inflation. So you're looking at it over that period and over longer periods. That's the right way to go. And we don't need to be in a hurry in getting to a conclusion about what to do. We can let the data evolve.
Thanks for the question, Chair Powell. Edward Lawrence with Fox Business. So I want to focus back in on oil prices. We're seeing oil prices, as you mentioned, move up, and that's pushing the price of gas. So how does that factor into your decision to raise rates or not? Because the last two inflation reports, PCE and CPI, we've seen the overall inflation has actually risen.
Right. So, energy prices are very important for the consumer. This can affect consumer spending. It certainly can affect consumer sentiment. I mean, gas prices are one of the big things that affects consumer sentiment. It really comes down to how persistent, how sustained these energy prices are. The reason why we look at core inflation, which excludes food and energy, is that energy goes up and down like that, and it doesn't. Energy prices mostly don't contain much of a signal about how tight the economy is, and hence don't tell you much about where inflation's really going. However, we're well aware, though, that if energy prices increase and stay high, that'll have an effect on spending, and it may have an effect on consumer expectations of inflation and things like that. That's just things we have to monitor. So.
On the consumer, they're putting more and more of this on their credit card. The consumer seeing record credit spending. How long do you think the consumer can manage that debt at higher interest rates now? And are you concerned about a debt bubble related to that?
So to finish my prior thought, I was saying that's why we tend to look through energy moves that we can see as short-term volatility. Turning to consumer credit, of course we watch that carefully. Consumer distress, measures of distress among consumers were at historic lows quite recently, during and after the pandemic. They're now moving back up to normal. We're watching that carefully, but at this point, these readings are not at troublingly high levels. They're just kind of moving back up to what was typical in the pre-pandemic era.
Hi, Jean Young with M&I Market News. Yields along the Treasury curve have risen to their highest in years. What is the Fed's view about what's been driving that increase in recent weeks? And how much of it can be attributed to macro explanations and how much to technical factors? Thank you.
So you're right. Rates have moved up significantly. I think it's always hard to say precisely, but most people do a common decomposition of the increase, and the view will be it's not mostly about inflation expectations. It's mostly about other things. Either term premium or real yields, and it's hard to be precise about this. Of course, everyone's got models that will give you a very precise answer, but they give you different answers. So, but essentially, they're moving up because it's not because of inflation. It's because it'll probably have something to do with stronger growth. I would say more supply of treasuries. The common explanations that you hear in the markets kind of make sense.
Kyle Campbell, American Banker. Thank you for taking the questions. Just two on housing.
You said slower shelter cost growth is in the pipeline and will reflect in inflation readings as new leases are signed. But there's also some questions out there about the way housing costs are measured, particularly the use of rental equivalents, which are estimates from homeowners about what their homes would rent for if they were in the rental market. So my question is, how much of the effort to tame inflation, both as it's measured and felt by the broader public, hinges on housing supply? And then as far as a constrained housing supply being sort of exacerbated by this sort of lock-in effect of mortgages being higher now than they were at their recent historic lows, how is that going to impact future thinking about taking interest rates to that lower bound in the future?
So on the supply point, of course, supply is very important over time in setting house prices and for that matter, rents. And supply is kind of structurally constrained. But in terms of where inflation's going in the near term, though, as you obviously know, a lot of it is leases that are running off and then being re-signed or released at a level that's it won't be that much higher. A year ago it would have been much higher than it was a year before. Now it may be below or at the same level. So as those leases are rolling over, we're seeing what we expect, which is measured housing services inflation coming down. Your second question was the lock-ins. How much is that affecting things, really?
Is that going to affect your decisions to potentially bring rates down to their lower bound in the future, sort of creating that
very low rate mortgages, and even if they want to move now, it would be hard because the new mortgage would be so expensive, and that's one of the explanations for what's happening broadly in the labor market. Would that play a role in our future decisions in a future loosening cycle about whether we would cut rates? No, I don't think it would. I mean, I don't think that's. I think we'd be looking at fundamentally what rates does the economy need, and in an emergency like the pandemic or during the global financial crisis, you have to cut rates to the point that you have to do what you can to support the economy. So I wouldn't think that would be a reason for us not to do that. It's not something we're thinking about at all right now, but down the road, I wouldn't think so.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you've mentioned several things that would possibly weigh on consumer confidence, maybe cut back consumer spending, possible government shutdown, high gas prices. At this point, would the Fed welcome a decrease in consumer spending? Would that help you get inflation closer to your 2% target?
I wouldn't say it that way. We're not looking for a decrease in consumer spending. It's a good thing that the economy is strong. It's a good thing that the economy has been able to hold up under the tightening that we've done. It's a good thing that the labor market's strong. The only concern, and it just means this: if the economy comes in stronger than expected, that just means we'll have to do more in terms of monetary policy to get back to 2%, because we will get back to 2%. Does that answer your question?
Yeah, and I guess on the other hand, would you worry that that could contribute to an economic slowdown or even a recession?
Well, that's always a concern. Concern number one is restoring price stability, because in the long run, that's something we have to do so that we can have the kind of economy we really want, which is one with sustained period of tight labor market conditions that benefit all, as I've said a couple times. So. That said, of course, we also now, given how far we've come with our rate hikes and how quickly we've come here, we do have the ability to be careful as we move forward because of that consideration.
Thank you, Chair Powell. Simon Rabinovich with The Economist. One of the factors in the economic resilience to date appears to be a lesser degree of rate sensitivity than in the past. Obviously, we've talked about households with long fixed-rate mortgages, also companies that refinanced before last year. What is your thinking about the efficacy of rates and how that's changed? And then related to that, how do you think about the distributional consequences in the sense that if you're a relatively wealthy household with a long fixed rate mortgage, the past year has not been all that tough with rates going up, whereas if you're relying on your credit card for supporting your consumption, in fact, times are getting a lot tougher a lot more quickly. Thanks.
So I guess it's fair to say that the economy's been stronger than many expected, given what's been happening with interest rates. Why is that? Many candidate explanations. Possibly a number of them make sense. One is just that household balance sheets and business balance sheets have been stronger than we had understood, and so that spending has held up and that kind of thing. We're not sure about that. The savings rate for consumers has come down a lot. The question is whether that's sustainable. It could just mean that the date of effect is later. It could also be that for other reasons, the neutral rate of interest is higher for various reasons. We don't know that. It could also just be that policy hasn't been restrictive enough for long enough. And there are many candidate explanations. We have to, in all this uncertainty, make policy. And I feel like what we have right now is what's still a very strong labor market, but that's coming back into balance. We're making progress on inflation. Growth is strong, but I think by many forecasts, many forecasts call for growth to moderate over the course of the next year. So that's where we are, and we have to deal with what comes. On your second question your second question was distributional, but can you be a little clearer about that?
Yeah, my point there was that if you're somebody who has a long fixed rate mortgage, you've been able to endure the higher rates relatively easily. If you're somebody who's living month to month off of your credit card, current financing rates are punitive.
Yes, and so the point I would make there is that we're trying to get inflation back down. The people who are most hurt by inflation are the people who are on a fixed income. If you're a person who spends all of your income, you don't really have any meaningful savings. You spend all your income on the basics of life: clothing, food, transportation, heating, the basics. And prices go up by 5, 6, 7%. You're in trouble right away. Whereas even middle class people have some savings and some ability to absorb that. So it is for those people, as much as for anybody, that we need to restore price stability. And we want to do it as quickly as possible. Obviously, we would like to do that. We'd like the current trend to continue, which is that we're making progress without seeing the kind of increase in unemployment that we've seen in past things. But you're right, though. When we raise rates, people who are living on credit cards and borrowing are going to feel that more. They are. And of course, people with lots of savings also have a much lower marginal propensity to consume, and so it's not going to affect them as much.
Let's go to Greg Robb for the last question.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the Beige Book recently, you can tell that the Fed has been surveying nonprofits and community groups about the economic health of low-income Americans, moderate-growth Americans. I have two questions about this. Are you going to use that data to maybe come up with a sort of like a quarterly survey of those groups, like the Senior Loan Officer Survey? And also the second question is, from your recent readings of these surveys, how are low and moderate Americans doing? Is there this thing where like the GDP is strong because of wealthy Americans kind of driving things? And just want to get your sense of the health of that sector. Thank you.
So I don't know about the quarterly survey. That's an idea we can take away and think about. In terms of how low and moderate Americans, they're clearly we're suffering from high inflation. I think during the pandemic, the government transfers that happened were very meaningful. And if you know the surveys that we take showed that low and moderate income people were actually in very, very strong financial condition. I think now it's a very hot labor market, and you're seeing high nominal wages, and you're starting to see real wages are now positive by most measures. So I think overall households are in good shape. Surveys are a different thing. So surveys are showing dissatisfaction. And I think a lot of that is just people hate inflation, hate it. And that causes people to say the economy's terrible, but at the same time, they're spending money. Their behavior is not exactly what you would expect from the surveys. That's kind of a guess at what the answer might be. But I think there's a lot of good things happening on household balance sheets, and certainly in the labor market and with wages. The biggest wage increases having gone to relatively low-wage jobs. And now inflation coming down, you're seeing real wages, which is a good thing. Thanks very much.
Jay Powell there, chair of the central bank that underpins, of course, the world's largest economy. I guess trying to do here on the tail end of this rate tightening cycle what he tried to do at the onset more than 18 months ago, and that is to guide market expectations to the same path that the Fed wants to trod. Our special coverage of the Fed Decides here on Bloomberg continues right now on the close as team surveillance right now passes the baton along to Scarlet Fu, along to Katie Greifeld, and along to myself, Romaine Bostick, as we take you to the closing bell and beyond. Guys, 13 FOMC meetings we've had, of course, going back to March of last year, 11 rate hikes coming out of those 13. We're back to pause, but Jay Powell wants you to believe that they're going to hike again this year.
Yeah, and it's made clear in the Statement of Economic Projections, right, where they see one more rate hike this year. They also revised up GDP forecasts for this year while seeing lower inflation as well. What I found really interesting was Jay Powell's pushback that the SEP is not a plan. This is simply the median of all the individual forecasts that have been compiled, and he made clear that forecasts are highly uncertain. For anyone who's out there trying to craft a narrative based on all those projections, he's saying, you know what, this is hard work and this is the best that we can come up with
no
right
one
now.
would ever craft a narrative.
No. But it's a reminder that monetary policy is an art, not a science.
Well, let's go. Sure. Some people believe that. You sound like an economist. But let's just go through real quickly some of those numbers that we did get out of those projections. Basically, you're leaving the benchmark rate where it is, but making it clear in that dot pot. 12 of the 19 officials right now favoring another rate hike for this year. And they're saying they're going to raise their projections for 2024 as well as 2025. A revision higher on GDP expectations for this year and next, and a revision lower for the unemployment rate, which I thought was interesting, not only for this year, but for the next 2 years out.
And you marry those numbers into what we heard from the man himself in the press conference. This moment really stuck out to me when asked if a
was
soft
it when he pulled out
landing-
that iPad?
That was pretty good. I do have a lot of questions about that.
It was the best advertising Apple's had in years.
You didn't see the stock pop, but in response to a question whether a soft landing, whether it's safe to call that the baseline, he said that he wouldn't call a soft landing the baseline expectation. Yes, it's their primary objective. It's possible, but not the baseline. But then back to Scarlett's point, you take a look at those revised numbers, it kind of looks like they're projecting a soft landing.
But don't read too much into that.
Trying not to.
Yeah, I think, though, he wants the market, I guess, to at least have enough sense of urgency that, another hike is going to come, but at the same time, have enough confidence that the economy isn't going to fall off the cliff. It was interesting to see the market reaction, of course. We talk about stocks at one point, just a few minutes ago, we're at session lows, and, of course, you had that 2-year yield, which everyone's going to be talking about, camped out at the highest level since 2006.
Yeah, moving up, at least in the aftermath. It came back down a little bit, but still remains higher, 5.135%. That's the highest in a couple years.
Let's walk you through some of the cross-asset price action. Abigail Doolittle standing by. Abigail.
Well, Romaine, this Fed meeting certainly not a snooze fest, and from a cross-asset class standpoint, lots and lots of movement. And I would say that if we were to title the overall meeting higher for longer, take a look at the 2-year yield that you were just talking about. So when the decision came out and the sense that they will be raising at least one more time this year, plus the dot plot being raised for the subsequent years, hotter economic projections, up, then down, and now higher, and at the highest level since 2006, essentially signaling that the market is taking the Fed seriously on the idea that they are going to be staying higher for longer. Similar message for the Bloomberg Dollar Index. Rising rates will support the Bloomberg Dollar Index. And from a technical standpoint and a longer-term standpoint, the Bloomberg Dollar Index is breaking out, suggesting that the rates rising that we're seeing today, that this trend, not just today, over the last several weeks, months, and even years, over the last 2 years, is going to continue. Now, you're talking about stocks. This is interesting because the NASDAQ 100 overnight really treading water, basically into the meeting even treading water, but at this point down 0.8%. So investors, stock investors also taking seriously the message that more money money coming out of the system, and that valuation, especially for big tech like this, could be made more precarious. If we go to other indexes, we are going to see stocks, I think, basically at the lows. The S&P 500 down 0.5% now, heading toward its third down week in a row. Small cap also down 0.4%, I think below its 200-day moving average. The SOX down 1%, and then that New York FANG index down 1.3%. A hawkish pause, higher for longer. One of those characterizations does seem to be appropriate, or maybe both, for this meeting.
The market reacting right now. Of course, the Fed back in July did hike rates, putting them back on pause today. Jay Powell making it clear that the decision to hold today is based on how far we've come. Take a listen to some of the other comments that he just made at that press conference.
Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
The chairman of the Federal Reserve speaking just a little while ago, a little bit earlier today. Bloomberg opinion columnist Bill Dudley said that there were going to be 5 key things that he was watching in today's Fed forecast, including will there be another rate hike this year? What's the outlook for unemployment? How low can unemployment go without stoking inflation? And what's the neutral Fed's funds rate? And when will rates start coming down? Now that the forecasts are out, let's bring in Bill Dudley, joining us right now, former New York Fed president, former vice chair as well, and over at Princeton University Senator for Economic Policy Studies. And let's start with the neutral rate, because this seemed to be one part of the press conference where he seemed to struggle a little bit in articulating exactly how they're going to assess when they think they've finally arrived at that rate.
I think the message of the meeting was basically 2 things. Number one, soft landing is more likely, because you can see the unemployment rate only has to rise now to 4.1% to get the job done. Back in June, it had to rise to 4.5%. And number 2, economy is stronger than expected, and therefore, while policy is probably not as tight as we think it is. So there have been a little bit of an upward movement in people's estimates of the long-term federal funds rate in this summary of economic projections, first in June and again this month. So what basically the Fed is concluding is maybe monetary policy is not quite as tight as we think it is, but they're also very, very happy about how the labor market's unfolding. They basically think a soft landing is more likely, quite a bit more likely. I'm a little surprised by the market reaction. I think the market reaction should be bond yields up because the Fed's going to be tighter for longer. Stock price is sort of mixed. Higher bond yields weighing on stock prices, but more chance of a soft landing. That's a good thing for stock prices. So I'm a little confused by the market reaction.
That's interesting. You mentioned the stock market reaction, because one point you make in your column today is that keeping a rate hike in the forecast, you write, has the tactical benefit of restraining markets, which might otherwise decide that we're done and generate an unwanted easing in financial conditions. Bill, you've been in the room before during these discussions. How mindful are policymakers of the market's tendencies to immediately make assumptions off of each clue that's dropped?
The market's always searching for what the Fed's going to do from anything, from the statement, from press conferences, from speeches. So I do think keeping one rate hike in the forecast does sort of, keep the market from running away from the Fed. But as Chair Powell mentioned in his press conference, it probably doesn't really matter that much at the end of the day whether they do that rate hike or not. It's not like the economy is going to turn around dramatically if the Fed does a quarter point more or a quarter point less. I think the way he's trying to explain why they might do another quarter is to make themselves more confident that they're going to achieve their objective. So let's imagine the data is sort of ambiguous as we go through the next couple months. So if it's ambiguous and the Fed's not really sure that they're actually going to achieve their objective in a timely way with the current level of rates, you do one more rate hike to try to increase your level of confidence. So at this point, it's not really about, do they have to go another quarter or not? It's really more about would going another quarter make them more confident that they're going to have the outcome that they seek.
And Bill, beyond whether or not they're going to hike one more time or not, I think it was interesting that they actually took a few cuts out of next year's forecast. When you think about the expectations for 2024, what should we read into that? Is that the soft landing perhaps coming into fruition, or should we take that as maybe inflation is going to continue to be a problem here?
Well, they didn't really change the inflation trajectory very much. So I think the way I view taking the rate hikes out rate cuts out is the fact that the economy is just stronger than expected. If the economy has more momentum, I don't need to support the economy as much with rate cuts. So I think that's really the message, because the inflation forecast didn't really change in a meaningful way.
We're in conversation right now with Bill Dudley, Bloomberg opinion columnist, and of course a former chair of the New York Fed. I want to bring into this conversation our very own Michael McKee, our chief international and economics correspondent here at Bloomberg, who actually wants to participate in this conversation. Mike, take it away.
Yeah. Well, let me tell you what I take out of this press conference, and then I want to ask Bill what he thinks, because he's the central banker and he has a much better idea than I do of what they're talking about in the room. But it seems to me that there's a bit of an internal inconsistency in their forecasts, in that they've more than doubled their growth forecast. They significantly lowered their unemployment forecast, and yet inflation is supposed to come down. So are they saying at this point that the stronger growth we've seen is not inflationary? And my takeaway from that would be they're done, but they're leaving that extra rate increase in before the end of the year as an insurance policy. And the same sort of thing holding true for the cuts they took out last year. If the economy were to produce inflation, then they have something in there that they can point to the markets and say, we did this. Bill, is that kind of the way people should take this?
I think that's the way people should take it. I mean, I think it's very interesting that before they had the unemployment rate going up to 4.5%, now the unemployment rate only has to go up to 4.1% to do the job. What that's telling them is they're taking quite a bit of signal of the fact that the labor market seems to be getting to better balance, even without the unemployment rate rising very much. So they're more confident that the labor market can essentially normalize on its own, that the Fed doesn't have to generate as much slack in the labor market to get inflation back down to 2%. So it's and Chair Powell talked about the increase in labor force participation. He talked about the fact that the ratio of unfilled jobs to unemployed workers has come down. So they're taking quite a bit of positive signal about how the labor market is developing.
Well, if the economy develops ambiguously, as you say, over the next couple of months, would you be surprised if they raised rates again?
I think at this point they probably think that they will not have to, but they know that if they're going to move in one direction or the other in the next few months, it's definitely a rate hike, not a rate cut. So I think it's going to depend on how the data unfolds. And as the press conference, there's a lot of discussion in the press conference. There's a lot of shocks hitting the economy right now. Government shutdown, auto workers strike, the beginning of student loan repayments, oil price shock. So I think the Fed may not actually have the government data in terms of the economic releases if the government shutdown goes on for any length of time. So I'm going to be very surprised if they hike in November, and then we'll see where we are at the December FOMC meeting.
Yeah, we'll see where we are, and that's something that Powell made extra clear. They're going to proceed carefully, cautiously. Bill Dudley, thank you so much. Bill is Bloomberg opinion columnist, senior advisor to Bloomberg Economics, and of course, the former New York Fed president. And of course, our thanks to Bloomberg's Michael McKee in Washington. Here in New York with us right now to continue the conversation after the Federal Reserve policy setting meeting is Torsten Slok, partner and chief economist at Apollo. It's so good to see you here in studio today. Did Jay Powell come across to you as hawkish or dovish?
Well, I think the clear signal they want to send here is that we need to slow this economy more down. I mean, they could have decided to hike rates today. Obviously, that was not market expectations, but I think this was a very hawkish pause. I mean, the whole communication, the way that the statement was written and changed, and what he said at the press conference, it clearly signaled that we can allow ourselves to keep rates higher for longer, and taking 2 cuts out of next year, by definition, means that rates will be higher for longer. And the fact that, as Bill Dudley just mentioned, the fact that this is happening without any increase in the unemployment rate today is 3.8. And now they see it going up to 4.1. That's really almost a rounding error. So saying the labor market is just not going to change in their forecast, that is quite incredible, in particular when they at the same time say we're worried about inflation, and they're saying we're worried about inflation being too sticky, and therefore the risk that inflation might not come down to 2%.
Well, Torsten, seizing on the idea that higher for longer is really the takeaway from this decision, from this presser. I want to go right to your notes, because you wrote before the decision that rates and therefore the cost of capital are going to stay elevated for another 9 to 12 months, and credit and equity investors should plan accordingly. What should that plan look like? Because I look at the equity market this year, I see it double digits higher, look at credit spreads, and they're pretty tight.
I know, but what's going on, and he was asked about this also, is that you're seeing both for consumers and for firms, higher interest rates or higher cost of capital are beginning to bite harder and harder. We're beginning to see delinquency rates going up for consumers on credit cards and auto loans. We're beginning to see default rates going up on high yield. If we are going to keep rates at these levels for another 9-12 months, we should be extrapolating the current lines for what's going on with delinquency rates and default rates. And that runs the risk, in particular in high yield, where default rates are now up to 4.3 in the data for August that just came out, that could continue for the next 6-9 months. And that's then going to open up a risk that if we begin to see the cost of capital bite harder and harder on companies every single day that cannot either get a new loan or refinance an existing loan, we begin to run the risk, of course, that we'll begin to see more companies defaulting. And on the consumer side, more people falling behind on their payments. He was asked about, are you worried about delinquency rates going up for consumers? And he said, oh, this is just a normalization. But I think the important thing here is, why is it normalizing? Because interest rates have gone up. So I do think that high interest rates are biting both on consumers and on corporates, and they're going to allow that process to continue now for potentially even not only the next 9 to 12 months, but maybe even the next 18 months, because they're going to keep rates higher. And I think that process is exactly what I would call the crystallization of the transmission mechanism of monetary policy, trying to slow the economy down gradually more and more. And that's the process that we're seeing across the board, both for consumers and corporates.
And Powell really did make that correlation, maybe not explicitly, but as explicitly as we're ever going to get out of a Fed chair, when he did talk about this idea that if the economy strengthened or did perform better than what was already in their projections, then we were going to get more hikes here. So he's basically sending that message loud and clear that at least the economic activity we're at right now, that might actually be the baseline, or I should say maybe the top line.
Absolutely, because think about it in credit markets. We are every single day when interest rates and cost of capital, as Katie has just highlighted, are at these high levels. This is having real implications. There are real firms that need to roll over loans. There are real firms that need to think about, do they want to have a new loan? And if the cost of capital stays at these levels for another year, that means that for the next 3-4 quarters, we are likely to see the increase in default rates, in particular for lower rated companies in loans and in high yield, continue to slowly grind higher. And this becomes a difficult process to manage for them, in particular if this starts to spread. Remember, there's about 11 million people who work in the companies that are high yield issuers. So that means that from a total employment perspective, there's potentially a lot of people in the high yield industries that are at risk of losing their jobs if this default cycle continues.
I'm curious, when you looked at the SCP numbers today, the economic projection numbers today, are they pretty much in line with your own outlook?
Yeah, I would also expect the summary of economic projections, as it said, that things are still okay for now, but they are projecting, and that's also what I would expect, that's also what the consensus is expecting. They are expecting that things gradually continue to slow down. Remember, they have two goals, of course. They have inflation and they have employment, and you need to have a soft landing, not only in inflation, we are well on track there, but we also need a soft landing in the labor market. And the fact that they are almost saying that we have almost achieved a soft landing because the unemployment rate is very close to the end goal where they think it will be in 2 years, that's saying that we can get inflation down with no implications for the labor market. That would be quite remarkable when you at the same time think about how companies, as we speak, are seeing default rates going up, in particular, again, for lower rated credits with higher leverage and lower interest coverage ratios.
All right, Torsten, really appreciate your time. Great to see you on set with that instant Fed analysis. That is Torsten Slok of Apollo. Meanwhile, you take a look at these markets. Stocks down, yields up. Bloomberg's Jess Menton standing by with a check.
Okay, Katie, Romaine, and Scarlett, taking a look at the S&P 500, the round trip it's made since the Federal Reserve first began raising interest rates in the cycle back in March of 2022. If you look in that span, the S&P 500's up close to about 4% in that time frame. But also, if you look back where it bottomed in October of last year, up well over 20%, actually around 23% at this time frame. But if you're looking at where things are trading today, not a ton of movement as stocks have been fluctuating this afternoon. Typically, historically, over the past 3 decades, the stock market, usually on Fed days, the S&P 500 does end flat. But going through today, there actually has already been 101 trading days since the last time the S&P 500 has seen a decline of at least 1.5%. So today would mark 102 trading sessions. That's the longest streak since 2018. So it's going to be interesting to see. Apparently, this wasn't necessarily the catalyst that investors may have been expecting to see a downward decline there, but something to definitely keep an eye on. Katie, Romaine, and Scarlett.
Jess, great roundup. Really appreciate it. And you know it's a big day because Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey is in the New York office coming up from Princeton. And Ira, it was really interesting facing listening to Jerome Powell. He brought up real yields multiple times. Just to go through some of the headlines here, he said that real interest rates are, quote, meaningfully positive now, and also that they need to stay positive for, quote, some time. When you think about where real rates are right now, you think about 5-year real rates well above 2%. How much of a tightening impulse is that doing for the Fed?
Yeah, I think that the tightening and the real rate environment is exactly where the Fed wants it. So I think the question becomes is how long do they keep it there? And then what happens if, say, inflation continues to come down a lot and therefore real rates just are even higher, right? So one of the things that we looked at in a note this morning was where the market is pricing the expectation for the real Fed funds rate a year from now. And basically where the market's thinking that actually real rates are going to come down a little bit because this morning anyway, or last night when I put the piece together, everyone thought that the Fed might, be cutting interest rates a little bit more than they think now, right? But I think that the fact is that the market still wants and still believes that the Fed is going to be able to hold the policy rate above inflation for at least the next couple of years.
One question I thought was really interesting was the question on the efficacy of rates. This idea that households and businesses that should be hurting more from the steady increase in rates have actually done okay, in large part because they locked in lower rates, either through 30-year fixed rate mortgages or refinancing before the Fed began raising rates. What did you think of Chair Powell's explanation about how just balance sheets are healthier than we might have expected?
Yeah, so he didn't mention this directly, but it all goes to the long and variable lags argument, right? So it's just longer and maybe more variable this time in large part because of what you just noted, right? A lot of basically the terming out of debt, both by the household sector and the business sector, and it's something that's basically been going on since the late 1990s. So this is a generational shift. It just means that it's going to take monetary policy longer to work. It's not that monetary policy won't work. It's just that it takes much longer to feed through the system. When 25% of corporate debt was in commercial paper and it was all 2 and 3 month CP, that affected the market immediately.
Yeah.
There's no more CP as a share of corporate funding, right? So it's not going to affect businesses and business activity as much now. But over time, you have less CapEx, right? Because maybe you're not willing to borrow a little bit more to do that capital expenditure that you would have. But again, that's a much longer, that's a 3, 4, 5-year type of activity rather than 3 months or a year.
All right, Ira, great to catch up with you here, Ira Jersey, over at Bloomberg Intelligence, the chief U.S. interest rate strategist there as we continue our special coverage of the Fed Decides here on this Wednesday afternoon. We continue to count it down to the closing bells as well, which are just about 14 minutes away. And Ira, we want to actually keep you here, Ira, if you can, before we let you go, because you're so good. We decided to ask you additional questions. And I do have one question here about the idea that how many people were betting on the steepening of the curve, meaning investors in the market. And when you looked at the dot plot and the economic projections here, do you think that's going to be enough ammunition to actually see a significant unwind in some of those bets?
Yeah, so I think that's actually one of the reasons you've seen some of the what we call bear steepening over the last couple of weeks, which is people thought that maybe the Federal Reserve was going to cut interest rates pretty aggressively next year. And because of that, you wind up with 2-year yields rallying a lot and 2-year yields much lower. And that was the interest rate, the steepener, and that was a consensus for a while. And I thought that for a little while too, although I backed off from that the last couple of months. So I do think that some of the move that you're seeing today are people saying, okay, well, look, if the Fed's on hold, 2-year yields aren't going to go down a whole heck of a lot.
I want to follow up on that too, because we're something like 18 months from when we first started this cycle, and really close to 2 years when you consider when you started to try to jawbone the market. Your expectations when you go back maybe to late 2021, early 2022, compared to your general expectations now here, did they shift meaningfully?
Well, yeah, of course, because we wound up getting much higher inflation than we thought, right? We were thinking that 10-year yields would peak somewhere under 4%. We've obviously peaked above 4%. The challenge with managing money and trying to determine where interest rates are going to go, particularly longer-term interest rates, it has to evolve, right? So getting direction right ends up being much more important than getting the magnitude right, because you can always stay in a trade longer if it's working than getting it wrong and getting stopped out or losing a lot of money, right? So we thought that yields were going to go up in 2022, right? That was a pretty consensus view.
Yeah.
But we thought, again, like 3.3%. Now it's 4.3%. I do think, though, overall, you have to think about, for the longer end of the curve, are we near or at the peak of interest rates? And I think we probably are, but there is a big risk here because we've tested this 4.35% on the 10-year.
Yeah.
If we break through that, there's going to be a lot of stops where a lot of people like buying at like 4.25, but if you get to 4.5, those people are going to get out of that trade, and you wind up with a big spike in interest rates.
What would be the impulse for long end rates to go higher, for the 10-year specifically to reach 4.5? What would be the actual catalyst to drive it there?
Yeah, I think it would have to be a reacceleration of inflation. So basically CPI and the core PCE deflator moving up a bit. And then as that occurs, basically even more shifting of expectations for what the Fed's going to do. So I think in order to see, a 5% 10-year, you probably need to have expectations of a 6% Fed funds rate or higher, just because the market is going to continue to think that at some point the Fed will cut interest rates. But if the Fed is still hiking interest rates, then you wind up having a significantly higher 10-year yield as well. So another 50 basis points or 75 basis points of hikes by the Fed, that might get you close to 5% on a 10-year. Now, that's not our base case expectation, obviously, but that's probably the likely market outcome of that scenario.
All right, Ira, now you can go.
Thanks, Roman.
I think the Amtrak trains are back up and running. Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey there, helping us walk through not only his take here on those economic projections, guys, but more importantly, how the market might react should some of those projections get hit. And of course, the big move today is in that 2-year yield, the most rate-sensitive part of, at least the main part of the curve here, up 7 basis points right now, 5.1587 and change.
The highest level since 2006. We also have the 10-year yield moving marginally higher. One thing that we were trying to figure out yesterday was the big move up in yields as well. And there are different reports, but Canadian CPI picking up, quickening in August after it had appeared to stabilize, raising some concerns that we're going to see a similar reacceleration of inflation here in the U.S. because the Bank of Canada was ahead of us with the hawkish pause.
Yeah. And it's interesting, too. I mean, we talk about the equity market reaction. We're still around session lows here for most of the major equity indices here. And I was just looking at the S&P sectors, and basically what's leading it right now is consumer staples and healthcare and real estate.
And then you take a look at the NASDAQ 100, your big tech names. The NASDAQ 100 off by 1.2%. I thought it was interesting. It was Bill Dudley, right, who said that, okay, if you take a look at what the expectations are, rate cuts coming off the table next year, shouldn't stocks be higher?
Yeah, he was puzzled by that for sure. I mean, big tech is, so maybe that should lift the markets overall. Let's not forget that we do have earnings coming out after the bell.
Yeah.
There's still corporate news, and FedEx will be reporting. We'll be all over that.
Yeah, we're going to get FedEx, and I see you got Clavio up there. It's a debut here on the day. Let's continue this conversation right now as we count you down to the close. Jeffrey Rosenberg joining us right now, BlackRock portfolio manager of the Systematic Multi-Strategy Fund. And Jeff, I just want to get your take right off the top here. When you heard the commentary from Powell at the press conference and kind of the back and forth with regards to where rates might be, where the neutral rate might end up here, this seemed to be just once again him trying to work that magic on the market and keeping their expectations in line with the Fed's expectations. Do you buy into it?
Well, I think that, most of the action in this meeting, comes from the statement of economic projections. And as Powell, tried to lay out, that's not part of the committee's deliberations. It's not a plan, but it is really, the signaling of each individual participant's expectations. And so that was really the dominant story. And so Powell had to kind of navigate that. But I think it was a story that he wanted to tell, particularly in showing, higher or restricted for longer in terms of the 2024 dot. The 2023 did not have the decline. So overall, it preserves a lot of policy flexibility to become less restrictive over time. And I think that's the easier path for Powell to have taken. And I think that's probably a good outcome for him and the FOMC today.
Less restrictive over time would suggest that current policy is sufficiently restrictive. And I fixate on that clause, that phrase, because that's a qualitative, not quantitative judgment, isn't it? What does sufficiently restrictive mean in the current context? Is it a moving definition or range, or is it a fixed target during this rate hike cycle?
Yeah, and as you saw, there was a lot of discussion and a lot of questions on that, and I think the answer is sort of you know it when you see it, which is that the policy rate has the impact on the data, on the economy, and most importantly on inflation that they're expecting. So, most of the forecasts that were written down today, and most of the market forecasts basically say the Fed's going to have success here on inflation, and so therefore we're sufficiently restrictive, and we're about to move the discussion to, are you too restrictive? What about cuts in 2024? Why did you take 50 basis points out of the cuts in 2024? But that may be premature. It's basically, counting your chickens before they've hatched in the form of we're expecting that inflation decline. And if we don't get that expected decline, that's going to be a bigger surprise, noting that, we've had a lot of failures in the consensus forecasting around inflation. Now it's too benign. Now the market is too complacent around the expectations that inflation will go back down to its pre-COVID level. I think that's where the surprise in the forecast may come from. But right now, there's pretty good consensus both at the Fed, in the SEP, and in the market that inflation has been won. The war on inflation has been won, and it's just not as Powell laid out in part of the Q&A. Now it's more two-sided and trying to secure that soft landing that is so much in the consensus, and I think is also reflected, partly in these SEP forecasts as well.
So, Jeff, how high is the hurdle for a rate hike in November? And he himself said that, it probably wouldn't do anything for the economy.
Yeah, I mean, as he said, and I think it's right, one more hike here is not really the make or break story. The story is really that they're going to be high for longer, restricted for longer. We're pretty much at the end of the hiking cycle. Whether there's one more or not, very much depends on how strong the economy is. And as he highlighted, the change from the prior forecasters really about the strength in the economy, contributing to people's unease about how quickly they had penciled in cuts in 2024. So that's really going to be the story here going forward is, does the strength persist? Does inflation not fall as much as forecast because of that strength? And the Fed actually needs to do more or hold at the higher rate. Well, both needs to do more in the form of one increase, but then hold at that higher rate for a longer period of time into 2024.
And Jeff, I'm still stuck on Chair Powell's comments on real rates, these meaningfully positive real rates. And just to recap what we've seen so far in 2023, you have 10-year real yields up about 45 basis points. You look at the S&P 500, up about 15% so far this year at the moment. I know that AI is very exciting, but when does the U.S. equity market start to respect what we're seeing in the bond market?
Well, the discussion on real rates is very interesting because, both you have an increase in kind of the projected real rate into 2024 with the 50 basis points of cuts in nominal rates being taken out at the same time as you basically maintain the inflation rate decline. Yet the discussion also brought about the longer run estimate and effectively the discussion on, what is the real neutral rate? So, right now, estimates for the real neutral rate imply that these are very high and therefore restrictive real rates. But there is this possibility, and Powell talked about it. He admitted that, the resilience of the economy might point to the fact that your neutral rates are indeed higher, that post-COVID structural changes have led to that. And, that will be the kind of historical reckoning of this tightening cycle, that if real rates indeed did go up, that we actually weren't as tight as we expected in real time. And that might explain the lack of the inflation decline down to the 2% level. Sort of the easy parts of inflation declines are behind us. The hard part is ahead of us. And whether we achieve that as easily as these forecasts in the SEP are implying very much depends on whether or not these real rates are as tight as we think they are today.
All right, Jeff, going to have to leave it there. Jeffrey Rosenberg over at BlackRock. He basically made it clear here, guys, that I thought he used the phrase here, the hard part really is here. And I just want to quote something. Enda Curran, one of our Bloomberg reporters here, wrote something great in the live blog that we had. And he basically said it's clear, in his words, it's clear the Fed is now in a much more, quote, complicated judgment territory than it has been. And he goes on to talk about this idea that when you go forward, these next few meetings, it's going to be insane.
What do they say about script writing, that the third act is the hardest?
I don't know. I've never taken a script writing class. What are you doing in your
Maybe
free
I
time?
revealed too much about myself.
Yeah, what is the script about?
You think about how close the finish line is.
Does it involve me and Scarlett?
No, it's all about the Fed, actually.
Oh, is it?
Yeah,
Okay.
basically, and how hard it is, their path forward.
Hold that thought, Katie Greifeld. We're moving closer to these closing bells. Our full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld and Scarlett Fu. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast with our friends Carol Masser and Tim Senevik. Welcome to our audiences across all of our Bloomberg platforms here on Fed Day. Of course, the big headline, guys, is the Fed holding rates here at the September meeting, but making it clear in those projections that it expects rates to be higher for longer into 2024 and beyond.
Right, and it looks like, Romaine, that the Treasury trade certainly got that memo and that note and that message very clear. Your two-year note now at 5.15. I mean, what? We're at the highest in since 2006, I believe. So we've really seen kind of a bit of a reset again, I feel like, this week and certainly on this day when it comes to rate expectations. And we just talked with Larry Pitkaski over at Good Haven, and he said, I love what he said, I think we're in a higher rate, risk-free environment without existential worries. So in other words, higher rates for longer, get it, but maybe without some big risks.
But here's the thing. When you look at the summary of economic projections, how can you know what's going to happen in 2024? How can you know what's going to happen in 2025? It's you really, as Yelena Shaleetov over at BNP Paribas told us, you have to take anything beyond this year with a giant grain of salt. We just don't know what's going to happen.
So Scarlett, should it not be considered a plan then?
He was very clear that this was not a plan. These are the median, the average forecast among, all these different participants who submitted their numbers. And by the way, economic forecasting is very difficult, guys.
I've heard that before. I heard that today, actually, from Fed Chair Jay Powell.
I mean, not if you have a crystal ball. I don't know. Do you guys not have one?
Yeah, we don't. Let's walk you through the market numbers here. We've been talking a lot about the macro, but it was a pretty busy day for equity markets. Obviously on pins and needles about the Fed, but of course you had an IPO today in Klaviyo, and not necessarily the best trading day for Instacart and ARM once again. The net effect of it all is the Dow Jones Industrial Average lower by about 0.2%. The S&P 500 giving back almost 1% on the day, or roughly 41 points, a close right around that 4,400 level, a key technical level there. The NASDAQ composite down about 200 points, or 1.5%, while the Russell 2000 looks like it's going to finish out the day lower by about 0.9%.
All right, quick look at the S&P 500 in terms of the names, about 173 to the upside, 328 to the downside, so certainly more of that risk-off trade, no doubt about it, and 2 unchanged, Scarlett.
Yeah, volume also slightly lower than the year-to-date average. Let's look at the sector performances here for the S&P 500. It was a down day for the major indexes, as Romaine told us, but there are some sectors that did finish higher, including telecom names, healthcare equipment, and food, beverage, and tobacco. So you're seeing a lot of those dividend plays, those safety plays come out ahead. On the flip side, you've got a lot of those big tech names, media, entertainment, semi and semiconductor equipment companies, and tech hardware, along with software and services, all leading to the downside, all down by at least 1.5%.
All right, a little nervous, making sure that my gainers actually held on to their gains, but let's go to it. Klaviyo, right? The IPO. It's been a big week.
Not all of them did, Carol. Can we just get rid of that fourth one?
Darn it, gosh. All right.
Can you just block out her box?
You know,
wow.
Again, I'm here. I can hear this. All right, so Klaviyo up about almost 32% at its highs today in its first day of trading as a public entity here, finishing up, though, with about a 9% gain. It was oversubscribed nearly, I think, 30 times. So, it's interesting. Limited supply, another one of those kind of IPOs, but nonetheless, a gain, but lost a lot of that momentum that it saw earlier in the session. Pinterest, I want to go there because it's been on quite a 2-day rally, up another 3%. It gained 3% yesterday. Analysts were impressed by Tuesday's Investor Day, saying that the social networking company was upbeat and that the long-term targets look achievable. It's up roughly about 12-13% so far this year. And then Enphase Energy, once again, rallying up 4% yesterday, up another 1.5% today. News Monday, late Monday, after the close at co-director Thurman Rogers bought about $4 million worth of shares. It's the only news I could find, but it looks like still some momentum. Still down more than 50% year to date, and you got about 8% of the float shorted. Initially, a lot of other solar names were higher, which meant the Invesco Solar ETF was up almost 2% at its highs today, but finishing with a decline of 0.1%. So over to you, Mr. Decliner.
Handing it off to me.
I am.
I'll take it. Let's talk about some of the stocks that moved lower on the day today. In the S&P 500, mega cap tech declining after the Fed's higher for longer message. Apple among the worst performers on a points basis in there. Microsoft there as well. Nvidia, Alphabet there as well. We should note that Dow Jones also reported a note from UBS's David Vogt that questioned demand for the Pro version of Apple's new phone, saying demand was not as strong as it was for the Pro models last year. And then Zebra Technologies, the worst performer on a percentage basis in the S&P 500, down 6.5% today. It's a company that makes barcode scanners, interactive kiosks, and more. Got downgraded to underweight from equal weight at Morgan Stanley. Morgan Stanley analyst writing that the pace of recovery at the consumer electronics company will likely be slower than expected. And then let's check in on Maple Bear. That's, of course, Instacart. The price for that IPO was $30. It closed today just above that IPO price. Yeah. So hung on to that, but still down 10.7% today. This after raising earlier this week, $660 million.
And do you know why it's Maple Bear?
No. Oh. Well, anyway.
Do we have something more important? Let's go to something more important.
Okay. Well, something more important, I would say, is the bond market. Yeah. I know there were some interesting single stock stories, but on Fed Day, of course, we got to take a look at what's happening across the Treasury curve, all the action in the front end. As you can see there, you have 2-year yields managing to rise 6-7 basis points, 5.15%. That is the highest 2-year yield.